Hi, hello, and namaste to all my dear students. This is CA Dhananjay Bhave. I welcome you all to this YouTube marathon revision on financial management for CA Intermediate. In this detailed video, I will be covering all important practical segments of financial management. I've prepared an exhaustive 83-page material which has all the formulas, all the important concepts and questions. This PDF can be downloaded. I will share the link to download this PDF in the description box below. Please make good use of this video. I recommend you to watch this video entirely. I've covered all the practical topics and all the important formulas. Do not skip any topic. It may be there are some topics which are very small. Even if it is very small topic, you never know. Institute may come with one bouncer question and that may be from a very small topic. So please don't ignore any section of this video. And when you're watching this video, please keep your ICS study material handy. And if you have attended my regular batch, regular class, you can keep that material. Most importantly, keep a notebook and a pen. I will be dictating some additional points. I'll also be asking you to write down few things that you should revise one day before exam. Please make a note of all of that. And whenever I ask you to write down something or mark something as important, please do so. Okay, without wasting much of time, let's start with first chapter, investment decision or capital budgeting. Yes, let us begin with chapter number 1, investment decision or capital budgeting. So this topic mainly is based on one concept, the concept of time value of money, which basically says that the value of money in future is less than the value of money today. Then all the investment decisions, cash outflow happens now, that is year 0, and cash inflow is in year 1, 2, 3, 4, up to n number of years. For our learning purpose, I am taking 5 years as the project period in total, year 1 to year 5. All my examples I will discuss year 1 to year 5. Understand, it is year 1 to year n depending upon number of years. Basically, we know the compound interest formula, that is future value is equal to present value into 1 plus r to the power n. That is, if I put 100 rupee today at the rate of 10% for 4 years, how much will I get at the end of year 4? This 100 is what I am investing today, present value, 1 plus rate of interest 10% 0.1 to the power 4, because it is compounded 4 times. The number that I get is future value. But what happens in business is exactly opposite. You will earn money in year 1, 2, 3, 4 and so on. But the outflow is happening right now, that is today itself. So if money is going out today and money is going to come back to you in future, you cannot compare this 100 outflow with this 30 plus 40 plus 50, that's all assume 3 years project. You can't add these 3 and say my total inflow is 120, outflow is 100, therefore it is a good project, I'm going to earn 20 rupee extra. The mistake is the 30 rupee which you're going to get is at the end of year 1. End of year 1, value of 1 rupee may not be equal to 1 rupee, it is less than 1 rupee because of the inflation. Due to inflation, purchasing power of money goes down. That means 1 rupee in future is definitely less than 1 rupee. You are getting this 40 at the end of year 2, so definitely this is not equal to 40. In reality, this is much less than 40, and year 3 it won't be 50, it will be much less than 50. So what we do in this topic is mainly this, converting the future cash inflow to their real value or present value. Outflow is happening right now, therefore there is no confusion. Year 0, 1 rupee is equal to 1 rupee. But what comes to you is after year 1, year 2, year 3, year 10. That number is not equal to book value. The book value is 100 rupee, but 100 rupee after 7 years won't be equal to 100. It is much less than 100. That is this discussion now. 1 plus r to the power n is called compounding factor. That is finding out the future value if you invest today in a bank at certain rate of interest. But then in business scenarios, investment is done once, assume year 0, and returns are earned in future, that is year 1, 2, 3, 4, 5. See the example. Investment today 10,000 rupee, return expected after 3 years 10,500 rupee. Now to decide whether it's a good investment or not, we can't compare 10,000 with 10,500. We cannot say, look, I'm going to get 500 extra. The reason is that 10,500 that is coming to you is after 3 years. And after 3 years, the value of 1 rupee won't be equal to 1 rupee. That means this 10,500 is not equal to real 10,500. This is only book value of 10,500. Why we cannot compare? The timing of outflow and timing of inflow is different. We know that the value of money changes from time to time. That is, value of 1 rupee today is more than value of 1 rupee after 1 year. Same way, 2 years, 3 years, 5 years, the more that side you go, the less is the value of the money. Therefore, now what to do? Comparing 10,000 with 10,500 directly would be incorrect. Hence, we need to convert 10,500, which is expected after 3 years, to its real value or present value by adjusting the time value of money. Here we are converting future value 10,500 to its present value. This is called discounting. If I put money, how much will it be after 3 years is compounding. I'm going to get something after 3 years. How much is its real value or today's value? That is discounting. For compounding process, we use compounding factors. For discounting, we have to use discounting factor. Now, what is compounding factor and what is discounting factor? Here, when I say 100 into 1 plus r to the power n, that is 100 into 1 plus zero point 0.1 to the power 4. If I do 1.1 to the power 4, whatever number I get, example 1.441, I'm writing, this number is called compounding factor. And compounding factor has to be greater than 1, because 1 rupee if you invest today, even at 1% return at the end of 1 year, bank will give you more in book value terms. But in real value terms, it will be much less powerful. Therefore, see this, discounting factors or discounting, sorry, accordingly, for discounting, we use discounting factor. Discounting factor is also called as discounting rate. Other names are inflation rate, bank rate, FD rate, opportunity cost, hurdle rate, cost of capital, anything given in the question. And remember this, please make a note somewhere. If discounting factor is not given in the question, then you can always take 10% and give a note. If question is silent, take 10% as discount rate and work out the sum. They will give. If they don't give, then you take that 10% as the discount rate. All compounding factors are greater than 1. Why? If you put 1 rupee today in a bank, even at 1% interest after 1 year, surely you are going to get more than 1. And all discounting factors are less than 1. The reason is, in future, whatever money you get, that will be less powerful. That is, 1 rupee received after 3 years will not be equal to 1. It will be much less than 1, maybe 0.83, that is 83 paise or 82 paise. That depends on inflation rate, discount rate, and if that is not given, I've already told you, to be taken as 10%. Now, I've given a small format to you. NPV method is the first method in this topic. In NPV method, what you do? You keep the cash flows, that is year 0 cash flow. You write it as cash flow in exam. Some students write this as cash inflow. It is not cash inflow column, it is cash flow column. If it is outflow, you write with a negative sign. Inflow, you write with a positive sign. Because it may so happen that in third or fourth year, you may have an outflow. You may be buying an additional asset in the mid of the project. Therefore, let it be cash flow. Can be minus or plus. Assume as of now minus 100. And inflows are 30, 40, 65, 85 and 95. I have taken 5 years as project life. Now discounting factor 10%. For year 0 it is always 1. That is 1 rupee today is equal to 1 rupee. In calculator, how much is the discounting factor at 10% at the end of year 1? You have to do 1 divided by 1 plus rate of interest. Understand here, you did 100 into 1 plus r to the power n. You have multiplied and now you have to divide. Simple formula, future value is equal to present value into 1 plus r to the power n. Now, I know future value, that is amount to be received at the end of year 1. I want to know its present value. Therefore, future value, I will shift it here, 1 plus r to the power n is equal to p. And this can be even written as future value into 1 divided by 1 plus r to the power n is equal to p. Now, 1 plus r to the power n is nothing but 1 divided by 1 plus rate of interest is or discounting is 10% at the end of year 1 future value into 1 divided by 1.1. So when you do 1 divided by 1.1, what you get is 0.909. The meaning of this is 1 rupee received at the end of 1 year is worth only 90 paise. And if you are receiving 30 rupee at the end of year 1, 30 into this, you get 27.27. The meaning of this is if you receive 30 rupee at the end of 1 year, its real value is only 27.27 rupee. This way, you will calculate the discounting factor 1 divided by 1.1, that is the first year number, your 0.909 in calci. Divide that again by 1.1, you will get what? 0.826, 0.751, 682 and 620 and so on. If nothing is given, you can take 10%. If they give discount rate, you take that itself. Lot of students, while doing the revision also, you will face one challenge. If you're working out study material or RTP questions, the way you round off and the way they round off sometimes is different, and because of which your answers won't match. If you're doing old RTP, MTP revision, don't worry about this. Most of the questions in exam, they will give you discounting factors. If you have seen RTP or old question papers, they will give you discounting table itself. If they give 0.9093 digits, you also take 3 digits. If they give 0.90, that's it, you also take 0.90. If given in the question, you don't calculate the discounting factors. If they don't give, then you will have to calculate 3 digits you write, and for any discount, for any error or difference in the answer, and if that is only because of the rounding off, please don't worry. And then you multiply 30 into 0.909, 27.27 and so on. If the NPV number is positive, you accept, otherwise you reject. This is a simple concept that you all know. Now, NPV table is based on cash flow. It is not based on profit as per P&L account. Now, when I say cash flow, how to find out? If I go to my P&L account, what I have in P&L is net profit number. But that net profit comes after deducting lot of non-cash expenses also. Let's take one example, depreciation. My NPV table is purely based on cash flow. Please understand this. If you want, make a note somewhere. Many students take profit before tax, profit after tax, GP, NP, all of that is wrong. NPV is purely based on cash flow. So if they give net profit as per P&L, and in the P&L if you have depreciation, understand it's a non-cash item. And if tax is not taken, you will have to minus the tax. So it is always cash flow. It is not PBT, it is not PAT, definitely not GP, definitely not MP. See this. What is CFAT? Cash flow after the tax. When an asset is purchased, we charge depreciation on it throughout its useful life. We know this, whichever method as per the question. However, from cash flow point of view, entire cost of the asset is taken as outflow in year 0 itself. Here I wrote minus 100. This is the cost of the asset, and I have taken it as an outflow entire amount in year 0 itself. Therefore, look at this. Hence, there is no need of considering depreciation as cost in each of the years. If I do that, it will be a duplication. Year 0 also I have taken minus 100. Year 1, 2, 3, 4, 5 also, if I take depreciation, say 20 rupee, 20, 20, 20, if I take for 5 years, I have taken minus 100 already, and I am taking it again 5 times, 5 years, assume useful life and scrap value 0. I should not take it in 2 places. However, as per Income Tax Act, depreciation is to be charged before calculating taxable profit. Tax is a cash outflow. Depreciation is not a cash outflow. Therefore, depreciation should not be taken, but tax should be taken. To calculate tax, I should first deduct depreciation. Therefore, in conclusion, what is happening now? From cash flow point of view, depreciation is not necessary. Not necessary because I have taken the full cost in year 0 itself. But from tax computation perspective, depreciation is necessary. Why? If I don't deduct depreciation, then my taxable profit will be wrong and my tax payment will also be higher. When Income Tax Act says deduct depreciation, if I don't deduct depreciation, it is my loss, because to that extent profit won't come down. If profit is not coming down, my tax will not come down. Therefore, to calculate the correct tax, you need depreciation. But to calculate NPV, you do not need depreciation because you have taken the outflow in year 0 itself. So now you see what is to be done. Profit before depreciation and tax, you take it from the question, or if they don't give in the question, we will have to work out. I'll tell you what is to be done in such cases. 10,000 minus depreciation, assume I have taken all these are example numbers, minus 2,000. Profit before taxes 8,000 minus tax, assume 30% tax rate, and if it is not given in the question, you can always take 30%. 2,400. Profit after tax 5,600. Add back depreciation, what you get is cash flow after the tax. First I deducted depreciation to calculate PBT, then I deducted tax to calculate PAT. I added back the same depreciation because it was a non cash item. This is cash flow after tax. Now, in one place I am deducting depreciation and in another place I am adding the depreciation. If I don't do this, then what will happen? This is 10,000, depreciation is 0. Assume I don't minus it. Then profit before tax will be 10,000. I'll end up paying 30% tax on this. My tax will be unnecessarily more. Income Tax Act says please take depreciation, and if I don't take depreciation, my taxable profit goes up, and if taxable profit goes up, tax will also go up. And then this will be 7,000, nothing to add, this will be 7,000. And now if you see, there is 600 rupee reduced cash flow because you paid 600 rupee additional taxes. Therefore, remember, depreciation should always be taken for the purpose of tax computation. Once you compute the tax, depreciation is added back because for cash flow purpose, you don't need this. Now, do you remember in regular class we have worked out lot of questions where PBDT is not given, right? You have to read this part, very important in examination. Make a note somewhere. Always check the starting point. Sometimes they start with PAT, sometimes they start with PBT. Write it in your own way. Always check the starting point. Sometimes it is PBDT, sometimes PBT, sometimes PAT, sometimes maybe even sales, sometimes maybe even sales. Now please listen. Case A. Suppose in exam they give you PBT. Tell me what to do. From PBT you have to first deduct tax. You get what? PAT. For that you have to add back depreciation. You get CFAT. That's all. Correct? Sometimes in the question itself they'll give you PAT. Then what to do? For PAT you have to only add back depreciation. You will get CFAT. Sometimes they give you PBDT. Tell me what all to be done from PBDT first minus the depreciation. For depreciation, they should give a method. If method is not given, you can take SLM and give a note. If it is WDV, they will give you percentage. From PBDT, you will deduct depreciation, you will get PBT. From there, you will deduct tax, you will get PAT. For that, you will add back depreciation, you will get CFAT. Okay. Case D, in some questions, they will start from sales. Now tell me if they give sales, we have to deduct all the expenses. Normally, you will have material, labor, and overhead expenses. And sometimes this number overhead, they will say that this is including depreciation. Now tell me if this is including depreciation, then sales minus material, labor, overhead, what you get is not PBDT now. You directly get PBT because this is included. Correct? You have to read this carefully in exam. From PBT, you know you have to minus the tax, you get PAT, you will have to add back depreciation. Sometimes they say this is including depreciation, but they won't give you amount of depreciation. Correct? Here it is okay, you can write overhead including depreciation, but to add back depreciation, you will still have to find out depreciation. So always do that as a working note 1. Okay, if you want to make a quick note, write down. Always your working note 1 is depreciation computation. Working note 2 will be CFAT computation. Working note 3 will be NPV table. I will wait. I am repeating. Always first working note is depreciation, second working note computation of CFAT, third working note is statement of NPV. One important point, say case E. Suppose question says company is a tax-free company. They don't have to pay any taxes. Now tell me, I can say PBDT itself is equal to CFAT. Am I correct? PBDT itself is CFAT. The reason is if tax is 0 from PBDT 100, even if you deduct depreciation 20, you get 80. Say PBDT minus the D, you get PBT. Anyway, tax is 0 because it's a tax free company. Then this will now be P8080. Correct? Add back depreciation 20. You will go back to CFAT of same 100 rupee, which was your starting point. That means in question, make a note. If it's a tax-free company, if it's a tax-free company, then PBDT itself is CFAT. PBDT itself is CFAT. You have to read this carefully in the question. So, coming back. Some of the special adjustments, let me discuss one by one. Some special adjustments, PVAF or separate columns, how to decide. Now, all of this is purely from examination point of view. PVAF is present value annuity factors. Now, what is annuity? When you are going to earn same cash flow for a definite period of time. Say, machine has 5 years useful life. CFAT is 35,000 rupee for all 5 years. Then you can use present value annuity factors. Now, some students get confused between annuity and perpetuity. Annuity is when you are earning same amount for limited period. Same amount 5 years, same amount 8 years. You know the number of years. Perpetuity is you are earning same amount but forever. You are going to earn it forever. There is no number of years given in the question. Understand this. This will be required even later in some other topics. I repeat what I said. Annuity is when you are earning same amount for limited period, 3 years, 5 years, 8 years. If I put money in bank FD under simple interest, what I am going to get is same interest for fixed 3 years, 5 years, 8 years. What is perpetuity or when to use perpetuity? When you are going to earn same amount and you will be earning it forever. I don't know how many years. It may be 3, 5, 8, 10. Suppose I have constructed a new house, gave it on rent, 20,000 monthly rent per annum, 2,40,000 rent. And how many years am I going to earn this? I don't know as of now. That means it's a kind of perpetual income. I have purchased a share and they are giving me 3 rupee dividend every year. How many years will I get dividend? I don't know. As long as I'm holding the share, I'm going to get it. This is not annuity. This is perpetuity. Very, very important. Value of anything depends on whether you are going to earn it for limited period or for unlimited period. Limited period is annuity, unlimited period is perpetuity. Yeah? Now, what is this PVAF? Suppose you are earning 35,000 every year. In the table of NPV, the last step, instead of writing year 1, 2, 3, 4, 5, same 35,000 5 times and then multiplying with discounting factor, example 0.909826 and so on, and then multiplying and then adding it. What we can do, anyway 35,000 is same, correct? This can be multiplied by summation of discounting factors. I quickly repeat, many students waits a lot of time in exam because of this. See, you are earning year 1, 2, 3, 4, 5, year 0 outflow, say 100 rupee. Every year you are going to earn 25. This number is same. That means annual CFAT is constant for 5 years. As I told you, 5 years, that means a limited period. Any limited period is annuity problem. Now this should be multiplied with discounting factor. Discounting factor for year 1, year 2, year 3 is what you're going to fill, and then you will multiply 25 into this number, 25 into this number, and so on, and this is negative 100, and finally you do NPV. Instead of this, anyway this number is constant, you are multiplying same number with different factors here. So what we can do, minus 100 is outflow plus 25 rupee you are going to earn for 5 years. You can multiply that with present value annuity factors. Some books use PVIF and PVAF. Many students think this is same. PVIF is index factor. This is nothing but DF. DF is what? This number 0.909826 and so on. PVAF is annuity factor where you are going to do the summation of multiple discounting factors. Some places it is written as PVIF in study material also. Don't get confused. IF is index factor. That is nothing but discounting factor. PVAF is when I do the sum. Okay. And minus 100 is outflow plus 25 into present value annuity factors. So this is minus 100. This is 25 into total all this year 1, 2, 3, 4, 5 this factor, and then you directly get the NPV. In exam, when to use PVAF, by the way, when your annual CF8 is constant. Yeah, you can download this soft copy of this material, and if you want, take the printout, and here you just write it. When to use PVAF? When annual CF80 is constant. When annual CF80 is constant. And when to do separate columns? When annual CF80s are different. Annual CF80s are different. That is, first year 35,000, next year 45,000, next year 57,000. You can't do PVAF. PVAF, the word annuity, I'm repeating again and again because I know this is one confusing area. You have to use PVAF only and only when annual cash flows are same. Next, another important adjustment where many students have doubt is what to do with working capital investment. Most of the questions you might have seen, 10 marks variety question will have a working capital adjustment. Now, working capital money is the amount that you invest at the beginning of the project. Suppose if we want to set up a factory in this room, we have to pay rental deposit to the owner, and that is a current asset, right? Suppose if we close this factory after 5 years, 5 years later, the money will come back to you. Before buying some goods from creditors, yeah. Some creditor may also say you first give 10,000 rupee deposit and then you place the order. Only after that I will start dispatching goods to you. Now these money, these amounts that you have paid in year 0 is working capital. These are not fixed assets. There won't be any depreciation on this. Now what I should do while solving NPV problem, working capital investment, take it as cash outflow in year 0. Please make a note somewhere. In year 0, it should be taken as cash outflow because the advances, the deposits I need to pay in year 0 at the beginning of my project. And you have to take it as cash inflow in year N. I'm writing it as year N, basically saying nth year, the last year of the project. Why is it last year of the project? You first start the project by investing money, and that money will come back to you only once you close that project. It is just like rental deposit. You pay at the beginning, and once you decide to vacate that building, the money will come back to you. Done. One confusion that some students have, I have received some questions also on this. For working capital, we can take as year 0 outflow, but is it compulsory to take it as inflow in last year? In some questions, in the question itself, they mention that working capital requirement at the beginning of the project is 5 years and money will come back. Even if they don't mention, you take it. Some questions they specifically mention, some questions they don't mention. You don't worry, by default make it a practice to take it as inflow in last year. Okay, please make a note somewhere. It should be compulsorily taken as inflow in last year. If I have given rental deposit now and I am using this building, the day I vacate the building, deposit will come back to me. That's a default understanding. In some questions it is mentioned, in some questions it is not, but you keep in mind, you should always take working capital investment year 0 outflow last year, take it as inflow. Next adjustment in NPV, quite common, is additional asset purchase. That is, suppose a project is for 8 years and they say year 0, you have invested 100 rupee and purchased an asset. Then at the beginning of year 3, now this is where many students go wrong. Beginning of year 3, you have to buy one more asset worth 30 rupee. Now when they say beginning of year 3, it should be understood as end of year 2. Very, very important. Beginning of year 3 should not be written in year 3. It should be written in year 2, because whenever I say year 2, it is end of year 2. Remember, this is end of year 2. Now, how to charge depreciation? Year 1 and year 2, you will charge depreciation only on the original equipment of 100 rupee. But because you're buying this additional equipment from the beginning of year 3 itself, you will have to charge depreciation from year 3, 4, 5, 6, 7, and 8. That means when you do depreciation working note, remember, year 1 and 2 will be only on the original equipment. Year 3 onwards, the original equipment plus the depreciation on additional equipment. Now, those who want to make a note, this is what you should write. Depreciation for year 1 and 2 will be original equipment, correct, minus the scrap value by useful life. Depreciation from year 3 up to 8 is depreciation on original equipment plus depreciation on additional equipment. Depreciation on original equipment plus depreciation on additional equipment. Lot of the students do mistake here. They take original equipment year 1 and 2. From year 3, they will take only the additional equipment depreciation. The first asset is still with you. Remember, first asset is used for 8 years. The second asset, you bought it at the beginning of year 3, that will be used only for 6 years. So take depreciation year 1 and 2 separately, year 3, 4, 5, 6, 7, 8 separately. Next, another area, many students miss this. If scrap value is given in the question, should be taken as cash inflow in the last year, 10th year I am writing. I know it's a very silly point, but then many students miss this because it's a big sum. They do PBDT, depreciation working note, CFAT, then NPV. By the time they come to NPV table, year 0, 1, 2, 3, they copy everything. Last year, that one addition, which is scrap value, they miss out. And because of that, your positive NPV may become negative NPV also, because scrap value won't be 100, 200 rupee. If the asset value is 1 lakh, scrap value will be easily 15, 20,000. And if you miss that, your answer will be wrong. Always and always take scrap value. What if scrap value is not given in the question? Then take it as nil. If nothing is given, take it as 0. Scrap value is not given, take it as 0. Next. Another common adjustment. What if we get negative PBT? Negative PBT means loss before taxes. Now, 2, 3 possibilities. Let me first explain to you. Later, you can make a note the way you want. Suppose PBT is positive. We know we have to pay taxes. If PBT is negative, then number one, the year in which you have negative PBT, there is no tax. Am I correct? After that, what to do? Income Tax Act says you can carry forward the loss up to 8 years. But please check in the question. In some questions, case A possibility, they say loss cannot be carried forward at all. If they say cannot be carried forward at all, then the year in which you have loss, don't pay taxes. That's all. You don't have to do anything in the next year or next to next year. Forget what Income Tax Act says, because in the question they have said that loss cannot be carried forward. Second possibility in exam, they can say loss can be carried forward, but only up to 2 years. That means in year 1, if I have loss, I can use it for year 2 or year 3. Even then, I have not used my loss of first year. I can't use it in year 4 or 5. Read the question carefully. Sometimes they mention that it can be carried over only for 2 years. Third possibility, nothing is mentioned in the question. Tell me, if nothing is mentioned in the question, you can follow the Income Tax Act, which says you can carry forward for 8 years. So, year 1 you have lost, use it for year 2, year 3, year 4, you can use it up to 8 years. So, I quickly repeat three possibilities. Before that, if PBT is positive, you have to pay tax, no question in that. If PBT is negative, one thing I know, there is no tax in that year. But is there anything that I have to do in year 2, 3, 4? That depends on the question. Case A, they say clearly that losses cannot be carried forward. Then year 1, suppose year 1 is loss, year 1 loss, don't pay taxes, over, full stop. Suppose second possibility, they say it can be carried forward for 2 years. Then year 1 loss, use it for year 2, year 3, that's it. You can't use it to set off against the profit of year 4 onwards. Third possibility, they don't mention anything in the question, then you follow the Income Tax Act, which allows you to carry forward for 8 years. Now, the way you want it, you can copy. Yeah, I quickly repeat those who want to copy. If PBT is negative, that year there is no tax. Simple to understand. If PBT is negative, that year there is no tax. Next year depends on three possibilities. Next year depends on three possibilities. You can draw three arrow marks. Case A, carry forward not allowed, carry forward not allowed. Then what to do? Nothing to be done in year 2 and 3. Make a note. Nothing to be done in year 2 and 3. Second arrow mark. Carry forward allowed for 2 years. Carry forward allowed for 2 years. Then loss of year 1. Loss of year 1 can be used in year 2 and year 3 only. Third arrow mark, case C. Nothing is mentioned in the question. Nothing is mentioned in the question. Then follow Income Tax Act. That is, carry forward for 8 years. Carry forward for 8 years. Basically, you have to read the question, one of the three possibilities. Next, any question where they're referring to replacing the machine. There are a couple of questions in study material also on this replacement decision. We have to use incremental approach. What is this? Let me first explain to you. You already have a machine. Let's mark it as existing machine. You already have, I'm sorry, yes. You already have one machine. Let's call it existing machine versus you are planning to buy a new machine. So most of the questions are like this in replacement decision. What you have to do? It is not like other NPV problems where you are thinking whether to buy machine A or machine B. You already have one machine, you are thinking to replace that machine. Now the thing to be worked out is CF80 if existing machine is continued and CF80 if new machine is purchased. Suppose this is 1 lakh rupee and this is 3 lakh rupee. This is annual CF80. Therefore, every year you are going to earn 3 lakh rupee, sorry, 3 lakh minus 1 lakh, 2 lakh rupee extra. And this 2 lakh is called as incremental CF80. Very, very important. If I continue with existing machine, I will earn 1 lakh rupee annual. If I shift to new machine, I'll be earning 3 lakh rupee every year. So I will be earning 2 lakh rupee extra per annum. And how many years is this for? Suppose in question they say 5 years. That means I'm going to earn same 2 lakh rupee for 5 years. So this will be 2 lakh into, as I told you, summation of discounting factor PVAF at 5 years 10%. Now this will be the cash inflow part. Now what about cash outflow? Understand, you already have one machine. Some students by mistake take this as cash outflow. You already have one machine. This is an existing machine. Suppose you have paid 3 lakh rupee to purchase this and you bought it 5 years ago. That number is irrelevant. Many students do this mistake. Today you want to buy a new machine that will cost you 10 lakh, and this old machine which you bought for 3 lakh rupee many years ago can be sold today for 20,000 as scrap. That means 10 lakh minus 20,000, 9 lakh 80,000 is your cash outflow in year 0. Now if I summarize, what does this mean? You pay 9 lakh 80,000 from pocket today and shift from old machine to new machine, you will be earning 2 lakh rupee every year for next 5 years. Therefore, NPV of, some students by mistake they write here NPV of new machine. It's not NPV of new machine. You should write it as NPV of replacement decision, because you are not thinking about choosing which is better machine. You're thinking of leaving the old and buying the new. So NPV of replacement decision will be year 0, in my example 9 lakh 80,000, correct? New machine cost 10 lakh, old machine scrap value 20,000. You will be paying from your pocket 9 lakh 80,000 rupee. And year 1 to year 5, year 1 to year 5, you will be earning 2 lakh rupee per annum extra. You're paying 9 lakh 80,000 extra, you're going to get 2 lakh rupee extra. And this is for how many years? 5 years. Therefore, PVAF at 5 years, 10% rate. You put this number, and then this number is NPV of replacement decision. If this number is positive, then replacement is a good decision. If not, it's a bad decision. Therefore, if you want to understand this as step 1, 2, 3, first work out depreciation of existing machine and depreciation of new machine. Then work out CF80 of existing versus CF80 of new. Then the difference between those two CF80s is called incremental CF80. That is the extra amount that you will be earning every year for next n number of years. To earn that, what you should do today, you have to sell the existing machine and purchase the new machine. If you sell the existing machine, in this case you're going to earn 20,000 rupee, and to buy new machine you have to pay 10 lakh rupees. So net outflow in year 0, 9 lakh 80,000. And in my example, you'll be earning 2 lakh rupee extra every year for next 5 years. Suppose they give scrap value of the new machine, that also you add here year 5. Suppose the scrap value of new machine is 10,000. This you multiply with discounting factor at 10%. Fifth year only, don't do summation here. Some students do this mistake also. Depreciation is deducted over 5 years. Scrap value is not for 5 years. Scrap value is only at the end of 5th year. Some students add this 10,000 also to 2 lakh and they take 2 lakh 10,000 into PVAF. If you are doing that, what are you indirectly saying? Every year I will earn scrap value. How is that possible? Scrap value is earned only once, that is at the end of the useful life of the asset. Next. In some questions, they will not give you cash inflow versus cash outflow. It will be some savings. And I've given a simple note to remember this. If there is a saving, consider that itself as your cash inflow. And remember the simple thumb rule, money saved is money earned. If you're saving some, understand that is as good as earning that money. There are problems in study material also where you are going to save something if you purchase machine A, if you save something else if you purchase machine B. So the saving amount should be taken as inflow. If I say 10, 25,000 rupee will be saved if I purchase machine A, take that saving as inflow. Some questions you will not have. Normally what we do, inflow versus outflow. Sometimes you will not have inflow versus outflow. You may have saving versus outflow. Money saved should be understood as money earned and take that itself as inflow. On each variety, you have different problems. Negative NPV, additional asset purchased, working capital adjustment, or sometimes in one big question, they can add all of this. Working capital also. Okay. By the way, one more thing I missed out. Sometimes they give you subsidy received on purchase of an asset. Just make a note. If there is subsidy received on purchase of an asset, this should be deducted from the original cost. Deduct from original cost of the asset. Please make a note. If a subsidy is given in the question, deduct it from original cost of the asset. Very important. Example, 25 lakh asset, 3 lakh subsidy. You have to start working out from 25 minus 3, that is 22 lakh. That becomes the original cost of the asset now. Done. Next. NPV is the fundamental method. If you are able to solve NPV problems, you will be able to solve the other problems, other method problems as well. The second method is profitability index, PI method. See this. PI is equal to discounted cash inflow divided by cash outflow. All inflows will go to the numerator, all outflows will come to the denominator. Simple. Rule for decision: PI greater than 1, PI less than 1, and PI equal to 1. What is the meaning of PI greater than 1? Cash inflows are more than cash outflows. That means this is a NPV positive project. Remember, if cash inflow is less and outflow is more, that means you're losing money here. This is NPV negative project. What if PI is equal to 1, cash inflow is equal to cash outflow? That means NPV is 0. That means there is a similarity between these two methods. But is there a conflict? Definitely yes. I'll give you one small example and then you'll understand this. Listen, suppose there are two projects, A and B. In A, cash outflow is 100, cash inflow is say 100 negative, 109 here. So you will call this 9 as positive NPV. Suppose there is another project called B where the outflow is 1000 and you're going to earn 1010. NPV is positive 10. Now, if you simply focus on NPV, this is a higher NPV project, we will be choosing this. But there is a small problem. Here you are earning 9 rupee extra on investment of just 100 rupee, whereas here you are earning 10 rupee extra on investment of 1000 rupee. Therefore, NPV may not give the correct conclusion all the time. Here is a best example in front of you. If I go by NPV, I should select project B because B has higher positive NPV. But in reality, you observe here, I am putting 100 rupee and getting 109. But here I put 1000 rupee and I get 1010 only 10 rupee extra by investing 1000 rupee. Therefore, we have to use the second method and that method is called PI. In PI, what do I do? 109 inflow divided by 100 outflow. This will be 1.09 and here not 1.0, 1.09, but here it is 1010 divided by 1000 and this will be 1. I think 001 or 01. That's a very small number compared to the other number. Correct? Therefore, PI always gives you, remember this, Relative return, very important, make a note. PI always gives you relative return, whereas NPV gives you absolute return. Absolute return is A minus B. Relative return is A divided by B. Relative return, when I say it's in proportion. Absolute return is simply A minus B, higher NPV. But so in this case, project B has to be selected because NPV is higher. But PI method says you should select A. Just now I discussed the example. NPV considers only the return, where this considers both risk and return, that is proportionate return. Hence, PI method is more sensible than NPV method. The other one is payback period method. I've given a small table to summarize how it should be worked out. This will basically tell you how many years you need to get back your original investment. That is, if I put 100 rupee today, when will I get it back? 2 years, 3 years, 5 years. That is payback period. There are two types, simple and discounted payback. Let me clarify one question. I've received this from many students on Telegram. Sir, in some questions, they simply say calculate payback period. Now, which one to do? Simple or discounted? In exam, to be on a safer side, do both and come. Because if I say simple in one question, they have done discounted. If I say do discounting, in some question, they have done only simple payback period. If they clearly mention simple, you do simple. Clearly mention discounted, you do that. If question says in exam, suppose calculate payback period without mentioning which payback period, you better do both and come on a safer side. Yeah, please make a note somewhere. If question says calculate payback period, if question says calculate payback period, then better to work out both in exam. Better to work out both in exam. This is a safer option. And in payback period, how will I choose which project is better? The shorter the payback period, that is better compared to another which is longer. Shorter payback period means what? You will get back your money early, you will get back your money quickly. And that is always better than waiting for longer duration. I've given a small format. You can revise this one day before exam. Year 0, 1, 2, 3, 4, 5. Cash flows are given. Discounting factor, discounted cash flow. What extra you have to do is cumulative discounted cash flow. Now, what is this cumulative discounting cash flow? Suppose year 1, 2, 3, 4. Just an example. You are earning 30 rupee, 40 rupee, 50 rupee, and 60 rupee. Year 1, 2, 3, 4. Now, this is cash flow. This is year. Then you do discounting factor at example 10%. Then you do DCF. Suppose that comes to 27, 35, 41, and 45, just for example purpose. Now I am doing cumulative discounted cash flow. That means first year at the end of year 1, I would have earned 27 rupee. Now end of year 2 will be 27 plus 35, 62 rupee. Is that correct? 62. And end of year 3, it will be 62 plus 41, which is 103. End of year 4, it will be 148. And here, suppose your outflow in year 0 is 100 rupee. That means understand, somewhere after second year, before third year, you are going to get back your original investment. Now simple cross multiplication to be done. How to do discounted payback period? In this case, you have to wait for a minimum 2 years, because by then you would have earned 62 rupee. If you run the project for one full year, that is third year, you will earn 41 rupee. You will earn 41 rupee. But you don't need 41 rupee. How much you need? From 62, You have to reach 100 because that was your outflow. That means you need another 38 rupee only. You cross multiply. When you do it, suppose you get zero point 0.9. That means 2 years plus zero point 0.9 years. This will be 2.9 years payback period. And what does it mean? If you start a project today and you run it for 2.9 years, you will get back your original investment. Another project, suppose that is 4.5 years, that means there you have to wait longer to get back your money. Shorter payback period projects are always better. Next, IRR method, a method where you have to do trial and error. Now, in simple, IRR is the rate at which present value of inflow is equal to present value of cash outflow. That is worked out using trial and error approach. I have given an example to you. Year 0, 1, 2, 3, 4, 5. Cash flows, this will be given in the question. Always and always, this is one more doubt for many students. Always in exam, check whether they have given the discounting rates for trial error. This is one place you remember, even in class, we took maximum time to solve these questions. Some students take 10%, 20%, some students take 10 and 30, some take 10 and 40. Therefore, the best thing is check in the question. Sometimes they would have given the rates already in the question. 10, 15, 25, 35. If they give, then take 10, take 35. Take smallest and biggest number given in the question. What if they don't mention anything in the question? Then make a note somewhere. Always start with 10%. If nothing is mentioned in the question for discounting rate, always start with 10%. And then you discount it. Suppose NPV is a big number. I am writing positive big. Okay. Suppose this number is a big number, then let your next trial be not 15 or 20. Directly you can do 30%, you can do 40%. But one message of caution, this I told you even in the regular class. Don't do trials like 10 and 60, 10 and 70. The gap between two trials should not be too much. So after 10, better you try 30. After that, if you're still getting positive NPV even at 30%, next trial can be 50 or 60, because from there it is 30 to 50, not 10 to 50. But don't do 10 as first and 50 as next, or 10 and 60. That's not correct. So if you're trying 10, better you next try 30. You need one positive, one negative. Then you can do cross multiplication and get the answer. What if I get both positive? Then I'll have to do one more trial. That time you have done 10 also, you have done 30 also. Now you can do 50 or 60, no problem, because cross multiplication will happen between 30 and 60, not 10 and 60. So I know what happens. We lose patience. 10% we do, don't want to do 20. You don't want to do 20, no problem. Do 30. Don't directly jump from 10 to 60. Okay. Ultimately, what do you need? At the end, you want the answer NPV to be positive. We may not get positive number. We may get one positive, one negative. If you get one positive, one negative, now you know the final answer is somewhere between that positive and negative number. Multiple IRR. This is possible when initially you have a cash outflow, and then you have inflows, and suddenly you have one more outflow, again you have some inflows. Then single problem, you will have two internal rate of returns. That's why we call it as multiple IRR. I repeat what I said. This is important even from theory perspective. Somewhere make a note. Multiple and modified IRR. Make a note somewhere. Can be good theory questions also. Now, when will this multiple IRR come into picture? When this explanation is there in the PDF. Don't worry. When initially you have a cash outflow, and then you have series of inflows, and suddenly you have one more cash outflow, then again some inflows, one more outflow, again some more inflows, then you will have more than one internal rate of returns, and that's why we call it as multiple internal rate of returns. Now, how to avoid this? The solution to that is modified internal rate of return. In modified internal rate of return, This theory is little complicated. Many students find it very difficult. So let me explain this to you. Read. This method is also called as terminal value method. Under this method, now this part is very important, very confusing to many students. Pay attention. All cash flow apart from initial investment. That means don't touch year 0, everything other than year 0. That means 1, 2, 3, 4. And they said all cash flow. They did not say only inflow, both inflow and outflow, but other than year 0 are brought to the terminal value. Terminal means what? End. Terminal means last. So terminal value means to the last year of the project. If it is 7 years, then take every number other than year 0 to 7th year using an appropriate discount rate. This will result in single stream of inflow in the terminal year. What is this? Listen to me. I've given one example to you to understand this. 1,36,000 rupee is an investment in year 0. And this is going to give you CFAT of year 1, 2, 3, 4, 5 numbers are given. But again you observe here, year 0 you have outflow and then 2 inflows, again 1 outflow, again 2 inflows. Now this will give you multiple IRR. To solve that problem, what to do? Other than year 0, I read just now, except initial cash flow, all other numbers should be brought to their terminal value. In this case, terminal value means year 5. Now how to bring this to year 5? Think about it. You are earning something at the end of year 4, sorry, year 1, 30,000 rupee at the end of year 1. From year 1, you have to go to year 5. That means 1 plus, suppose rate of interest is, they have given 8%, 0.08 to the power only 4 I have to do because you are earning it at the end of year 1 and you want to convert that to year 5. So from year 1 end, if you invest, you will earn interest for year 2, 3, 4, 5. Only 4 years you get the number. This 40,000, 1 plus 0.08 to the power 3 because you are earning it at the end of year 2. If you invest that, you will earn money for 3rd, 4th and 5th year. Even this number, though negative, take it this way, minus 40, 1 plus 0.08 to the power 2, same way to the power 1, to the power 0 and add all of this. By doing this, what happened now? You shifted all year 1, 2, 3, 4, 5 numbers to year 5. This is the meaning of that para. Read here. Under this method, all cash flow apart from initial investment, I did not touch that 136,000. Apart from initial investment are brought to the terminal value, that is the last value, and that's what I did. This will result in a single stream of cash inflow in nth year. Now what happened? Outflow is happening in year 0. That number is here 1,36,000. Year 0 cash outflow, and year 5 you have cash inflow. You shifted all the year 1, 2, 3, 4, 5 numbers to year 5. Now you have year 0 outflow 1,36,000. Year 5 inflow. Suppose that year 5 number cash inflow is 1,87,000. Now cash outflow in year 0 is 136 as per that example, and year 5 cash inflow is 187,000. Now you can use the compound interest formula. Future value is equal to present value 1 plus at what rate we don't know to the power 5 because in this question it was 5 years. Now you can do trial and error. You can take 10% and see, not happening 20% and see. Finally, all that you need to reach now is 187,000. Yeah, and that is what they have given here. Look at this. The MIRR is obtained by assuming single outflow in year 0. I told you 136,000 and terminal cash inflow as mentioned above, which was in my example here 187,000. So in simple, what I did, year 0 number I kept as it is. Year 1, 2, 3, 4, 5, I shifted everything to year 5. Now finally outflow is in year 0, inflow is in year 5. Now it is more like a compound interest formula. Future value I know, present value I know, rate of interest I need to find out. N is 5 years. Here it says the discount rate which equates the present value of inflow to 0th year outflow is called MIRR. That is this. The 5th year value should be equal to today's outflow into 1 plus at what rate? I have to do it by trial and error. Next. accounting rate of return. Somewhere make a note. This you can read after you complete everything else one day before exam. Let this not be your priority, because in this method we don't consider any discounting rate. We go by profits as per P&L, net profit, and we don't consider the fact that value of money 1 year later will be less than value of money today. That means this whole chapter very purpose is defeated. Purpose of learning this topic is to know that future value is less powerful than today's value, the present value. Here, read accounting rate of return is based on book value of cash flow. Here you will take the book value that is coming from P&L and balance sheet. Here discounting factors are ignored. That means for you 1 rupee today, 1 rupee after 5 years is all same. And decision is merely based on accounting profit and not cash flow. This is profit after tax by initial investment into 100. Sometimes you can even do average PAT by average investment. Now when to do this average? If you have more than 1 year in the question. If you have 3 years data, find out PAT year 1, year 2, year 3, take the average, that becomes the numerator. Divided by, here you can see two possible denominators. They have given here. The denominator can be either initial investment or average investment. Now how to do? Initial investment is year 0 outflow, that we anyway know. What is this average investment? Take the investment at the beginning of the project, year 0. Take the investment at the end of the project, year 5. This plus that divided by 2. If you want to do average investment every year, that year beginning value, that year end value, that becomes next year beginning, next year end, take the midpoint. Suppose year 0, 100 rupee. 100 rupee you invested, 20 rupee depreciation, end of the year 80. Next year opening balance becomes 80, closing 60, assume 20 rupee depreciation. This will be 60, this will be 40 and so on. Now if you want to do by initial investment, 100 is the number. If you want to do by average, then 100 plus 80 divided by 2. So 90 is the average investment. Here 80 plus 60, average is 70, and here 50 and so on. So if you want to use average, you need opening balance, closing balance divided by 2. If you want to use initial, then you have the year 0 value anyway. Right? Very simple one. And I don't want you to spend too much time on that concept. Okay. The next concept, market important, is project with unequal lives. So what is this project with unequal lives? I've asked question on this. Suppose there are two projects. One is 6 years and another is 3 years. 6-year project, year 0 outflow given, year 1, 2, 3, 4, 5, 6 inflows are given. Project B, only 3 years, year 0 outflow, and then year 1, 2, 3 inflow. Nil, nil, nil. That means project got over at the end of year 3. If you work out, say discount rate 12%, if you work out NPV of this project, NPV will be 649,094 and NPV of second project is 515,488. Now, I cannot and should not compare 649 with 515. Don't worry, you don't have to work out. I've already worked that out. If you compare 649,094 with 515,488 and say, look, 649 is a higher NPV, I will select that. The mistake that you are doing is this 649,094 is NPV in 6 years, whereas this 515,488 you will earn this much NPV in just 3 years. So what is the better thing to do now? Don't take this versus this. This is earned for 6 years. Divide that by summation of discounting factor for 6 years. This is earned for 3 years. Divide that by summation of discounting factor for 3 years. Now what you know is equivalent annualized number. Why am I calling it as equivalent number? One is for 6 year, another is for 3 years. When you divide that by 6 year, 3 year summation, you are bringing them on par. Otherwise, you'll never be able to compare. One is 4 year, another is 7 year, one is 9 year. then those three NPVs can't be compared as it is. You bring all of them to one common category, and that common category can be per annum. That's why they use the word equivalent annualized criteria. Here, NPV is the criteria. So, whichever is higher, 214 is higher, I will select that. In some questions, we did one question like this in the class. In some questions, they will give you only cost. Listen to me. Very, very important. They've asked this question 2, 3 times. Suppose there is machine A, there is machine B. Purchase cost of the machine. This is 1 lakh rupee. This is 1,50,000 rupee. And this is annual cost 60,000. Here 50,000. Useful life of the machine is 3 years. This is 4 years. Now the question is, which machine is cheapest? Now what we should not do is, sir, 1 lakh today plus 60, 60, 63 times 1 lakh 80. 1 lakh today plus 1 lakh 80 total number versus 150 today plus 50, 50, 54 times, that is 2 lakh. This comparison is wrong because this is for 3 years and this is for 4 years. So what to do? First, to find out total cash outflow. How to do it? 1 lakh rupee cash outflow year 0 plus you will be spending 60,000 rupee every year for 3 years. So multiply this with PVAF for 3 years. And this number you get will be the total cash outflow if you buy machine A. Same way, machine B, 1,50,000 plus 50,000 into PVAF at 10%, 4 years. Now you have two numbers. Now also you can't compare this with this because this total is for 3 years, whereas the other total is for 4 years. Therefore, you divide this by PVAF at 4 years. Sorry, this was 3 PVAF for 3 years, and this you divide by PVAF for 4 years. Now with this, what happened finally? Both are comparable. This versus this is the right comparison now. Whichever is lower, you will choose because here it is only and only cost. Okay, make a note somewhere. This kind of sum, one question you should solve before exam. Somewhere make a note. Project with different life. Project with different life. That is that is only cost criteria. Only cost criteria work out at least one sum. Work out at least one sum. For example, cover this during the revision. Yes. Last concept in this chapter is capital rationing. When will you do capital rationing? When you have multiple projects, all of those projects can be good, all of them may have positive NPV, PI greater than 1, but you may not have money to do all the projects. In that, there are two types of projects: divisible and indivisible project. What is divisible project? If you don't have money to do full project, you can do part of the project also. If you don't have money to do full project, you can do part of the project also. All such questions simply go by ranking. Right, like this, simply go by ranking. What ranking? You will have to calculate NPV for rupee 1 or you have to calculate PI. Now, whether to use NPV or PI, I will explain now. But remember one thing, you have to first prepare a small table, project, cash outflow, cash inflow, calculate NPV, and then calculate NPV for rupee 1 or PI, and then give a ranking. If projects are divisible in nature, then go in the order of ranking. First rank you do full, next you do full. Next also, if you have money, do full. If you don't have money, anyway, question says divisible project. That means part project also you can do, no problem. The second possibility is indivisible project. What do I mean by indivisible project? You want to do it full, otherwise you cannot. This kind of questions you have to work out by trial and error. Trial and error. Why trial and error? You may first want to do rank 1, 2, and 3. You will still have some unused money, but you can't do rank 4 because question says you can't divide the project and do either do full or leave it. So now rank 1, 2, you may want to do rank 4, or you may leave rank 1 itself. Rank 2, 3, 4, and 5 also may be requiring less money. But remember, when you do trial and error, always include rank 1 project in all your trials. Because why it is rank 1? It is earning maximum money. Correct? It won't happen that there is rank 1, 2, 3, 4, 5, and you got the best answer with rank 3, 4, and 5. Then what is the use of ranking it as 1 and 2? Right? So when you do trial and error, always and always include rank 1 project. Last one, when to use NPV and when to use PI. Understand, when there is no shortage of money. What is the meaning of no shortage of money? Any investment I'm ready to make. That means now I have only one criteria. Am I going to get positive NPV? I repeat, if I do not have shortage of money, then I'll be ready to do any investment as long as I'm going to get positive returns. That means you can use NPV method. But available money is restricted. There is a shortage of money, then always use PI, sorry, or I would say NPV for rupee 1, which is one and the same. NPV for rupee 1 and PI will give you same conclusion. Now, why am I using PI? Because I don't have unlimited funds. So you can't say, sir, let's do every project anyway you have money. I don't have money to do every single project. I have limited money, and that limited money I should put it in those places where my returns are going to be maximum. Right? So read in the question. In fact, in class we have done 3 problems on this. Okay, check today. Where there was shortage of money, available funds are only 1 lakh, available funds are only 3 lakh. We have done it on PI or NPV for rupee 1. There was one more sum. We did Elite Cooker Company sum where there was no shortage of money. In that case, we worked out all the NPV. Wherever we had maximum NPV, we have selected that as the best mix or that project as the best project. Therefore, check in the question whether we have restriction or no restriction. Okay. So this is about the chapter of capital budgeting or investment decision. Make a note somewhere. One question always comes from this. Most likely a 10 marks question from this topic is expected. And practical segment is more important than theory in this chapter. Somewhere make a note. There are other topics where theory is equally important. I'll tell you later. Practical questions are more important than theory in this chapter. Okay. With that, we are done with chapter 1. By the way, this chapter 1, 2, 3, 4 that I've listed here is a general order, not most important, least important, etc. And I've not taken up any theoretical chapters. I've covered mainly the practical areas. Therefore, don't check this chapter number with the study material or my class material. Okay. So we will now move on to chapter number. Yes, let us begin. Chapter number 2, risk analysis and capital budgeting. This is very small topic, very easy topic. Make a note somewhere. Please don't go to exam hall without revising this. Okay. Not about important or not important. From exam point of view, it is a easy topic, convenient one, small one. You can do revision very quickly. Let us start now. Techniques of risk analysis in capital budgeting. First one is probability analysis method. In probability, you are trying to analyze the chances that an event is going to occur or not. When an event is certain to occur, then the probability will be 1. So if you see probability as 1, that means it is sure going to happen. If there is no chance of happening, then the probability will be 0. That means most of the probabilities will be in this range of 0 to 1. If I say probability is 0.8, that means there is 80% chance of happening, 20% chance of not happening, and so on. Once we adjust probability, cash flows will be considered as expected cash flow, then NPV will be called as expected NPV or probable NPV. I have taken an example, even the solution is printed. You just have to follow this. Example, project P and Q. Initial investment is 10,000 rupee. Following is the expected cash flow year 1 along with the probabilities. That means project is for only 1 year. Discount rate is 10%. Which project to be taken? P and Q I have given both in the question. Possible event A, B, C, D, E. What does it mean? At the end of year 1, we are not sure which is going to be the reality. It may be case A, case B, case C, one of the 5 cases. If possible event A becomes a reality, then I will earn 8,000 rupee. If B becomes a reality, 10,000 rupee, and so on. And what is the probability of I earning 8,000? Only 0.1. 0.1 means 10%. Probability of earning 10,000 is 20%, and so on. Same way they've given even for project Q. If you understand one project, you can do it for the other one. Now how to do NPV here? Year 0, 10,000, probability is 1. So this is minus 10,000. Now discounting factor will be 1 because year 0, 1 rupee is equal to 1 rupee. Therefore, discounted cash outflow will be 10,000. Why did I write probability as 1 for this? This money is going out right now. When money is going out right away, right now, there is no doubt. Therefore, it is certain to happen. But at the end of year 1, A, B, C, D, E, one of the 5 can happen. So, copy all the cash flows from the question, copy the probabilities, multiply that 8,000 into zero point 0.1, 10,000 into zero point 0.2, and so on. Sum of all of that, this is called expected cash flow. Some books write this as X bar. What is X bar? Probability of first event P1, X bar here, P1, X1. Second probability, second cash flow. Third probability, third cash flow, and so on. If you don't want to write it in table, you can do it this way also, P1 X1 plus P2 X2 up to n number of years, and here 5 probabilities, so 5 probabilities for 1 year. What if they give you one more year, year 2? Again there they will give you A, B, C, D, E, 5 more probabilities, and so on. And then 10,000 is outflow, 12,000 is at the end of year 1. End of year 1, therefore multiply with discounting factor. This comes to 10909. Now the NPV is 909. And you see here, this NPV is written as expected NPV or probable NPV. This is not the actual NPV because we have got this number after adjusting the probabilities. What if they give you more than 1 year? If they give you more than 1 year, first year 0 outflow, there is no confusion. Year 1, there can be 4 possibilities. Year 2, there can be again 4 possibilities. Correct? Year 3, again 4 possibilities. Do the same thing. Find out the expected cash flow. Multiply with discounting factor for year 1. Same way for year 2. Same way for year 3. And then finally NPV. So this can be for 1 year or can be multiple years. If they give multiple years, you have to just extend this table year 2 also, year 3 also, and so on. And I have done for one project. Same way you can try for second project. Now whichever project gives you higher probable NPV or expected NPV, that has to be selected. Next, variance or standard deviation. Now variance or standard deviation basically tells you how far is the individual number. Individual number means individual x1, x2, x3. How far are these individual numbers from the most expected number? Now what is the most expected number? The x bar. Therefore, understand this. There can be two variety of projects. If you understand the logic, you will understand the formula. Suppose one project has cash flow which can be up or down like this, say year 1, year 2, year 3, 4 and 5. There is up and down movement, but it is well within a range. Another project, same way, 5 years, but the cash flow expected are something like this. Now, this project, though there is an upward and downward movement, it is well within a range. But here, the movement is too much that it tells you investing in second project is very risky, high risky compared to investing in first project. Say this is project A, this is project B. As a businessman, I am okay to accept a little up and down in my business, in my cash flows, but I may not want project B variety because it always gives me trouble. I don't know whether I'll be earning positive 10,000 or just positive 150. Again, next year, positive 11,000. Again, next year, 175. I don't want this. I'll be more happy if I'm earning 560, 580, 590, 600, 650. As long as it is well within a range that is considered to be much safer when compared to the other one. Now, how to measure whether it is high risky or whether it is highly safe or not? For that, you use standard deviation. Basically, standard deviation is the square root of variance. Higher the standard deviation, higher the fluctuation. Lower the standard deviation, lower the fluctuation. This is the meaning of ISD. This is the meaning of lowest. That means which project is better? Definitely the one having low standard deviation. How to calculate standard deviation? Okay, before that, see this. A large variance indicates that there will be large variability between cash flow. Small variance indicate that the cash flows are somewhat stable throughout the life. I've used the word somewhat stable. I did not say same. Observe here. Neither project A nor project B is going to give you same earnings every year. There will be some up and down because you're not investing in risk-free deposits. You are taking some risk. Up and down is quite common. But if you have too much of up and down, then you have too much of risk as well. Now, to measure that risk, we have the formula, that is square root of variance is called standard deviation. How to reach variance, I will explain. For capital budgeting decision, standard deviation is used to calculate the risk associated with estimated cash flow from the project. Now, listen to me. There is a question, project A, project B. Observe. Possible events, any of the five may happen. Cash flows are given to you. Probabilities are given to you. Project B, same way. Cash flows and probability. 8 marks. I've asked you a question. You need to calculate variance and standard deviation. How to calculate variance here? What is the meaning of variance? First, understand that logically. How far are the individual numbers from the most expected number? That means first you have to find out the most expected number, which is x bar. And how to do x bar we discussed 10 minutes ago. P1 x1, P2 x2 and so on. Therefore, any project, this is the table. I'll give you time to copy the table. In the study material, they have not done it in table format. They do it this way. 80,000 minus 1,20,000 square into probability and so on. Table is a much easier one. I'll first write it and then I'll give you time to write it. Listen to me. They have given possible events A, B, C, D, E. Possible events A, B, C, D, E. They have then given cash flow. In exam, mark this cash flow as X. And then they have given probability. This is P. Okay. And then you have 8,000. I'm just taking the, okay, I'll take the exact numbers. 80,000. I'll just write it as 80, 100, 120, 140, 160. And probability is 0.1, 0.1, 0.2, 0.4, 0.2 and 0.1. Now you have X with you, you have P with you. So the next thing to be done is, here I told you X1 P1 plus X2 P2 and so on. What you get is X bar. X bar is the most expected cash flow. Suppose that comes to 120. I'm just taking an example. Now the next thing to be done is X minus X bar. That is individual number you see how far is that number from the most expected number. That is 80 minus 120. This will be negative 40. This will be negative 20. This is 0. This is positive 20. And this is positive 40. This is x minus x bar. And then we square this. Why do we square this? Because there is a positive number, there is a negative number. If you simply total this, minus 40, minus 20, 0, plus 20, this total comes to 0. What is the meaning of 0 total in this column? There was no variation at all. But if you see, there was variation. Once it was as low as 80, later it was as high as 140, 160 also. So we cannot say there was no variation at all. There was variation. Upward is also variation, downward is also variation. Now to find that out, we then have to square it. So what happens now? Negative number 40 minus 40 into minus 40, when you do, becomes what? 1600 positive. All the numbers will become positive numbers. This you multiply with p. This is p into x minus x bar. And this total is called variance. Only one thing you have to do, standard deviation is square root of variance. This table is better than the way in which they have done in the study material. The same thing. What they did, first they took the cash flows, multiplied by p, and then they added, then they said x bar, expected net cash flow. And that number they have used here, x1 minus x bar, the square, and then multiplied by p. That's what we have done in the table. First find out x bar separately, then x minus x bar, that is 80 minus this, 100 minus this, 120 minus this, and so on. Square it and then multiply that with probability. Okay, you don't have to copy the number, just copy the column heading for your reference. I'll wait for 2 minutes. Copy the overall format. Possible event, cash flow, which you write as x, probability write as p, x minus x bar, p into x minus x bar, p into x minus x bar square, finally the total. The total of this gives you variance. Total of this is variance. Square root of variance is standard deviation. That is here. Standard deviation is equal to square root of variance. Done. Now, a high standard deviation means high risky. Just make a note this as well. Low standard deviation means low risky. Therefore, we always select the project having low standard deviation. Always select the project having low standard deviation. Select the project having low standard deviation. Simply means you are taking less risk by investing there. Done. Same way, they have done it even for project Q, sorry, project B, A or B, P or Q, that's okay. And then here, standard deviation was 21,000. Here it is 41,000. Again, this has a lower standard deviation, so we should select that. And this is a high standard deviation, better to reject that. Now, we should not take the final decision about a project only based on standard deviation, because standard deviation simply measures risk, high risk, low risk. People may take high risky investment if there is high return expectation also. Therefore, it is not correct to say that low SD is the best project. Low SD is low risky project. High SD is high risky project. Therefore, to say which is the best project, I have to see whether that high risk is compensated with high return or not. And that is calculated in CV method, which is coefficient of variation. If you see the formula, you don't have to do anything new. Coefficient of variation is standard deviation, just now you calculated in the previous sum, divided by expected cash flow, which is nothing but x bar. That means if the standard deviation is example 100 and x bar is 20, now x bar is the cash flow and this is a measurement of risk. To earn 1 rupee of cash flow, understand my sentence, to earn 1 rupee of cash flow, how much is the level of risk that I am taking? If coefficient of variation in this question comes to 5, another project coefficient of variation comes to 2, another project has only 1.2, that means understand, to earn 1 rupee cash flow, I am taking this much of risk in all the projects. Again, I will choose the one having lower CV. That means here I am not deciding everything only based on standard deviation. I am taking standard deviation divided by, I am also seeing how much am I earning. So basically, when I do standard deviation by x bar, what am I trying to calculate? How much is the risk that I am taking divided by for each rupee of earning. So this can be 100 standard deviation, x bar 20, then 100 by 20 to earn 1 rupee of cash flow. The risk involved is 5 times, 2 times, 1.2 times. I will definitely choose the one having low CV. And remember, in examination, they can club all of this: standard deviation, before that variance, standard deviation, coefficient of variance. Please make a note somewhere. Combining all of this, solve at least one problem. Make a note. Combining all of this, variance, standard deviation, and coefficient of variance, you should solve at least one sum. Done. Let's continue. Next one is risk adjusted discount rate method. The use of RADR is based on the concept that investors demand higher return from risky project. If the risk associated with any investment is higher than the risk involved in similar kind, discount rate is adjusted upwards. Why is it upwards? You are trying to discount a project with a higher rate. When you discount a project with higher rate, that means you are devaluing its inflow. Even after taking a higher discount rate, if a project is still giving you positive NPV, that means it's a really good project. I repeat, one project you worked out with 10% discount rate, you got positive NPV. You worked out same project with 12%, 14%, 16%, even then it is giving positive NPV. That means even after such a high discount rate, if the project is still giving positive NPV, it's really a good project. Therefore, what to do? Any sum, I have given one example to you. If they have given risk-free rate of return as 7%, that means you can put money in bank FD and earn 7%. Risk premium expected by management is 7% extra. Now, why are they expecting extra? If I put money in bank FD, I get 7% without any risk. If I'm investing in business, I'm going to have some risk involved in that. To compensate that extra risk, I'm expecting extra return of 7%. That means I should now do the discount not with 7, it will be with 7 plus 7, 14%. Therefore, if they want you to write it as a formula, risk adjusted discount rate is equal to risk free rate plus risk premium. You can also make a note. I'll explain this. Risk adjusted discount rate is equal to risk free. I need minimum 7% because bank is going to give me that. Without any risk, I'll earn so much. Correct? But in this particular project, considering the risk involved, I want something more. That something more is called risk premium. And in the question they have given, management is expecting 7% more. Therefore, the total discount rate, risk adjusted discount rate to be taken for our solution will be 14%. Correct? In exam, they will give you both. Okay, the RF as well as risk premium, add both and work out. But you see in this question what they did, life of the project 5 years, following cash flows given, calculate NPV based on risk-free rate and also based on risk adjusted rate. So if they give a question like this, and this was from RTP, first you will work out NPV based on simply 7%. And what was 7%? Risk-free rate. And then risk free rate is 7%, risk premium is 7. So the risk adjusted rate will be 14%. And then they did one more table with 14%. And then they have got the positive NPV. Now tell me, even after taking risk adjusted rate of 14%, if you're still getting positive NPV, that means it's a really good project. At 7%, definitely it was giving you 144. Now, even after discounting at a higher rate, upwards, you have taken 7 plus 7, even then it is giving me positive NPV. That means it will beat not only bank rate, it will also beat my bank rate plus additional premium. Even after discounting at 14, if I'm getting positive NPV, that means it is really a good project. Yeah. What if this number comes to negative? Earlier, when you did at 7%, it was giving positive NPV, but now with 14, it is giving negative NPV. That means this project will help you earn little more than bank FD, but not more than bank FD plus premium. Correct? At 7%, it was positive, but at 14, it is negative. That means it will earn more than bank FD, but not more than bank FD plus the premium. Next, one more easy method, very simple method, certainty equivalent method. The certainty equivalent is a guaranteed return that the management would accept rather than accepting a higher but uncertain return. What is this? If somebody says there is a project, you invest today, at the end of year 1, you will earn, say, today year 0, cash outflow 100 rupee. At the end of year 1, cash inflow will be 200 rupee. And if you ask them, are you sure of this 200? They may say, no, I'm 70% sure this will happen, but I'm not 100% sure. That means this is a higher return, but uncertain return. High, but uncertain return. Therefore, what management would do, 70% on 200 when you multiply, you get 140. They will consider 100 as outflow, 140 as inflow. 140 here, 100 here. They will consider 100 versus 140, and if 40 is positive NPV even now, they will accept this project. Basically, what are they trying to do? Instead of taking a very high number but uncertain number, they're converting that to a low number but with higher certainty. And this 70% can be written as 0.7, and this is called certainty equivalent coefficient, CEC. Check here. This approach allows the decision maker to incorporate his or her utility function into the analysis. In this approach, a set of risk-less cash flows is generated in place of original cash flow. I've given an example here. Year 0, 1, 2, 3, 4, 5, expected cash flow, but look at the certainty equivalent. coefficient or quotient. Now, what is the meaning of this number? Observe everyone. You will be spending 4 lakh rupee, and are you sure? Yes, because the certainty quotient is 1. At the end of year 1, you are expecting 3 lakh 20,000 inflow. Are you 100% sure? No, I'm just 80% sure. Therefore, this number is 0.8. Now, what is the meaning of 3 lakh 20,000 with 80% guarantee? If you multiply 3 lakh 20,000 into 80%, you can see here 3 lakh 20,000 into 80%, 2 lakh 56,000. That is, instead of saying 80% chance of earning 3 lakh 20,000, I'll be happy to say 100% chance of earning 2 lakh 56,000. I'm converting high but uncertain number to slightly lower but a certain number. So you simply convert all the cash flows to their adjusted or certain cash flows, and then you get adjusted cash flow, multiply with PV, and then you get finally NPV, multiply with discounting factor, you get present value. So in simple, I have given one line here. This method is similar to probability. Here we use the word certainty equivalent coefficient instead of probability. Understand, when I say 80% chance I will earn, indirectly I am saying 20% chance I may not earn. Probability is this itself. Probability of earning is 0.8, means probability of not earning is 0.2, and so on for all the other years. Next two methods, again very easy and very simple. Sensitivity analysis. Mark this important, make a note, and from study material, RTP, mock paper, wherever you get a question on sensitivity, practice. The good concept, more likely they ask a question. Yes. Sensitivity analysis in simple is a modeling technique which is used in capital budgeting, which is used to study the impact of change in the variable on the outcome of the project. What is this? See, for one project to give you positive NPV, there are a lot of things that are involved: sales quantity, selling price, variable cost, fixed cost, tax rate, discounting rate, initial outflow, useful life, and so on. At the end, you will have positive or negative NPV. If a project at present is giving positive NPV, the good news, you have started the project. But now you want to know whether the project is sensitive to change in sales volume, or change in price, or change in cost, or change in tax rate, and so on. In sensitivity analysis, what we do? We keep all other numbers same. We change only one item at a time. We change only sales quantity and see how much will be my new NPV. We change only the price to see how much is the new NPV, and so on. Okay. Therefore, in sensitivity analysis, always first work out base NPV. Somewhere, please make a note. I'll dictate 2 3 lines. In sensitivity analysis, while solving the problem, make a note. In sensitivity analysis, while solving the problem, always, always first calculate, first calculate base NPV, base NPV, full stop. Then, then make changes in, make changes in one item at a time. Make changes in one item at a time. Then calculate, then calculate revised NPV then calculate revised NPV and decrease in NPV, decrease in NPV in bracket in percentage term, in percentage term, close the bracket. Now see this. In a project, several variables like weighted average cost, consumer demand, price of the product, cost price operate simultaneously. The change in these variables will impact the outcome. Correct? If price go up, NPV will go up. If cost goes up, NPV will go down. Anything changes in one of this, NPV will change. It becomes therefore very difficult to assess change in which variable impacts the project outcome in a significant way. Therefore, what we do, project outcome is studied after taking into account change in one variable at a time. To see this, the more sensitive is the NPV, the more critical is the variable. I have given one example. Suppose project cost 1,20,000, cash flow 45,000 annual every year. Project life is 4 years. Their discounting is 10%. This question is from old RTP. Examine which of these three factors the project is most sensitive. That is, you can use the annuity factor 10%, 3.169, 11%, 3.109. Now, which of the three means these three? Change in initial cost, annual cash inflow, and cost of capital. So, what they did, first calculated the base NPV. How to do base NPV? You can see the question here, 45,000 annual, 4 years, 10%. Therefore, they first took the summation of discounting factor. So, 45,000 into 3.169 minus outflow. They calculated base NPV. Correct? And what have you written just now? Always first calculate base NPV and then change only one item at a time and recalculate the NPV. That is work out revised NPV. So, what did they work out first? They said initial project cost. So, they have taken 10% adverse variance. You can take any percentage, 10 is easy. Why did they take adverse variance? What if something goes wrong is what I have to find out. Not what if something goes right. Okay. What if something goes wrong when I say my investment may go up by 10% and that creates a problem. If investment goes down, there is no problem. I'm happy. But if investment goes up, that's when the problem is. So now what will happen? Only initial project cost from 1,20,000 is now 1,32,000. How much will be NPV? Same 142,605 inflow, there is no change, but outflow is different now. NPV is 10,000. Earlier it was 22,000, now it came down to 10,000. So change in NPV you have written last line in percentage term 53%. What does this mean? 10% increase in the initial project cost will impact NPV to fall by 53%. 10% change there is resulting in 53% decrease here. Same way, the next thing, annual cash inflow, they said decrease by 10%. It is an inflow. Adverse means it has to come down. Therefore, here what they did, they took revised annual inflow from 45,000, they took 90% means 10% less. They took 40,500 multiply by summation factor minus the same 1,20,000 original cash outflow that they are not changing now. This NPV is 8,345. Now you see the fall in NPV is 63%. Now how did they get 63%? Earlier it was 22,000 and now it is just 8,345. Such a big fall divided by starting point into 100. Same way they changed even the cost of capital, that is discount rate. Now it is falling by 13%. Now, if you observe these three numbers, 10% adverse variance was causing 53% fall when it was project cost. Then we went to inflow 10%, it was causing 63%. And here it was cost of capital 10%, this is 13%. That means understand the project is most sensitive to changes in the cash inflow. 10% problem there will create 63% fall in net present value. Wherever you have the highest percentage fall, understand the project is most sensitive to Next is scenario analysis. This is similar to sensitivity, but in sensitivity analysis, you change one item at a time, only cost, only inflow, only discounting factor. Here you do more than one. See this? This analysis brings in the probability of changes in key variables and allows us to change more than one variable at a time. That means imagine variable cost goes up, fixed cost also goes up, quantity comes down, price also comes down. All bad things happen at the same time. Now it's not sensitivity analysis, it is scenario analysis. And that is here. This analysis begins with the base case or most likely set of value for input variable, then go for worst case, that is low unit, low price, high cost, etc., and best case, sometimes even the moderate, that is one or two beneficial, one or two against the organization may also happen. In summary, sensitivity analysis is about analyzing how sensitive the project is for one item at a time. Scenario analysis is about analyzing how sensitive the project is for multiple items at a time. Here you are taking more than one. Okay, this ABC Limited is considering project X initial cash outflow given three inflows, that is scenario 1, 2, and 3. Here 1, 2, 3. Now, scenario 1, if you see all the years you have low number, that means this can be considered as worst case scenario. And scenario 3, you are having good numbers. Sorry, I think I am circling in wrong order this way. Year 1, 550, 650, 750, 500, 550, 600, 800, 900, 1000. If you see, all low numbers are in first scenario. Highest number in year order, I am saying, are in third scenario. That means third scenario should be understood as best, and first one is worst case scenario. Determine NPV in each scenario. Each scenario means scenario 1, 2, and 3. If they don't write it as best case, worst case, you also don't write as best or worst. If they write, you also write. Simple. So therefore, here what they did, scenario 1, year 0 minus 1600, year 1, 2, 3, they took discounting factor multiplied with scenario 1 numbers. That is here 550, 500, and 800 here. And then scenario 2 and scenario 3 here minus 57, 154, 365. What is the meaning of this minus 57? If worst case scenario happens, then you will have minus 57 as your NPV. Best case scenario, you will have maximum 365. That means now you know the range. Worst case also this much, highest also this much. And then they gave, if ABC Limited is certain about year 1 and 2, first and second year will be scenario 2, but uncertain about third year. Determine NPV expecting scenario 1 in last year. Suppose I know what may happen in first and second year, but I'm finding it difficult to predict the third year moment. Then they are saying third year would take the worst case. Therefore, they took minus 16 lakh plus 6 lakh 50,000 into first year factor, 550 second year. Last year alone, they took 800. That means actually they are taking these numbers, scenario 2 and scenario 1. Multiply with discounting factors, year 1, year 2, year 3, and finally NPV 76. By the way, this table, all rupees are in thousands. It is basically 57,000, 154, 365, even these numbers. Okay, I have covered all the methods of risk analysis in capital budgeting. Somewhere make a note from this topic. Do at least one sum from every method. Do at least one sum from every method. We'll stop. Revise this chapter. Revise this chapter only after investment decision chapter. Only after investment decision chapter. Okay, because here also you use discounting factors, here also you need CFATs and so on. So better do this only after doing the investment decision chapter, right? So with this we are done with chapter 2, that is risk analysis in capital budgeting. One of the easiest topic, very small also, won't take much time. Do every possible sum from this topic without fail. Okay, with that we are done with chapter number. Yes, let us start the next topic, chapter 3, risk and leverage. Another small topic and important topic. Somewhere make a note, risk analysis in capital budgeting. Make a note somewhere, risk and leverage, dividend decision. These three topics are very small and very easy. Without fail, you must revise. Write down somewhere. Don't leave these topics at any cost. Very small, very simple, and very easy. The two, risk and leverage, is much easy. Now, this can be a theory question. There are two varieties of risk. One is business risk, second one is financial risk. Understand the basic principle. Anybody running a business has business risk. But whether you have financial risk or not, that depends on whether you have debt in the capital structure or not. If there is debt, then there is financial risk. If there is no debt, then there is no financial risk. See this. Meaning, this is associated with firm's operation, means day to day business, variable cost, fixed cost, profit, loss, all of that. This is related to EBIT. Financial risk is the additional risk placed on equity shareholder because they use debt funds. Because there is debt, there is interest to be paid. And whenever there is a debt and the interest has to be paid, understand a businessman takes additional risk. That is called financial risk. Second, how do you measure? Using a formula called DOL. Here we use the formula DFL. Business risk is connected to economic climate, that is inflation, competition in the market, customers taste, preference, all of that. Financial risk is linked to use of debt fund. That means if you use debt, there is risk. If you don't use debt, there is no financial risk at all. How to reduce? Business risk cannot be reduced at all. Anybody running a business has business risk, but financial risk can be reduced if you do not have any debt in your capital structure. Now, these formulas are extremely important. Entire chapter is based on these 5 6 formulas. And if you have already worked out problems even from study material, if you know these four formulas, DOL, DFL, DCL, and even the ROCE, which will come little later, if you know these four formulas, you will be able to do majority of the sums. If you're not able to understand those topics, then those formulas, then full topic becomes very difficult. So let's understand the formulas. DOL is percentage change in EBIT. EBIT is earning before interest and tax divided by percentage change in sales. When to use this percentage change? Only when you have two period data in the question. That is 2 months, 2 years, 2 quarters data. If they give, you can use it. Or DOL, another formula is contribution by EBIT. Use it when single period data is given, that is only 1 year, 1 quarter, 1 month, then use this. Same way, DFL is percentage change in EBT by percentage change in EBIT. Again, if you have two period data, here you can use EPS in place of EBT, many students find it difficult to understand. How can we use EPS in place of EBT? Observe, from EBT, if you see till the end, everyone concentrate, this is important. From EBT, you deduct tax, you get EAT. Tax is a percentage. So if EBT goes up, tax will also go up, EAT goes up because it is in percentage. And most of the questions we understand that there are no preference shareholders unless printed specifically. That means this will be straight away divided by number of equity shares and you're going to get EPS. And if EAT is more, then EPS will also be more because number of equity shareholders will not go up every now and then. Only when you issue fresh shares, number of equity shares will go up, otherwise not. Therefore, understand, whenever I say EPS is going up by 5%, 10%, understand you can either say EBT is going up or you can say EPS is going up. If the 100 here becomes 200, tax which was 30 becomes 60, and EAT which was 70 becomes 140. Suppose there were 10 shares, now also 10 shares, this was 7, this is 140. That means if this go up by 100% jump, even this, sorry, 14, even this will jump by 100%. That means I can now understand that sentence properly. Here we can use the word EPS in place of EBT. If that goes up, everything from there goes up, and we assume that there are no preference shareholders. DFL, use it when you have single period data, that is EBIT divided by EBT. Nothing much to revise in this section. You only have to understand these 2-3 formulas. Combined leverage is DOL into DFL or contribution by EBT. Basically, this is contribution by EBIT into EBIT by EBT, correct? When you say DOL into DFL. But what happens? EBIT, since they are common, gets cancelled. Finally, you are left with contribution divided by earning before tax. Combined leverage. Combined leverage, if that is more, then understand combined risk involved in the business is very high. Now, what many students fail to understand is what is the meaning when we get an answer. Suppose I use this formula, DOL came to 3. Yeah, the meaning of this 3 is for 1% change in contribution, there will be 3% change in EBIT. Understand, I'm saying 1% change in contribution. I can even say 1% change in sales. Why? If sales go up, contribution also go up, and sales, variable cost, contribution, all three will go up in same direction in same speed. If that is up by 20%, variable is also up by 20%, contribution is also up by 20%. So the number 3 means for every 1% change in sales, there will be 3% change in EBIT. And what is DFL? Again, if DFL comes to 4, that means for 1% change in EBIT, there will be 4% change in EBT. What if combined leverage is 7? Understand, for 1% change in sale. Remember, combined leverage will connect topmost item to bottommost item, which is the topmost item sales, and the bottommost item is EBT or EPS, correct? That means for 1% change in sale, there will be 7% change in EBT, or I can say EPS also, right? Another important concept, very small topic, small not in size in terms of size, but it has only these 3-4 formulas, and every question revolves around these 3-4 concepts. So, concept of ROCE versus interest, they have asked repeatedly many times. ROCE basically means return on capital employed. Capital employed is debt capital plus equity capital. That is, it is measured in percentage term. So that is EBIT by total capital. Example, debt is 20 lakh, equity 10 lakh, EBIT 3 lakh. Therefore, ROCE will be 3 lakh EBIT divided by 20 plus 10, that is 30 lakh. 3 by 30 into 100, 10% is ROC. Now, Very important discussion. When will you consider a company to be in a favorable position? When will you say they are financially leveraged? Leverage means advantage. When will you say from financial perspective they are in an advantageous position? That is, see here. Suppose equity share capital is 5 lakh, debt is 5 lakh. Same I have taken all three columns. Total capital is this. Suppose EBIT is only 2.5 lakh. Here 1 lakh 20. Here 50,000. ROC is 25%. That is 2.5 lakh by 10 lakh. 1 lakh 20 by this and this by this. Suppose rate of interest is 12%. Conclusion is favorable, neutral, and not favorable. How did they reach this conclusion? Listen to me, very important. What is the meaning of ROCE 25%? I took 5 lakh from equity share capital and another 5 lakh from debt. 5 lakh here, 5 lakh here. I added both 10 lakh and that I invested, I got 25%. Indirectly, I can say from equity share capitals 5 lakh also I earned 25%. From debt 5 lakh also I earned 25%. Correct? From this 5 lakh also I have earned 25%. From debts 5 lakh also I have earned 25%. Now, how much am I paying to the debt provider? Only 12%. That means observe here, from this debt I am earning 25%, whereas I am paying only 12%. The excess that I am earning because of debt, the 13%, I will be giving that to my equity shareholders. I am using debt and making equity shareholders wealthy. Very important sentence. I took 5 lakh from debt. I will pay them only 12%. But using their 5 lakh also, I made 25%. Now, who will enjoy the 13% extra return? The equity shareholder. Definitely, after paying taxes only, whatever is left out, equity shareholders will enjoy that. Which means by having debt, I am increasing the earning of equity shareholder. Equity shareholder will anyway get 25% on their 5 lakh, plus they will get 13% extra because there is debt. That is why here they use the word favorable. Here they are using the word neutral. Why? You are taking 5 lakh from debt, you are earning 12% from that. And how much are you giving them? Same 12%. So take their money, invest in a project, make 12%, that full 12 is going to them. How is it advantageous or how is it problematic? It is neither. But in third case, interest rate is 12%, whereas you are earning only 5%. Now observe, from the debt holders 5 lakh also, you are making just 5%, but you should pay them 12%. That means you will end up paying 7% from your pocket. That means having debt is not favorable to you. That means having debt is good when, see this, ROI means return on investment, which is nothing but ROC. If ROC is greater than interest, it is favorable, taking debt is good. If ROC is less than interest, not at all favorable. You saw in the table. If ROC is equal to interest, neutral, whether you take debt, you don't take debt, will not make any difference. Yeah. The same thing that I explained here. The basic aim of financial leverage is to increase the earning of available to equity shareholder using fixed cost fund. Which is a fixed cost fund? Debt, because we will pay them same 7%, same 8%, irrespective of our profit. That means we should use their money and make our shareholders wealthy. And if I am able to do that, then that such process is called trading on equity. And when will I use debt to make shareholders rich? Only if my ROCE is greater than rate of. Few problems on this. A company had following balance sheet as on 31st March. Share capital, reserve, debenture, liability, fixed and current asset. All other details given: fixed cost, variable cost, total asset turnover, income tax rate. Calculate the following. Now see, they said total asset turnover ratio 2.5. That means from 1 rupee asset, we are making 2.5 rupee of turnover. From 1 rupee asset, we are making 2.5 rupee of turnover. Go to the balance sheet, we have 400 crore of assets with us. 400 into 2.5, our turnover is 1000 crores. And later question says find out EPS. For that, I have to start with sales. Variable cost is given in the question as 65%. I will take that. This will be contribution. Fixed cost is also given. I can see here all the numbers. 65%. Fixed cost is 80 crore. And then I got EBIT minus the interest. For interest, I have to go to balance sheet. In the balance sheet, I have debt, correct? 15% on 200 crore. EBT, pay taxes. This is earning available to equity shareholders. If you divide that by number of shares, you get EPS. Simple. Same way, operating leverage, single period. So contribution by EBIT 1.296. What is the meaning of 1.296? For 1% change in sale, there will be 1.296 percentage change in EBIT. Sales, you can even write contribution because both sales and contribution change at the same rate. Financial leverage, EBIT by EBT, same way. Again, more than one. That means reaction is more than proportional. Combined leverage, you mix both 1.458%. That means if sales go up by 1%, your EPS or EBT will go up by 1.458%. Another question, mark this as important, and this is from RTP. This is a lot of small sub questions, very good questions. A firm has a sale of 75 lakh, variable cost given, fixed cost 6 lakh. It has a debt of 45 lakh at 9%, equity 55 lakh. Basic data. You are required to do ROI means ROCE, which is EBIT by total capital. So what they did first, sales minus variable, contribution, fixed cost, EBIT. They took the interest, calculated up to EBT. Then for ROCE, they did EBIT divided by total capital into 100, 27%. Now see, does it has a favorable financial leverage? Your ROCE came to 27%, whereas the interest that you are paying is only 9% rate. When ROCE is more than rate of interest, having debt is good. That means you are in a favorable financial leverage condition. If the firm belongs to an industry whose capital turnover is 3, does it have a high or low capital turnover? Now, capital turnover is turnover by total capital. And in the answer, they did turnover by capital, they have much less than industry average. That's the comment they have written. Calculate DOL, DFL, and DCL. For this, you anyway have contribution, EBIT, EBT. You can do DOL, DFL, and then multiply to get combined leverage. If sales increase by 10%, what percentage EBIT will increase? Now we have done DOL. How much was DOL? 1.2. That means if sales go up by 10%, this will go up by 12.2%. This is one question where many students had doubt. I have received this doubt. Many. Observe this next question. At what level of sales the EBT of the firm will be equal to 0? How to do this? They are talking about sales and EBT. That means we should consider combined leverage. Sales the top item, EBT the bottom item. So now you see here. Combined leverage is 1.44. Here is where the confusion. For 1% change in sale, there will be 1.44% change in EBT. Now, they want EBT to be 0. That means they want this to change by 100%. For that, how much should be change in the sale? When you cross multiply, you get 69.44%. What does that mean? If sales drop by 69.44%, EBT will drop by 100%. So as of now, sales is 75 lakh minus 69%. At 22 lakh 92,000 sales, your EBT will reach 0. That's the mean. Did you understand? We always do this for 1%, 1.44. For 60%, how much should this be? But here they have done the exact opposite. They want this to fall by 100. They said how much should be this? Small cross multiplication. Yeah. And the last one, if EBIT goes up by 20%, by what percentage EBT will increase? This is combined leverage because they want EBIT to be connected to EBT, not combined. Financial leverage. Where was the financial leverage? 1.18. That means for 1% change in EBIT, 1.18. And now they are saying that the EBIT will go up by 20. That means this is 20 into cross multiply 1.18, you get 23.6%. Right? This topic, as I told you, work out as many problems as possible, similar to risk analysis in capital budgeting. Easy chapter, very simple chapter. There are no complications involved. Most likely, a 5 marks question can come from this. They give 10 marks, well and good, but less chances that you will have a 10 marks question from this chapter. Again, practical segment is more important than theory. This topic, risk analysis and dividend decision, all three, easy, small. They always ask, see, even if they ask 5 marks from all three, dividend, risk and leverage, and risk analysis, 15 marks out of just 60 from small three topics, and this will not take too much time for you to do revision as well. So, I always say this even in regular class that working capital management topic, lengthy, time consuming, revise that last. These kind of small topics, but they always ask a question. Such chapters you revise first. This has to be revised first. Okay. With that, we are done with another small topic, risk and leverage. Yes, let us begin with the new topic. The next topic, cost of capital. Capital is the source of money. Capital is the money, can come from multiple sources. In this topic, we mainly cover cost of debt, cost of preference, cost of equity, and cost of retained earnings, reserves, and surplus. Most of the times, cost of reserves and surplus is also interchangeably used and written as cost of equity because reserve belongs to equity shareholders. So, whatever is the cost of equity is the same cost that can be taken even for reserves and surplus. So, first part is calculating cost of debt. Basically, what is this cost of debt? Debt is the money that I get from lenders, can be bank, can be debenture holder. Cost of debt is I pay them some interest and I save some taxes also. So, cost of debt basically means how much is the cost that I am incurring to use somebody's money. Now, somebody here is a debt provider. There can be two varieties, cost of irredeemable debt and cost of redeemable debt. This is one topic where you have a lot of formulas, and one day before exam you can use this PDF. It has all the formulas in one place. I will anyway be explaining one by one now. You can keep this PDF handy and use it for revision one day before exam also. First, cost of debt without any redemption adjustment. Logically speaking, there is nothing called irredeemable debt. If you have paid loan, if you have given loan to somebody, you have to take the money back, principal money back. If you have issued debentures, that has to be redeemed. If you have taken loan, that has to be repaid. That means there is a certainty in terms of number of years. But for academic purpose, they have worked out both in study material. One is cost of debt without redemption. Next is cost of debt with redemption. Now, when I say cost of irredeemable debt, that means I keep paying interest into 1 minus tax. Why 1 minus tax? Because I pay interest and I save tax because of that. So, I may be paying 1000 rupee interest, but because 30% tax is there, this 1000 gets debited to P&L. My profit will come down by that extent. My tax will also come down by that extent. So, though I pay 1000 from pocket, I save 30% of 1000. Therefore, net cost to me will be only 700 rupee, which is 1000 into 1 minus 0.3. When you do, you get 0.7. 1000 into that is 700 rupee divided by net receipt, that is the debt amount. Suppose debt amount is 10,000. Loan amount, if it is debenture, if it is issued at par, it is 10,000. If it is issued at premium, then you add. If it is at discount, you deduct. And if there are any incidental expenses like flotation cost, ROC fee, etc., all of that should be deducted in the denominator. I've given a note here. Net receipt or net proceed means issue price minus issue expenses. Issue expenses means all of this flotation cost, commission, underwriting commission, and all of that. If issue price is not given, then students can assume it to be equal to current market price. And this is where there is a doubt in many students' mind that in some questions they give issue price. If they don't give, what should I do? In study material, most of the places they have used market price. In some places, even in study material, they have used face value. And this is why the confusion is. Listen to me. Very important. Let me explain this and clarify this doubt once for all. Suppose there is a debenture. Its face value or book value is 100 rupee. Its current market value is 110 and issue price is 120. What does it mean? Company is planning to issue. When they issue, they get 120 rupee. In market, people are buying and selling it at 110, but the book value is 100. For all the formula, the basic thumb rule is we should take the issue price. Make a note somewhere. Basic thumb rule in all the formulas is we should use the issue price. Now the problem comes when they don't give issue price. So if issue price is given, take issue price only. Okay, definitely minus the flotation cost. That minus has to be done. Whether you take market value or issue price or book value, that minus has to be done. So if issue price is given, then you always take issue price. What if issue price is not given? Now comes the question, check whether book value is given and market value is given. Suppose only book value is given, market value is not given, then you take book value. No confusion. Now the problem is issue price is not given, book value is also given, market value is also given. This is where the confusion is. In some places in the study material, they have taken market value. In some places, they have taken book value. If you think from practical perspective, market value is the price at which debenture is getting traded in the market. Now, when people are ready to buy and sell it at 110 rupee in the market, why will I issue it at book value? Basic common sense. I wanted to issue it at 120 issue price. Suppose that is not there in the question, then go by the market value is what is logically correct. But in study material, some places they have taken market value, some places they have taken book value. So better you take one of the two and give a clear no. Because if your starting point is different, your answer will also be different. I can see most of the questions, when question is silent, they have taken book value and not market value. Though this is logically wrong, this is what they have done in many sums in the study material. I repeat, suppose issue price is not given and both book value and market value are available. Logically speaking, we should go by market value, and that is what we might have done in some of the questions in class also. But in study material, though market value is there, book value is also there, they have gone by book value by giving a note that it is assumed that the issue is at book value. But reality, you understand, book value 100, market value 935. Why will anybody issue it at book value? And if I issue it at book value, company will get less money. In market, people are ready to give me 935 rupee. Why will I issue it at 100? Correct? So logically that was correct. But academically, when question is silent and issue price is not given, they have taken it on book value basis. You also do that. To be on a safer side, give one line no. Okay, coming back. That's why here net receipt, though I have said equal to current market. If current market is also not there, consider book value. If issue expenses are not there, take it as 0. This is practically correct. Okay, but ICAI study material, most of the times, they take face value when question is silent. Yeah, I quickly summarize. If issue price is already given, no confusion at all. If issue price is not given, then we can take either book value or market value. Logically, market value is correct, but in book, in ICAI study material, they have repeatedly taken book value. So, academic purpose, I am also recommending go by book value, but give a clear cut note. Yes, if there is redemption. Now, observe here, When there was no redemption, the formula was interest into 1 minus tax divided by net receipt. What I pay divided by what I get. Simple. I means company. But if it is with redemption, then I have to do interest into 1 minus tax, definitely divided by net receipt. But because there is a redemption, there can be profit or loss on redemption. That is RV minus NR divided by N. Now, what is RV minus NR? At what value I am going to redeem it minus what is the inflow today. This is like cash inflow today. I am doing it from company's perspective. This is what is coming to us today when we issue, and this is what will go out from us after say 5 years, 8 years, 10 years. The difference between these two will be loss. But this interest is per annum. The tax saving is per annum. Therefore, even this should be per annum. Therefore, we divide this by number of years. Understand the purpose of dividing this by number of years is to find out annual loss or gain. Otherwise, we could have just done RV minus NR. Interest is per annum, tax saving is per annum. Therefore, even this should be per annum. Now, the denominator won't be simply redeemable value. You have to add net receipt and redeemable value and divide by 2. Basically, you have to take the midpoint. How much is coming in today? That is net receipt inflow. How much will go out after say 5 years redemption? RV plus NR whole divided by 2 into 100 because you want the answer in percentage term. Both the formulas are very important. I have given a small table. You can go through this by yourself. Issued at par, redeemed at par, there is no gain, no loss. But issued at par, today I am collecting 10. I'll have to redeem it at 12. That means I'll end up losing 2 rupee. 2 rupee after total say 5 years. Then I divide by 5, I'll get to know annual loss. Same way, 10 versus 8, I gain. Correct? Formula will be same here. But when you do this, if there is a gain, this number inside the bracket will be negative number. So in that case, suppose interest is 100 minus 1 minus 0.3. This will be minus say 20 rupee if that's a gain 20. If it is loss 20, it will come as plus 20 whole divided by RV plus NR by 2 into 100. So you don't have to write it as plus or minus formula. Write it as plus. Inside the bracket, if it is negative, it is actually gain. Same way, issued at 12, redeemable at par, 2 rupee gain because today you are collecting more. In future, you will be repaying very less and so on. 12 versus 12. Look at this. Issued at premium. Today you are collecting 12. In future, you will repay only 8. That means you are saving 4 rupee. And if this is happening after 5 years, you have to divide this 4 rupee by 5. So you get to know annual gain or loss. Same 8 versus 10, 2 rupee loss. 8 versus 12, 4 rupee loss. 8 versus 8, 0. And all of this is total. You have to divide that by number of years. That is what you write in the numerator, annual loss or gain. It means whenever there is a loss or profit, it should be treated as cost or benefit respectively. Loss or gain on redemption should not be treated as expenditure in the year of issue itself. That is why we are distributing it over the life. Example, 10,000 loss to be redeemed after 5 years. I have to take 10,000 by 5, that is 2,000 rupee. Interest is per annum, tax saving is per annum. When you divide this by number of years, you get even this on per annum basis, whole divided by RV plus NR by 2 into 100 because you want the answer in percentage. Next method is YTM method. This is more like IRR method. Very easy. I have given a table to you. See this. This is similar to IRR. This was done in investment decision. Here you do trial and error. Observe everyone. Very important. You take year 0 net receipt, which is your denominator. That is here. Interest net of tax, that is I into 1 minus t. Year 1 to n, that is 1, 2, 3, 4, 5. Assume whatever is the interest, suppose 100 into 1 minus 0.3, this will be 70. N is redemption value, redeemable value. Suppose I am writing some numbers here now. Suppose debenture is issued minus flotation cost, say 98 rupee, 100 rupee debenture, 2 rupee flotation cost. Every year 10 rupee interest into 1 minus tax 0.3, therefore this comes to 7. And N, let's assume 5 years. That means 5 years interest will be paid. Fifth year, it will be redeemed at premium. So this is 105, 5 rupee premium. Now in IRR, what we do? We take discounting factor. Sorry, these numbers, one second, not here. These numbers will come here. 98, this is 7 rupee, and this is 105, correct? And then year 0 will be 1. Year 1 to year 5 I have taken at 10% summation, that is 1 divided by 1.1. You keep doing the sum, you get 3.790, and then fifth year factor, say 0.620. This is negative minus 98. This and this, you should get 0 here. You won't get, you may get a positive number. Then you have to do one more trial. Same like IRR. Now when you do, you may get a negative number. And now you know, you'll have to cross multiply plus and minus. Similar to IRR, it is minimum 10% plus something more. Correct. Suppose I'll just write some numbers to help you understand. When you did 10%, suppose this answer was 25. When you did 20%, suppose the answer is minus 5. Your target was to reach 0. Therefore, now cost of debt is equal to minimum 10% plus something more. How much more? From 10, you went to 20. That means you increase the rate by 10 points, because of which your NPV came down from 25 to minus 5. That means it fell down by 30 points. But you wanted the 25 to come to 0. So for the 25 fall, how much should be the number? Then ultimately this will be 10 plus, when you cross multiply. Example, you may get 7.5. Just writing an example, 10 plus 7.5, 17.5 will be your answer. This is your cost of debt, KD, worked out using YTM method. YTM is nothing but IRR method. Yeah. If you want to make a note of this, just an example, you can write down roughly year 0, year 1 to 5. All these are example numbers. Net proceeds. NP is net proceeds, that is issue price minus flotation cost. Net receipt, net proceed or net receipt, one and the same. Then all these numbers are example numbers. Minus 98, interest into 1 minus t, say 10 rupee interest, 30% tax, 7 rupee, and then fifth year 105, that is redeemable value. It is basically the same thing that you did in the formula, but instead of formula, you are doing it in the IRR or YTM method. Okay, we continue. Next one is amortization. Amortization of bond. Even debentures can be amortized, but most of the time debentures are repaid in one shot. But bonds, one basic quality, basic character is that bonds are redeemed over a period of time. That is, 100 rupee bond issued today will be repaid in part over say 5 years, 8 years, 10 years. Most of the cases in India, bonds are amortized over a period of 5 years. What happens in amortization? Suppose a bond is worth 1000 rupee and amortization has to happen over 5 years in equal installment. 8% is the interest. For an investor, understand year 1, 2, 3, 4, 5, how much will be his cash flow? He will get some principal repaid and also interest. Now 1000 rupee bond should be amortized in 5 years. That means every year you will get 200 rupee in the form of principal repayment. This is the meaning of amortization, instead of repaying 1000 in one shot. but the interest amount will differ every year. First year you will get 8% on entire 1000, that's the opening balance, that is 80 rupee. Second year, since 200 is repaid, you will get interest only on 800. So 800 into 8%, 64 rupee, and so on. Your interest amount keeps coming down. Therefore, the total cash flow will be different every year. When cash flows are different, you can't do summation of discounting factor. You have to then take the discounting rate as given in the question, then discounted cash flow. This is the value of the bond. Value of the bond. Now, this as of now is 1000 rupee. Suppose the value comes to 1120. What does it mean? Though it is available in the market at 1000 now, its real value is 1120. Remember, value of anything is based on its future earning capacity. Now, this is neither annuity nor perpetuity. For annuity, it should be same amount forever. For for annuity, it is same amount for limited period. Perpetuity, same amount for ever. In this case, it is for only 5 years limited period, but the amount is also not same. When the amount is not same, then value of anything is cash flow into discounting factor plus cash flow into discounting factor. This is cash flow of year 1, discounting factor of year 1, cash flow year 2, discounting factor of year 2, same way cash flow of year n, discounting factor of year n. So this is value of anything. In this case, it is bond. Value of anything is equal to present value of future cash flow. What if this is annuity problem? Then it is cash flow per annum, correct, into summation of discounting factor. If it is perpetuity, value of anything is cash flow divided by rate of return. The rate of return is 8%, to divide that by 0.08 if this is perpetuity. So in perpetuity, same amount earned forever. In annuity, same amount is earned for limited period. Now this sum that I did, my cash flow is changing every year, therefore I have to multiply it separately. Okay, this is my annuity example and this is my perpetuity example. One simple thumb rule to remember: anything they ask you to find out value of something, value of equity, later in the capital structure it comes value of debt, value of firm, go by the simple rule: what is that I am going to earn, divide that by rate, applicable rate. If it is value of bond, what am I going to earn? Every year some cash flow, some money will come back plus some interest, correct? But here I can't use that because here the cash flow is different every year. Therefore, I had to do by the first approach, this one, correct? Imagine I have bought a bond, 100 rupee, no question of redemption. They are going to pay me 8% forever. Forever means perpetuity. How much will be my cash flow? 8 rupee divided by what is the applicable rate? 8%. That means 8 divided by 0.08. Value of that bond is simple 100 rupee. Okay. But if they are going to give me 8 rupee for next 5 years, then it is 8 into summation of discounting factor PVAF at the rate of discounting for 5 years. So why is this very important? Why am I repeating again and again about perpetuity? Later in the capital structure topic, you have something like this. Many students find it difficult to understand this value of debt, value of equity. Listen to me. Later you have value of firm. Remember the value of firm. Now firm has a perpetual life, correct? That means this sum is based on perpetuity. What will a firm earn? Profit, EBIT. And what is the rate applicable? Overall cost of capital. Therefore, the formula is EBIT by KO. It will come later. I'll explain when I go there. Value of equity. What will equity shareholders get? Earning available to equity shareholder, which is the rate applicable to equity shareholders, cost of equity. Value of debt is equal to what will debt holders get? Interest. Irredeemable, that means they will get it forever, which is the rate applicable? KD. That means anywhere you see value of something which is going to be earned forever, what am I earning divided by applicable rate? Simple. In this case, value of bond, I could not use any of the above formula because annual number is not same. Correct? You saw in my table every year this was same, but this was changing. Therefore, my cash flow was different. Therefore, I had to multiply separately. And this is not even infinite series. This is definite 5-year period. Correct? Definite 5-year period. That means I can't use annuity, I can't use perpetuity because even the cash flows are different. No question of annuity, no question of perpetuity. That's why cash inflow into discounting for year 1, cash inflow into discounting for year 2, and so on. Next, very important, please make a note somewhere. Cost of convertible debentures. They can ask this question. They have asked many times in the past also. What is this cost of convertible debentures? Now, listen to me. Some students get confused. We have already studied two different ways. One, the formula KD is equal to I into 1 minus T plus RV minus NR by N, RV plus NR by 2. And we have also studied YTM method, which is trial error. These are two different ways of calculating cost of debt. And if they say cost of convertible debt, what is this? Convertible debt gives an option. Remember, this is an option. This is not a compulsion. It's an option. To whom? The debt holder, the investor. What is the option? After say 5 years, he can either take cash or he can convert to equity shares. Now, which one will he choose? That depends on his decision. Definitely, he will choose the one which is more beneficial to him. That is, today I am issuing a debenture for 100 rupee. 5 years later, he will have two options. Either he can redeem it at premium, example, 100 may become 105, redeemable at 5 rupee premium, or he can get 10 equity shares after 5 years. So this is today, year 0, and this is year 5 after 5 years. Now, which one he will choose? Sir, 105 is amount, but these are 10 shares. Now, we should know how much will be the value of one share. Suppose value of one share is 13 rupee, then 10 shares into 13, he is going to get 130 rupee worth shares. Even if he is not interested to be there as a shareholder, he can take those shares and immediately sell. There is no compulsion for him to stay in that company forever. He will decide whichever is higher in simple. That means whenever you see a question with conversion option, whenever you see a question with conversion option, very, very important thing to remember. First thing you should find out redeemable value. Redeemable value can be either cash or shares. Find out how much is cash value will be given in the question. Find out how much will be the value of shares. Whichever is higher, choose that. Now, once the RV is ready, you can either use the formula, that is this. Now you know the RV value, or you can use YTM, that is year 5 value in the trial and error table. Okay. One question on convertible debenture. Please make a note, everybody. One question on convertible debenture concept you must work out. One question on convertible debenture concept you should work out. Done. There you write down while working out, while working out, please make a note, while working out cost of convertible debentures, cost of convertible debentures, always calculate, always first calculate, always first calculate redeemable value, redeemable value, that is higher of, higher of cash or shares, buyer of cash or sales, cash or shares. Once you decide that, you know the redeemable value, next line you write down. This can be worked out. This can be worked out either using formula. By the way, that formula is called approximation method. Either using formula or using YTM method. Either using formula or using YTM method. This depends on question. If they don't give anything, you can use any of the two. If they mention use YTM, then you have to work out under YTM only. Okay. Let's move on. I have explained this already. The cost calculation of cost of convertible debenture is very much similar to redeemable. While determining the redemption value, it is assumed that the debenture holder will choose the option which has highest value. I told you, either redeem it as cash or convert it to share. Accordingly, the same is considered. Now, this can be either done using formula or under YTM method. Next one is simple, and don't waste time on working out this cost of preference share. Why I'm asking you not to spend time on this? Everything that you have done in KD is same here also. Here we pay dividend in place of interest. Therefore, formula will not be I. Formula will be PD, preference dividend. Second one, dividend is not treated as expenditure under tax. It's an appropriation of profit. Therefore, there is no tax benefit. That means you tell me, if I have to work out KP, what should be the formula? If there is no redemption, then it is simply preference dividend by net receipt into 100. If it is with redemption, then preference dividend plus same way RV minus NR by N, RV plus NR by 2 into 100. Even this can be done under YTM method, that is year 0, 1 to 5, say 5. Here also net receipt. Now it is only PD, no 1 minus T, and then redeemable value, then discounting factor at 10% first trial, and then 20%, 30% cross multiplication. That means all that we did there, we can do here also. You don't have to work out any specific problem on this. Just change the formula. What was this in debt? I into 1 minus T. Now there is no 1 minus T. Number 1. It's not interest, it is preference dividend. Therefore, it is simply PD. All other things are okay. Next, cost of equity shares. Now, for cost of equity shares, there are many formulas because equity share depends on too many factors. Company should be making good sales. Company should be earning good profits. Company should pay good dividend. For that tax rate, above that interest, before that fixed cost, variable cost, so many things matter. And there is no guarantee whether equity shareholder will get something or not. He may not even get even a single paisa. That is another problem of being an equity shareholder. First formula is annual dividend divided by net receipt, which can be written as D by P. P means P0 into 100, because you want the answer is percentage. Now, when they say annual dividend, and we are not writing whether it is dividend now or dividend at the end of year 1 or end of year 2, this can be used only when dividend number is constant. What do you mean by that? D0 dividend right now, D1, D2, D3, all the dividends are same. Then you can use this. This is again more like your perpetuity. Now you observe here itself. What is the perpetuity that I am talking about? I am trying to find out value of an equity share. Correct? You observe why I said perpetuity. And as an equity shareholder, it's a perpetual income. And I'm saying annual dividend constant number. Correct? That means this is constant cash flow divided by applicable rate, which is the rate applicable to equity shareholder, cost of equity KE. And if you cross multiply, value into cost of equity is D. And if KE is shifted here, it is D by value. Value means market price of share. If there is a flotation cost, you minus. That's all. Net receipt is nothing but P0. Here also you see the same thing, perpetuity. As an equity shareholder, my income is perpetual income. Debt is redeemed. Preference share should be redeemed. Equity, no question of redemption. And anything related to equity, understand it's a perpetual income. I earn forever. Right? Second one. Earning approach. Same way, instead of annual dividend, you take annual EPS. Again, this can be used when EPS is constant. Both these formulas to be used only when annual numbers are same, that is constant. But we can't expect the share price to be constant, dividend to be constant. Companies keep growing. Therefore, to adjust the growth, we do D1 by P0. Now, here is one area where many students get confused. Sir, you are writing D1, but in my book it is written in study material as D0 into 1 plus G. Now, what is D0 into 1 plus G? D0 is dividend right now into 1 plus G. That means you are trying to calculate dividend at the end of year 1, which is nothing but D1. Correct? Suppose today dividend is 10 rupee, expected to grow at 10%. That means 10 into 1 plus zero point 0.1. Correct? Which is 10 into 1.1, which is 11. I am directly writing D1 here as 11 rupee. So you can also write it in exam as D0 into 1 plus D, nothing wrong, divided by P0 minus flotation cost, if any. That's why net receipt is the word they've used, plus G. Now, what is this G separately that we are adding? Understand, if I purchase a share today by paying P0, suppose 105 rupee, and I am going to earn dividend at the end of year 1, say 8 rupee, and after receiving dividend, I am planning to sell this share for 120 rupee. Now, how much am I going to earn? First, I got 8 rupee dividend for my 105 rupee, correct? This is one earning, plus 120 minus 105. I earned little extra because I sold the share after collecting dividend, and even for this today I am investing same 105. Correct? So 8 divided by 105 is the earning from dividend, plus this 120 minus 105, which is 15 rupee, divided by 105. This is nothing but growth of the share price. It was 105, it went to 120. If I keep it, it may go to 135, 145, and so on. Therefore, the formula D1 by P0 plus G is your cost of equity. And this is to be done only when there is growth in the question. Now, first two formulas, I said constant earning and constant dividend. Here I am saying use it only when there is growth. And growth rate will be given in the question. And if they say historically company's share price has been growing, dividend has been growing at 8%, you take even in future, it will grow at the same percentage. Next is realized yield approach. You don't have to do anything. Realized yield is nothing but YTM method. Now, what is the meaning of YTM method? As an equity shareholder, today I bought a share for 98 rupee. I earned dividend at the end of year 1 7 rupee, end of year 2 8 rupee, end of year 3 13 rupee, and that year I sold the share for 120 rupee. Not redeemable. Equity share is not redeemed. This is sold to some other party. Redemption only when the company is closed, liquidation. Now then this is my cash flow. This is year 0, 1, 2, and 3. And then we took discounting factor at say 10% with the discounting factor, and then discounted cash flow. You may try 20% and then cross multiply everything that you did in YTM method, you did in IRR method, the same thing here also. So realized yield approach in simple is YTM method. YTM is also called as IRR method. Somewhere please make a note. Realized yield approach, realized yield approach, comma, YTM method, comma, IRR method are one and the same. Done. Next one is CAPM approach. Quite important. Capital asset pricing model. This considers the risk return relationship. There are two varieties of risk: unsystematic risk and systematic risk. This PDF will be with you, so you can read in detail later. Let me explain it in summary. When I say unsystematic risk, this is the risk that is not common to every company in the market, the stock market. This is applicable only to that company for that year because something is wrong in that company for that year. It is not common, it is not universal. Okay. Suppose in one of the company, say Ultratech Cement, in one quarter, their profits have been very, very bad, very, very low. If I have one share in Ultratech, then my portfolio fully will not get affected. Only that company's that share will get affected. This is unsystematic because this is not applicable to every company. But what if I put all my money only in Ultratech? Then I will be affected very badly. So how to avoid this? It can be reduced or eliminated by diversifying the portfolio. I should not put all my money in one single company. That means this can be avoided. The second one is systematic risk. This is macroeconomic, inflation, government policy, interest rate, RBI policy, etc. Suppose there is a high inflation. Suppose there is an election and result comes, and now we know that a new government is going to come in the country, or in the budget they increase the tax rate, or there is a war situation because of which government has stopped all the infrastructure and development related work and money is diverted towards security, army, etc. When that happens, this is not going to impact only one variety company. This will affect whether I have money in cement company or in steel company or in information technology company. All variety of company stocks will get affected. Lockdown was also one such example. All company stock prices were very, very low during lockdown because that was common to every company. This is non-diversifiable. Why I cannot diversify? I told you. Wherever you invest, if there is a lockdown, whether it is cement company or steel company or a hotel company, all of that will get affected. As diversifiable risk can be eliminated, the non-diversifiable is a risk which cannot be eliminated. Therefore, business should be more concerned on non-diversifiable risk, and that is measured by the term beta. Now, beta is a measurement of risk. In simple, how to understand this? If beta is very high, then understand the risk involved in such company is very high. If beta is very low, now very low doesn't mean zero, a little above zero, then the risk involved in such company is also very less. What is the meaning of beta equal to 1? Risk in one company, that is say in my example Ultratech Cement, is equal to risk in any other company share in the stock market. Whether I put money in Reliance or Ultratech or Maruti Suzuki or Tata Motors, the risk involved in all these companies is same. That is when the beta is equal to 1. Practically speaking, beta 1 is a very rare phenomena. You cannot say risk of investing in Ultratech is same as risk of investing in Reliance Industry. Level of risk will be different. Can the beta be equal to 0? Beta will be 0 only if you put money in bank FD. That is, risk is 0. Even if there is COVID lockdown, you will get interest. If you invest in government bonds, your interest is sure, short. There is no question on whether I'll get 8% or 10%. Whoever is in power, whatever be the tax rate, whatever may be the inflation situation, if you have purchased Government of India bonds and if the rate of interest is 8%, surely you are going to get 8% at the end of year. Now, you see this. Any investment I make, suppose risk-free rate is 6%. Any investment I make, I need minimum 6% because I can stop this investment and put the money in bank and that bank can give me 6% interest. I am investing in a business, say hotel business, textile factory, two-wheeler, four-wheeler dealer. All these businesses have got element of risk and that risk is measured by beta. So the more you go this side of the graph, higher is the level of risk. So because the level of risk is more, the additional return that I am expecting will also be more, and this is called risk premium. If the risk premium is 8%, then from my investment, what I expect is 6 plus 8, 14%. If the risk level is very low, then it may be just 6% plus 1% more. I need 7%. So one thing is clear, I surely need 6%, correct? Because I can get that even by putting money in bank FD. If I am investing in a business, surely I need little more. How much more depends on the level of risk, and that risk is measured by the formula beta. That's why you see the formula here. Risk-free return, say 6% plus RM minus RF. I can invest in any other company in stock market, and that is giving 12% interest. That means I can put money anywhere, I'll get 4% more. But the risk involved in this company measured by beta is 2 times. That means I need 6 plus 2 times of 4. That means 8. So 6 plus 8 I need 14%. That depends on the risk involved. Another company, if beta is very high, then this will be 3. Accordingly, this final answer will also increase. Okay. Mark this important, make a note somewhere. Both theory and practical concept of CAPM is very important. Please make a note somewhere. They can ask a 4 marks theory question, or it can be a small problem. Now RF is government bonds, bank FD, treasury bills. Sometimes they write it as T bills, which is treasury bills. Done. The last part is cost of retained earnings, KR. Now KR and KE most of the times will be same. There is a logic why it is going to be same. Understand, who is the owner of reserve? Ultimately the equity shareholders. So they gave you 100 rupee. From that they are expecting 15%. You made some profit, but you did not give dividend. You kept it as reserve. From reserve also they expect same rate of return. That means most of the times KR is equal to KE. But the only difference in terms of formula is, for the purpose of cost of equity, P is net proceeds, that is issue price minus flotation cost. But if you are working out KR, you can directly take market value. You don't have to take issue price. The reason is you are not issuing anything to anyone. Your own reserve, you are using it. Number one. Number two, there can't be any flotation cost. Flotation cost comes into picture only if you issue something. ROC charges, security transaction tax, underwriting commission, all of this basically, SEBI duty, charges, etc. This will come into picture only if you issue shares or debentures or bonds. When you are using your own reserves in surplus, where is the question of paying flotation cost? And why am I not taking issue price? Whom are you issuing anything to? Anybody, correct? It's simply your own money. Reserve was kept, now you are using it. Therefore, number one, no question of issue price, simply use market value. Second, no question of flotation cost because you are not paying any flotation cost to anybody. Now, we have studied 4 things in total as of now. One is KR, that is cost of, sorry, we have studied first KD, and then we studied KP, correct? And then KE, and finally KR. Most of the times this can be same, but 1 or 2 exceptions I just now told you. When issue price and market value both are given, this can slightly change. Now suppose we have got 100 rupee from debt, 120 from preference, 80 rupee from equity, 20 rupee from reserve. Now my company is funded with all 4. Now when I put all 4 and then KD say 8%, KP 9%, KE and KR, let's take it equal 12%, 12%. When I do the average of all of this 100 comes at 8%, this 120 at 9%, this 80 and 20 is at 12%. That total is called weighted average cost of capital. How to do it? See here. Equity shares and debt. Suppose I have 6 lakh and 14 lakh. I have just taken basic numbers. I have to do the total, that is 20 lakh, then assign the weight, which is 6 lakh by 14 lakh, 0.3 by 0.3 and 0.7, 6 lakh by 20 lakh and 14 lakh by 20 lakh. Sorry. Then cost of capital. Example, this will come from all the formulas we studied in last half an hour, and then you multiply, you get WACC. Now WACC can be done either using book value or market value. For book value, all these numbers will come from balance sheet. Equity share capital from balance sheet, reserves and surplus balance sheet, debenture balance sheet, preference share capital also from balance sheet. But if you have to do it on market value basis, it won't be balance sheet numbers. You will multiply number of shares by the market price of share. Number of debenture into market price of debenture. I will show you one or two questions later. Now, this portion I will come back little later, this reserve and this example. Let us first go through one or two basic sums on WACC. I'll then come back. Example. A company has equity share capital, reserve, preference and debenture. Remember all of this, these are all book value numbers. Market price of equity given, growth rate, dividend given, growth rate given, 40% tax. You are required to compute WACC using market value RTP question. Now for market value, I can't take 4 lakh, 4 lakh, 2 lakh, 6 lakh because these are all book value figures. For example, you see equity share capital, 40 lakh shares of 10 each. What is 10? Book value of one share. But how much is market value given here? 60 rupees. Correct? First what they did, they calculated cost of equity, cost of debenture, cost of preference, they took 12% as it is, and retained earnings or reserves and surplus, as you can see, is not there at all. In the question, if you observe, there is reserves and surplus, but in the answer they have shown only debenture, preference and equity. Why is reserve not taken? Because the question was under market value basis. Now comes the doubt, why reserves are not taken when WACC is done under market value? Understand, for equity share there is a market value, it can be bought and sold. For debenture there is a market value, in share market you can buy and sell. For reserve there is no market value because reserve cannot be bought and sold. I can't keep equity share of Reliance and only sell the reserve per share to you. If I want you to enjoy the reserve, I should sell the share. That share comes with power to enjoy future reserve. Therefore, whenever you are doing market value WACC, you do not have to consider reserves and surplus. But if the same question was under book value, then you have to take reserves and surplus also, because reserves and surplus has book value. It has no market value, it has book value. So 9% debenture, they found out market value, weight is given, weight is calculated 32 crore. So 6 crore by this, 2 crore by this, 24 crore. And then cost of capital is available in the working note. You multiply, you get the number. Now understand, equity share capital, everyone, important concept, and I had kept something pending that is to be discussed now. Book value 10, how did this became 60? Why is someone paying 60 rupee for a share whose book value is just 10 rupee? They are doing it because they know that book value of the share is 10 and the share has so much of reserve. You go to the balance sheet, reserves and surplus is 4 crore rupee. And who will enjoy this 4 crore rupee? The same 40 lakh shareholders will enjoy this also. That means when someone is ready to pay 60 rupee, the market value of equity share has some equity component and some reserve component, and that is why we directly take the 60 rupee here. We don't have to take reserves and surplus. The 60 has share capital amount and also reserve amount. That is why I don't have to write it separately. What if this question was under book value? I would write both. Share capital 4 crore and reserves and surplus also will be 4 crore. That time I told you by default KE and KR is same. Imagine if the same question was under book value. I'll write it here. If the same question was under book value, then I would have taken equity share capital, I would have taken reserves and surplus, then preference share capital, and finally debt. Because under book value, remember, reserves and surplus should also come because reserves and surplus have book value. The only problem is they don't have market value. So I'll copy all the numbers from the question table, and anyway, cost that is cost of equity, cost of reserves are same in both the cases. Therefore, I will be taking same number, or I can even club both and write, because anyway I am multiplying two different numbers here, the amount with the same cost of equity and cost of reserve. If this is also 15%, this is also 15%, why should I write 4 crore here and 4 crore here separately? I can instead write equity, share capital and reserve, and together I write 8 crore into single number 15%. That was the story that was given there. Here, reserves are to be ignored while doing market value. Logic, we can't buy and sell reserve. They're not independently saleable. Market value of equity share represents both paid up capital as well as retained earnings. And that was the same thing that we learned here. I have given one more example here. Question starts from here. Companies present, look at this. Book value, capital structure, debenture, preference and equity. All of these are book value numbers. Later, all these securities are traded in capital market, market price, recent prices, debenture, preference and equity 22 rupee. Now you see in the answer, just a second. If you see in the answer here, when they worked out WACC book value, they copied 8 lakh, 2 lakh and 10 lakh, and this they copied from the question as it is here, 8, 2 and 10. But later when they had to do the same answer under market value, they first calculated, look at this, 8 lakh rupee by 100, they calculated number of debentures multiplied by 110, that was the market price. And same way, 2 lakh by 100, they calculated number of equity preference share multiplied by market value, same way one more. And then they did the total, assigned the weight into specific cost, and this specific cost will come from the working note, cost of debt, cost of preference and cost of equity. Now which formula did they use? Interest into 1 minus t, RV minus NR by N, RV plus NR by 2. That means this question is with redemption, correct? Here you observe 100 rupee per debenture redeemable at par, that means redemption is at par, given 10 year later, 11% coupon rate means interest rate, 4% flotation cost. Here one doubt that many students have. If they give 4% flotation cost, should I apply the flotation cost on book value, market value or issue price? It's always issue price. If issue price is not there, I already told you, take it as book value and give a note. I told you. This is what I told you few minutes back. Logically speaking, if issue price is not there, we should go by market value, but in study material, in many cases, they have gone by book value. So basically, whatever is the price at which you are issuing, on that you apply the percentage. Understand in simple, this as a transaction value. If it is happening at issue price, book value, then book value. Here they have given sale price means issue price 100. When issue price is given, in all the answers, you take issue price only 100, 122. That is why if you see, they have taken 100 redeemable value at par, net receipt 100 minus 4% flotation cost 96 rupee. Here also same way, but 1 minus tax has gone because it is preference, correct? And PD has come, there is no I, because you are paying dividend to preference shareholders. Here also net proceeds redeemable at par, even this one. Net proceed, because they said sale price means issue price 100, but the flotation cost now is 5%. They have taken 5%, 100 minus. And once you get this cost of equity D1 by P0, why D1? Because they have given that the dividend is to expected to grow at the 7%. That means this is the third formula, dividend plus growth adjustment, and that you can see here. And once they get 3 percentages, book value, market value table, and they find out WA. One more question. N Limited wishes to raise capital of 10 lakh rupee for meeting their modernization plan. It has 3 lakh in the form of reserves and surplus already. They have some money with them. The following are the further details. Debt equity mix 40-60. That means this 10 lakh will come in the ratio 4:6, 4 lakh and 6 lakh. Cost of debt up to 1,80,000 you pay 10%. Beyond that you pay 16%. That means if you are taking a 4 lakh loan, first 1,80,000 you pay 10%, above that you pay the balance interest. Earning per share, dividend payout, that means 2 rupee dividend out of 4 rupee, growth rate given, current market price, tax rate. Determine the pattern of rising the finance. 10 lakh into 60, 10 lakh into 40, 6 lakh, 4 lakh. By the way, out of 6 lakh, you already have 3 lakh rupee retained earnings. That means balance will come from fresh issue of equity share. And then debt, 10% on 1,80,000, balance, that is 2,20,000 at 16% interest. Second, cost of debt. How much will be cost of debt? For 1,80,000, you have to pay 10% into 1 minus t. For balance 2,20,000, 16% into 1 minus t. They have taken this divided by total 4 lakh rupee into 100. Same way, they want you to even do cost of retained earnings and cost of equity. KR and KE will be same because there is no flotation cost or market price. They took D1 by P0 plus the growth rate, same formula we discussed some time back. And once you get that equity, you see including retained. Why including retained? Anyway, this is 15%. Even if you write 3 lakh, 3 lakh separately for reserves and equity, you'll then multiply by same 15%. Therefore, they said I'll take 3 plus 3 full 6 lakh and then multiply by 15%. Debt is 4 lakh and then they added 11.66 is the WAC, right? Mark this question important. They've asked repeatedly this debt equity mix type questions. Even in study material, you have 2-3 questions on this. Good, some important. Yes. So with that, we are done with chapter 4, cost of capital. Yes. Next topic is capital structure. Now, capital structure basically means deciding the right composition of total capital. Capital is the fund that you need. I already told you. Whether the money should come from equity or debt or preference share or from reserves. And if I'm going to get some money from all these sources, what should be the composition of all of this? Should I have more debt, less debt, more equity, less equity, equal amount of debt and equity? This discussion is capital structure. See this. Capital structure is the combination of capital from different sources of finance. The capital of a company consists of equity shareholders fund, preference share capital, long term outsider debt, external debt, basically means bank loan or debenture. The source and quantum, that is from where to get, quantum is how much to get, depends on three factors: control, risk, and cost. What do I mean by control factor? When you have less equity share capital, there will be less number of equity shareholders. And when you have less number of equity shareholders, all of them will earn good amount of return on their investment. And all of them are owners of the company. When number of equity shares increase, there will be too many equity shareholders, and when you have too many equity shareholders, the control gets diluted, earning gets diluted. Earlier 1,000 shareholders, but this year we have 5,000 shareholders. Earlier only 1,000 people would participate in AGM, now 5,000 people. Earlier only 1,000 owners, now there are 5,000 owners. Whatever was earned by company earlier was shared among 1,000 people, now that has to be shared among 5,000 people. Everything is getting diluted when you have too much of equity share capital. That means you have to keep this as the first factor in mind. It is better to have less owners than having too many owners. Now, if you want to have less owners, then from where should you get money? If not equity share, then the next best option is getting money from debt. But the problem with debt is, second, debt is risky. Why risky? Irrespective of whether you make profit or loss at the end of the year, you have to pay them interest. Number one. Number two, debt comes with a definite lifespan: 3 years, 5 years, 8 years. After that, you have to compulsorily redeem debt. Correct? That means if you take loan today and it has to be redeemed within or repaid within 3 years, then you will have a huge outflow at the end of third year. Suppose I issue debenture to you. Today I collect money. I have to repay you after 3 years. Today I am happy I got the money, but I know at the end of third year I should have enough money to repay that loan to you. But if it is equity, there is no question of repayment and no question of redemption of any equity share. Not only redemption, when I have debt, end of year, whatever is my profit, or even if I am in loss, it is compulsory to pay interest to the debt providers. This is another risk. Number one, risk of repayment, huge cash outflow. Number two, risk of compulsory interest that is to be paid. But if I am taking money from equity shareholders, number one, I don't have to pay anything compulsorily at the end of year one, year two, year three. Number two, I don't have to even repay the money to them because there is no question of redeemable equity share. You have never studied anything called redeemable equity share. You will redeem the money only when the company is closed. And in liquidation of companies, you have studied this also. You will pay them only after paying it to everybody. That means at the end of paying it to all outsiders, if nothing is left, you won't pay anything to equity shareholders at all. That means eventually no guarantee whether they will get money or not. The third factor is cost. Understand debt is cheap. Why is debt cheap? Because the one who is giving you debt money, either banker or debenture holder, they take very less risk. Why am I saying they take very less risk? Their interest is to be paid compulsorily. They are secured, correct? Well, if a bank is giving me loan, they will first take the security and then give loan. When bank has given me loan by taking security or even debenture, if I am not able to repay the loan, they have an asset. They can sell that asset, they can take that cash because I've given that as a security and I've taken loan or issued debenture. When there is a security, the risk taken by debt providers is less. When the risk is less, the return that they expect will also be very less. Correct? Return to debenture holder is cost to the company. But equity shareholder, because they take unlimited risk, the return expectation will also be high, very, very high. So, return expectation to equity shareholder is the cost to the company. Therefore, debt is cheaper, equity is costlier. So, if you combine all the three, there is no one line solution as to whether debt is good or equity is good. We can't even say debt equity of 50-50 is best. Even that cannot be considered as correct because we will learn little later. You cannot say 50-50 or the equal mix is good. Many people, they know all the advantages of having debt, but one question comes whether they have the ability to handle the financial pressure or distress that is caused if there is debt. If a company is running with loan, they have a pressure which the other company which has no debt will never face. Suppose I am a company earning with debt. So one thing that is in my mind always is I should earn minimum so much money so that I can pay the interest. Suppose interest is 27,000 rupee. I know at the end of year earning before interest and tax should be at least 27,000 rupee because I have to pay that much of interest, bare minimum. But if I'm running with only equity, then there is no compulsory payment. So even if I earn 2,500 rupee, I'll be happy because there is no compulsory interest to be paid. So two variety companies, a company having debt will always have this in mind that they should earn minimum amount that is equal to interest that they have to pay. But a company which is funded fully by equity, they do not have this headache at all. Even if they earn 225 rupee, they are happy. Only pay income tax, balance money can be enjoyed by equity shareholders. So there is no answer as to which is correct. Don't even think 50-50 is the correct answer. Debt equity should be in equal proportion. No book says that. Now, why knowing this is important? Understand, more debt, less debt, more equity, less equity, all of that will ultimately impact cost of overall capital, that is WACC. Imagine debt is cheap, equity is costly. You have very high debt. What happens? WACC will be less because weightage of debt is more, which is cheaper. WACC comes down. Weight of equity. Suppose if that is more, equity is very costly. Weight is also more, cost is also high. When you multiply and add, WACC will also be very, very high. Right? Therefore, If your cost of overall capital is less, automatically value of the firm will go up. Again, value of the firm. Firm means business here. Now, a firm has a perpetual life or a business has a perpetual life. Anything that has a perpetual life, how to find out the value? How much you are going to earn from the business, which is EBIT divided by how much is the overall cost of capital. Overall cost of capital is nothing but KO or WACC. Now, if I want to increase the value of the firm, two ways. Observe here. The first way is, suppose EBIT is 100 and cost of capital is 10%, 100 by zero point 0.1, value of the firm will be 1000. If I want to increase the value, what is that one thing that I can do? Reduce the cost of overall capital. If that comes to 8%, 100 divided by 0.08, this will automatically go up maybe 1200 or 1250. That means value of the firm will go up when cost of overall capital comes down. Basic thumb rule. Value of the firm goes up when cost of capital comes down. Or what is the other approach? Let this be 0.1. You try and improve the EBIT, that is profit. If this goes to 120, then 120 by zero point 0.1 also 1200, value can go up even in this approach. But increasing EBIT means what? Increasing EBIT means you have to increase the profits. Profit, this is based on sales minus variable cost minus fixed cost. This is not financial management area. This is the cost accounting area, variable cost and fixed cost. Therefore, in this chapter, where we are learning capital structure decision, our focus will be more about the WACC, that is denominator. Try to bring this down to increase the value of the firm. And how to do it? There are two theories, relevancy and irrelevancy. One common thing in all these approaches, relevancy and irrelevancy, there are only two kinds. They make some assumptions. This assumption is common for the entire chapter. First one, there are only two kinds of fund. One is debt, another is equity. That means there are no preference share capital. The total asset of the firm is given. The total asset, if you know, that means the liability side, total liability also you know. And if you exclude the current liability, balance is all funded by either equity share capital or long term debt. Taxes are not considered. There is no tax at all. Now, if there is no tax, from EBIT you pay interest, you get EBT, that itself is EAT. And since there are no preference shares also, just now I read first assumption, EAT itself will be available to equity shareholders. Dividend payout is 100%. That means companies don't keep any reserves or retained earnings. Business risk is same for all the businesses. That means if you are comparing two garment factories, two construction companies, the risk taken by both the construction company is same. The firm has perpetual life, I told you at the beginning. Now the first approach is relevancy approach. This chapter, both theory and practical concepts are important. Okay, please make a note somewhere. They can ask you to write short notes on any of these approaches. They can ask you short notes on any of these approaches. There are total 4 approaches, basically under 2 categories. First, relevancy model, under that 2 approaches, then irrelevancy, under that 2 more approaches. Let us begin. First, relevancy model. Under this approach or this model, capital structure decision of the firms are relevant. Change in capital structure will impact the value of the firm. Now, first is net income approach. Capital structure is relevant to the value. See this. Very important sentence. Many students find it difficult to get this. An increase in financial leverage. An increase in financial leverage. What does it mean? Increase in debt. That means more debt you have, high financial leverage you have. will lead to decline in the overall cost of capital. That means you want to reduce the overall capital cost of capital, you have to increase the debt. And we already know if WACC comes down, value of the firm goes up. The first formula I discussed 10 minutes ago. When WACC comes down, value of the firm go up. Conversely, opposite. If you have less debt, then it will increase the WACC and that will decline the value of the company. On what basis they are saying this? Observe this. Leverage means level of debt. The more you move this side, understand more debt you are planning to take. The more you move this side, more debt you are planning to take. Now what is happening as per this graph? KD remains same. Sorry, KD remains same. What is the meaning of answer? If loan is available at 8%, it will be available at 8% only. Whether it is first loan, second loan, seventh loan also, all loans will come at same rate of interest. Cost of equity, suppose if it is 12%, equity shareholders also expect same 12% return. Now the more you move this side, you observe cost of overall capital is coming down. How will this happen? Suppose I have 100 debt, 100 equity. This is at 8%, that is at 12%. What I did, I increased the weightage of debt, made it 120, reduced equity to 80. Now what happened? The cheaper source, which is debt, I am increasing. The costlier source, which is equity, I am decreasing. Automatically WACC will come down because I am taking more money from cheaper source and less money from costly source. Now go one step further, make debt as 140 and equity only 60. Again, I am taking more and more and more of cheaper funds. Therefore, my overall cost of capital will further fall. But if I make it further 160, 40, 170, 30, and so on, the more and more and more you go this side, overall cost of capital keeps coming down. That means this approach is in favor of unlimited debt, or I would say maximum debt. It says as much as debt is available, take it. More debt you take, debt is anyway cheaper. Higher the debt, lower will be the overall cost of capital. Right? Value of the firm is equal to value of equity plus value of debt. This is the formula. See this. Under this approach, value of the firm will be maximum at a point where WACC is minimum. I told you in the formula. What was the formula? Value is equal to EBIT by WACC. If you reduce WACC, value goes up. And when will the WACC or KO comes down? The more and more you have debt in the capital structure. Thus, theory suggests total or maximum possible debt. That's what I told you. As much debt as possible you take, and that is what it suggests. Value is EBIT by value of the firm. The same thing that we studied there. What was the formula there? Value is equal to EBIT by KO. You just have to move it here, cross multiply and move it here. It's the same formula. Actually, you don't have to understand this as two separate formulas. Market value of equity. Again, value of anything. I told you again and again already. Value of anything, if it is perpetual, what are they going to earn? Earning available to equity shareholder. Why? I am taking market value of equity. I should not take EBIT. Correct? When I did value of firm, I took EBIT because firm as a whole earns EBIT. But I am an equity shareholder. For me, what matters is only earning available to equity shareholder divided by what is the rate applicable to me, cost of equity. Again, this is a perpetual income. As an equity shareholder, I will earn this money forever. Thus, according to this approach, firm can increase the total value by decreasing the cost of capital. And how to decrease the cost of capital? Increase the leverage. Increase the leverage means increase the level of debt. But there is one problem. The only assumption is any additional debt will come at same rate as present debt. If you see in this graph, this line was a straight line. This line, you can see KD 8% is a straight line. What does that mean? Your first loan, your second loan, your third loan, even if you take 5 loans, 10th loan also will come at same 8%. That's why KD is a straight line. But the problem is, in reality, KD won't be a straight line. Why? First bank manager may give you loan at 8%. Second bank manager will not give at 8%. He will expect higher rate because he is taking high risk. Why is he taking high risk? Because you already have one loan. Giving loan to someone who already has 7 loans is more risky than giving loan to someone who has no loan at all. So the seventh, eighth, ninth banker won't give you loan at the same rate of interest. So KD being a straight line is practically not correct. And that's what traditional approach is. And you observe one more thing in my previous graph, even the KE was a straight line. What do I mean by KE being straight line? Equity shareholders expect same rate of return. Now think about it. If you are an equity shareholder and you are expecting 12% return from the company, when they take more and more and more and more debt, as an equity shareholder, even you will start finding it to be very risky. Because when a company has too much of debt, they have to first pay interest to them. Correct? So that's a financial commitment, financial burden to them. And when that is more, then as an equity shareholder, you will also start finding it to be very risky to stay in such companies. Last year, we had only one loan. On that, we had to pay interest. Balance was enjoyed by equity shareholders. But this year, balance sheet, there are 3 loans. That means I should first pay interest to all 3 of them. Then only what is left out I'll enjoy as an equity shareholder. What if next year you have 5 loans? Next to next 8 loans, 10 loans. You will also start finding yourself to be in a very risky situation. Therefore, the traditional approach. See what it says. The rate of interest on debt remains constant for a certain period. Thereafter, it starts increasing. First loan, second loan may come at same rate, but the fourth, fifth, seventh, eighth loan will be at a higher rate because that bank manager, the seventh or the eighth loan provider, he will find himself to be in a very risky position. Second, as and when company goes for higher and higher debt, equity holders start seeing higher risk. Why? Debt has to be repaid. Debt interest is to be compulsorily paid, and that is paid even when there is loss. So equity shareholder will find such companies to be high risky company. When their risk goes up, their return expectation also will go up. Now, combined effect of 1 and 2, whenever company borrows excessive debt, WACC will start increasing and value of the firm will decrease. And if I have to put it in graph, you see here, cost of debt earlier in the initial phase may be same. First loan, second loan may be available at same rate of interest, but after that loan rate also starts going up. And equity shareholders initially they may not expect very high rate, but once the level of debt goes up, even their expectation will start shooting up. That means because of debt, up to a point you can see, up to a point the cost comes down, but after that the cost starts going up. That means taking debt is good only up to this level. Having debt is good to you because it will bring down the cost of overall capital. After that, taking debt is not a preferred decision. That means you should know when to stop taking debt. The previous graph said keep taking debt. The WACC graph, the line will come down. But that was correct when this was a straight line and this was also a straight line. Correct? Now these two lines are not straight. Therefore, don't expect the overall cost of capital to come down. I have given a small example to you. Here you observe. Company is thinking of any of these 7 options. They have given cost of debt 11, 11, 11.6 and so on. And here cost of equity, percentage of debt. What do we mean by 0? There is no debt. That means this is fully funded by equity. When it is fully funded by equity, KO will be full 13% because there is no debt at all. In second option, 0.1 means 10% debt, 90% equity. Now what happens to KO? 10% debt, 0.1 into 11% cost of debt plus if 10% is coming from debt, 90% will come from equity and that should be multiplied by 13. You add both, you get WACC. First one I did not do because this was 0. This was 1 into 13. What is the use? Same 30. Like this, if you work out all 7, you will start realizing that Up to a point it comes down, and after a point it will start shooting up, and that's what I told you, that's what the graph said. Because of excessive debt, remember, up to a point this is good. Even equity shareholders expectation will start going up. Because of the combined effect, up to a level this will come down, later it will start going up. This is the optimum point. Up to this, that is good. After this, it is not preferable. Therefore, how will you select which is the best option out of 7? The option where KO is lowest. That may happen in second or third option. When you roughly work out, you will get to know. So the next model is irrelevancy model. The first two models, as the name suggested, relevancy model, whenever you change the composition of capital, the WACC was coming down, and whenever WACC comes down, value of the firm goes up. Irrelevancy model believes that whether you have more debt or less debt, or even no debt funded only with equity, value of the firm will not change. Name itself says irrelevancy model. Very important. Understand this. Capital structure decision is all about having more debt or less debt, more equity, less equity. This chapter is all about this. But irrelevancy models believe that whether you take more debt or less debt or even no debt, that will not make any difference at all. That means a company funded with fully equity versus a company funded half debt, half equity has no difference in their total values. They believe KO won't change, and if KO is not changing, value of the firm also will not change. See this. Capital structure decision of the firm is irrelevant. Any change in the leverage, that means more debt, less debt, will not lead to any change in the value of the firm. And the market price, as the overall cost of capital, is independent of degree of leverage. Very important theory question is this irrelevancy model. They can ask either net operating income or the next one, approach. Now, net operating income believes that, see here, additional debt will not come at high interest rate, same logic used in net income, and interest rate of existing debt and additional debt will remain same. Thereby, additional KD keeps bringing down WACC. This assumption is more like what we studied in the first one. KD remains same, so more and more debt you add, WACC tries to come down. But this effect is apparently offset by an increase in KE, and this is what we studied in traditional approach. The more and more debt you take, equity shareholders' expected rate of return goes up. This happens because equity shareholders seek higher return as they're opposed to greater risk due to excessive debt. If you take too much of debt, they won't like it, and when they find it to be high risky, their expectation also will go up. In conclusion, additional debt will bring down WACC, whereas it will get offset by increase in cost of equity. If you see the graph, you will understand. KD remains same, and when KD remains same and more debt you take, what happens? The overall cost of capital tries to come down. This is what we studied in the first graph. But because you have taken too much of debt, equity shareholders will start expecting more. So whatever was trying to go down will go up now because of cost of equity. Net net, wherever it was, it will remain there only. Overall cost of capital will not move. One will try to come down. KD is trying to bring down WACC, whereas K is trying to take it up. Net net effect, it will remain at the same point. And remember, KW means cost of overall capital or weighted average cost of capital. If this graph, if this line remains same, what happens? WACC is same. That means value of the firm also will remain same. If value of the firm remains same, then now you know the meaning why they said it is irrelevancy. Whether you have more debt or less debt, they believe it is irrelevant. Approach is also another approach under irrelevancy theory. Mark approach important for both practical and theory. Everybody. Please mark it. Important. Both theory and practical, or make a note. Now, approach has two explanation. One is without tax and one is with tax. Now, in exam, how to decide whether to work out under without tax approach or with tax approach, that depends on the question. Sometimes they say with 30% tax you solve the problem. Sometimes they won't mention. So depending upon that, you do the answers. Now, again, this approach believes that value of the firm remain unchanged irrespective of change in the capital structure. We know this, that's why it is under irrelevancy heading. They come with four assumption. Capital markets are perfect, all information is freely available. That means only few people are not in a position to influence the overall share market. Everyone has freely available information. No insider trading, no leaking of confidential information. 3, 5, 10 people can't change the share price because they know something which others do not. Second, all investors are rational. People don't buy randomly. They buy only if they are convinced that buying a share in this company is a good decision. Third, firms can be grouped into equivalent risk classes. That means if there are two construction companies, both can be considered as companies having same business risk. Non-existence of taxes, they believe there is no tax at all. The value of the levered firm can neither be greater nor lower than that of an unlevered firm according to this approach. Now, what is this levered and unlevered? Levered firm is the one having debt. This has debt and equity. Unlevered firm is the one having no debt. Understand, leverage means advantage, and advantage comes only if you take risk, and the risk is taken only if there is debt. So, in conclusion, if you call your company as a levered firm or leveraged firm, that means you have some debt. If you say there is no leverage, that means there is no advantage because of debt. The two must be equal. That means value of levered firm is equal to value of unlevered firm. There is neither advantage nor disadvantage of having debt in the firm's capital structure. Therefore, in simple, what did they say? You want debt, take it. You don't want debt, don't take it. Having more debt is good, having less debt is bad. There is no logic as such. You have debt, you don't have debt, that will not make any difference. That's a simple conclusion. Since the total investment value of the company depends upon underlying profitability, it is invariant with respect to relative change in the firm's financial capital structure or capitalization. So they believe that you want to increase the value of the firm, don't try to reduce this KO. This can't be reduced. That's what they believe in irrelevancy model. Then what is the only option now if I want to increase the value of the firm? Increase the profitability. Net operating income. Operating income means day-to-day income, which is EBIT. So you want to improve the value of the firm, then try to improve the profits. Don't try to reduce KO because it cannot be reduced. This approach was in 1958, where they believed no taxes. 5 years later, in 1963, they came with tax, and when there is tax, they recognized that value of the firm will increase when taxes are there. Now, what happened? Whenever there is debt, observe, whenever there is debt, there is interest, and whenever you pay interest, there is tax saving, and because of tax saving, value of the company having debt will be more than value of the company not having debt. Value of the company having debt means levered firm value will always be more than unlevered firm. Now, in exam, there are few things that you should check. Okay, I will dictate, it is not printed here. Just make a note of these points quickly. Make a note of this. If you are working out some without tax, if you are working out a sum without tax, value of levered firm will be equal to value of unlevered firm. That means having debt, not having debt will not make any difference. And WACC of levered firm will be equal to WACC of unlevered firm. Same way, write it once again. I will just overwrite here so you understand the difference. If you are working out, you write it again. If you are working out with tax, quickly make a note. If you are working out with tax, then value of the levered firm will be greater than value of unlevered firm, because they believe that there is a tax saving, and tax saving gives you benefit, and that benefit is the additional value. Whereas WACC of levered firm will be lower than the WACC of unlevered. Why WACC is less? When you pay interest to debt, there is a tax saving. Earlier KD was 8%, but now KD will be 8% into 1 minus T. There is 30% tax that will come down. And if KD comes down after tax, when you are working out under with tax approach, if the KD comes down, WACC comes down. That's why WACC of levered firm is less than WACC of unlevered firm. In exam, listen to me for a minute. Any sum under approach, first check whether it is without tax and with tax. And remember these 2 points. You will get to know your answer is right or wrong. Without tax, value of the two firms should be equal, and WACC should be equal. If it is not equal, then there itself you know answer is wrong. Clear? And if you are working out with the tax, then having debt is good now because there is a tax saving. Therefore, value of levered firm, levered is the one having debt, should be more than the value of unlevered firm, and WACC of levered should be less than WACC of unlevered firm. If this is not matching, then your answer is wrong. There itself you know. Correct? The next concept is financial break-even point. Listen, we already know something called break-even point. It's the level where profit or loss is equal to 0. Similar logic, financial break-even point is a level of EBIT where you are earning enough money to pay interest, taxes, and preference dividend. That means earning available to equity shareholders will be 0. If a company crosses financial BEP, equity shareholders will get something. Read. It denotes the level of EBIT which is sufficient to cover interest, tax, and preference dividend. In other words, it is a level of EBIT at which earning available to equity shareholder is 0. That means if interest is 2 lakh, if company is earning exactly 2 lakh EBIT, now what happens? EBIT 2 lakh, interest 2 lakh, 2 lakh minus 0, 2 lakh minus 2 lakh is 0. From there, everything is 0. What if company is earning 4 lakh? There is 2 lakh debenture interest, 2 lakh preference dividend. Correct? Now the money will go in paying only these guys. In between, you have to pay tax also. Therefore, if the company is earning more than financial BEP, I am writing it as FBEP, financial BEP, only then understand equity shareholders are going to get something. Otherwise, equity shareholders will get. One more concept is EBIT, EPS indifference point. I have given a small table here. Equity share capital, debt, total capital. I have kept total capital same in all 4 examples, but I've only changed the composition. You can see 1 lakh here, 150, 50 here, 50, 150, 180, 20. Total capital remains same, but the composition is different. I've even kept same EBIT, you can observe. That means both are same. Total capital is same and EBIT is same. But what happens to EPS? You see the workings. As I go down, from EBIT I pay interest. Interest rate is 8% on 1 lakh in first column and so on. EBT minus the tax, EAT, I have to divide by number of equity shares, and if I see my EPS is changing every time. Which means, though the total capital is same, Though the EBIT is also same, EPS is different because the composition of capital is different. Correct? Now, what is indifference point? It is that level of EBIT at which EPS remains same irrespective of capital structure. That is, whether I have more debt, less debt, only debt, debt and equity mix in any different ratio. Here I can see 4 different combinations and 4 different EPS. I want the EPS to be same. How much should be my EBIT? How to find out? Ultimately, what I want, EPS of option 1 should be equal to EPS of option 2. Correct? How to do EPS? EBIT minus interest minus tax minus preference dividend divided by number of equity share should be equal to one more. EBIT minus interest, the formula is same. You have to work out by keeping EBIT as X and minus interest will be available in the question, tax rate will be given. After doing all the equation, suppose X comes to 3 lakh. What is the meaning? If you earn 3 lakh rupee EBIT, if you go by say first capital structure, I'll just erase this. Whether you go by this option 1 lakh 1 lakh or you go by 1 lakh 50 and 50, if your EBIT is 3 lakh, EPS will be same. That's why it's called indifference point. There won't be any change in the EPS. That's the meaning. Now, one thing for many students, when you keep this as X, if these numbers are in lakhs, suppose debt is 20 lakh, interest is 10%, X minus 2 lakh minus something, there will be too many numbers and then you'll have to do cross multiplication also because there is an equal in between to get the value of X. If you don't want to write big numbers, at the beginning itself write on top all amounts are in thousands or all amounts are in lakhs. So finally your answer will be 3. 3 means 3 lakhs because your answer is in lakhs. Otherwise, you will end up cross multiplying big numbers, something like this: X minus interest of 2 lakh minus 30% on X minus 2 lakh and so on is equal to something, and then cross multiplication you will have 7 zeros, 8 zeros. And in the class also, remember, we have done mistakes in this with too much of multiplication. On top itself, you write rupees in lakhs. Simple. Now, this is the formula when I have only 2 options. What if I have 3 options? I can't work out something equal to something equal to something. Correct? Then you have to do for option 1 and 2, 2 and 3, and then 1 and 3. Correct? Is there a possibility X and X gets cancelled and I can't get the indifference point? Yes. If I do proposal 1 equal to proposal 2 or option 1 equal to option 2, X minus something and so on, like I showed you just now, it may so happen that X and X gets cancelled. Now, if X and X gets cancelled, you will not have any answer at the end. If I don't have any answer at the end, what does it mean? There is no indifference point. Correct? In exam, you will be stuck. When X and X gets cancelled, you don't know how to proceed. That is not wrong. I'll show you one example now itself. Here I have the example. If you cannot find out indifference point between 2 proposals, nothing wrong. You will be stuck at some point and right there itself, there is no indifference point. What is the meaning of this line? There is no indifference point. EPS can never be same. Whatever may be the EBIT, EPS between these 2 options can never be same. And that can happen in exam. Don't worry if you are stuck. Again, I am repeating, when you work out indifference point, it may so happen that you won't be able to solve till the end. X and X may get cancelled or X will be left, amounts will get cancelled. X minus 4 lakh is equal to 0.5x minus 4 lakh. Now 4 lakh gets cancelled and only you are left with X minus 0.5x. You can't work out. If that happens, please don't worry. You write there itself, there is no indifference. One example is here. The management of RT Limited wants to raise its funds from market to meet out the demand, etc. And then proposal PQR, you see, 100% equity, 50 equity, 50 debt, 50 equity, 0 debt and 50 preference. Cost of debt and preference given, tax rate given, equity share 10 rupee plus 10. So if you issue 1 share, you get 20. Investment needed given, EBIT given. They want you to do EPS, BEP and EBIT range for indifference. Now, PQR, they wrote EBIT same number minus the interest. First and third option, they have not written anything because you have debt only in the second option. Other 2 options, there is no debt. And then they got EBT. minus the tax EAT plus preference dividend only in last option, because only in the last option you can see in the question there was preference share. First and second there was no preference share. EAT divided by number of shares, they got the EPS. Now to do financial break-even point, they have calculated how much should I earn so that I can pay interest, tax and preference dividend. Here you observe the indifference point. They worked out EBIT. I told you can keep it as X and solve that into 1 minus T divided by shares, etc. Here they got the answer. Here they got the answer. But here when you do, you will be stuck. X and X gets cancelled or value and value gets cancelled. In exam, you can also write the answer like this. By the way, this itself is from RTP. This answer is given by institute, right? That means this is possible that you may not get an indifference point. If you don't get an indifference point, don't panic. I told you. What is the meaning of no indifference point? There can never be same EPS between these two options. One more example sum. Sinha Limited wants 30 lakh rupee and they are expecting EBIT of 5 lakh rupee. While deciding the financial plan, they want to maximize EPS. That means they want you to indirectly, they said, select the option having high EPS. Alternative 1, 2 and 3, 2.5 lakh debt, balance will come from equity. First para they said you want total 30 lakh. Now if 2.5 lakh comes from debt, balance 27 lakh 50,000 will come from equity and so on. Here 10 lakh here, balance 20 from equity, 15 here, balance 15 from equity. Company share is 200, expected to decline to 160 in case you borrow more than 10 lakh. Borrowing more than 10 lakh is happening only in alternate 3. Borrowing means debt. Only in option 3 you are borrowing more than 10 lakh. In all other cases, that is first and second, share price to be considered is 200, but here share price to be taken is 160. Where did they take this in the answer? You can see here number of shares to be issued. Here they have divided by 200, here also 200, but here they have divided by 160. One share will only give you 160 rupee if you are in alternative 3. Other two alternatives you are going to get anyway 200 rupee. Come by. Here slab wise interest rate is given up to 2.5 lakh, 10% interest. This is more like what you do in income tax class. Then 2.5 lakh to 10 lakh, 15%. Above 10 lakh, it is 20%. Tax rate given, analyze. So, first, I told you already 2.5, 27.5, 10 and 20, 15 and 50. And then they have calculated EBIT is anyway same. Interest, they have done in working note. EBT minus tax, number of share, EPS. Wherever you have the highest EPS, that's the best option. That's what they have done here as the answer. 2.5 lakh into 10%, quite simple. Second, slab rate up to 2.5 lakh, 10%. Beyond that, another 7.5 lakh, they added both. Here, 3 levels, they have added both in the number of shares, and that is used here for computation of interest and computation of number of. Right? It's a good question. You can mark it important. With that, the capital structure topic revision is over. Here, you make a note, this topic, both theory and practical concepts are important. There are 4 approaches: net income, traditional, both are under relevancy, and then net operating income and approach, both are under irrelevancy model. Any of this, they can ask short notes. Remember the graph. If you understand that, then you will be able to answer the theoretical question. That can come for 5 marks. Don't ignore the theory part. This, yeah, with that the capital structure topic is done. Next, we will have to start dividend decision. Yes, let us move on to the next topic. It's actually chapter number 6, dividend decision. Very, very small topic, very simple topic, very easy topic. Another topic that you must revise one day before exam without fail. Risk and leverage, risk analysis in capital budgeting, and dividend decision. These are the 3 topics that are easy, can be revised quickly, and for short they ask one question for at least 5 marks each. So even if they ask 5 plus 5 plus 5 from all the three small topics, you will have 15 marks out of just 60 marks FM paper. So one very easy topic is here in front of you, dividend decision. There are four types of dividend policy. Dividend decision chapter is basically about deciding whether to pay dividend or keep the money as reserve. Number one. Number two, once you decide to pay dividend, the next question is how much should be the amount of dividend? Should we pay 100% of earning as dividend? Should we pay 50% dividend and keep balance 50% as reserve, and so on? These questions are to be now answered. So two things we are trying to understand. Number one, whether to give dividend or not. Number two, if we want to give dividend, how much should the amount of dividend be? There are four dividend policies. First one is regular dividend policy. This is a policy where company regularly pays dividend to their shareholders. The amount may not be same every time, but one thing is sure, if you are an equity shareholder in such companies, you are going to get dividend at the end of every year. Now, which type of company can do this? Only those companies which are financially very strong and stable, those who have good amount of reserves and surplus, those companies which are in existence from last say 10, 15, 20 years. These are well established company, their business is going very, very well. Such companies can follow regular dividend policy. Suppose you have set up a company just 3 years ago, 2 years ago, then you may not be in a position to have regular dividend policy because you don't know, you're still settling in the business. One year you may have good profits, next year you may not have good profits with you. Second, stable dividend policy. I told you, regular dividend policy is the dividend is paid regularly every year, but amount need not be same. It can be slightly fluctuating, but one thing is sure, you are going to get dividend. In the second policy, which is stable dividend policy, you are going to get number one, short dividend. Number two, amount is also certain. Number one, you know you will get. Number two, you also know how much you are going to get. Under stable dividend policy, there can be three varieties: constant dividend, constant payout ratio, and stable rupee plus extra dividend. What is constant dividend per share? Every year I am writing DPS, means dividend per share. Every year my company is paying 7 rupee dividend. So 7, 7, 7, 7, all the years you are going to get exact amount. In second, it is constant payout ratio, that is dividend payout ratio is 50%. What does it mean? How much ever is the EPS, 50% of that will come to me as dividend. If EPS is 10, 50% is constant. So 10 into 50%, you will get 5 rupee. Next year you earn EPS of 20, 20 into 50%. Next to next year you earn EPS of only 2 rupee. Even then 50% will remain same. Now you will get 50% of 2 rupee. So basically, in first one, dividend amount is constant. In second one, dividend payout ratio is constant. And understand, if payout ratio is 50%, the balance is reserve or retention ratio, that is another 50%. I'll give you one more example. If dividend payout ratio is 70%, that means retention ratio is 30%. If payout is 60%, retention is 40%. Right. Third one is stable rupee dividend plus a bit of extra dividend. What is this? Here I will pay 4 rupee for sure, stable, not 3, 4 rupee for sure I will pay, plus I will pay you little extra, but I am not giving you any commitment as to how much will be this extra. What some companies do, they'll give this promise to their equity shareholders that look, you are going to get stable 4 rupee plus something extra every year, but that may be 4 plus 1, maybe 4 plus 0.7, maybe 4 plus 2.5, we don't know, but 4 is for sure. The extra depends on the good profits. If company earns very, very good profits, you may even get 4 plus 4, correct? But first 4 is sure, plus extra, that depends on company's performance that year. Next one is irregular dividend policy. Here company has no policy as such at all. One year they may pay 7 rupee, next year they may pay 3 rupee, after that just 1 rupee, after that maybe 27 rupee. There is no specific policy at all. That's why it's called irregular dividend policy. One year you may not even pay any dividend, even that is possible. Last one, no dividend. This is when company says we are earning, there is EPS, but don't expect dividend. Then where is all the money going? Money will sit in reserves and surplus. All the money will go and sit in reserves and surplus. So EPS 7 rupee, dividend 0. Entire 7 will sit in reserve. Yeah. But if you want to follow this policy, remember one thing, your shareholders may not be very, very happy with this. Imagine you are an equity shareholder. Every year you go to the annual general meeting and they tell you only one thing, no dividend. Every year if this happens, some shareholders may not be very happy with this idea of keeping all the earnings as a reserve. They expect at least some money to be paid in the form of dividend. So practically speaking, this is a difficult policy to follow. You may want to give some dividend even as a company, because think about it, the shareholder could have invested that money in bank FD without any risk. He would have got say 6%. Now he has taken risk by investing in your company, and if you say no dividend, he may not be very happy. Now, when you say no dividend, shareholder will ask, then what about the earnings? There is EPS, but you're not giving me dividend. Where will the EPS go? We will keep it as reserve. And immediately next question from shareholder will be, what will you do with that reserve? Now, management should have a clear-cut explanation to this question as to what will they be doing with the reserves and surplus. Now, they may say this is kept for reinvestment. We will open one more factory, one more branch. We'll launch one more product. We will go for expansion. And if you say that, then shareholders will expect some return from that new product, new branch, new factory also. So next year, next to next year when they come, again you cannot say this year also we have earned some money, but everything will be kept as reserve. We will again reinvest and so on. Shareholders would expect some return from the investment that you have made, right? Therefore, practically speaking, no dividend is a very difficult policy to follow. Now, how much dividend should be paid? This is covered in this discussion called theory of dividend. There are three models, Walter, Gordon and MM model. MM model is called irrelevancy model. The first two, Walter and Gordon, are called relevancy model. Now, how to understand this? When I distribute dividend, will the share price change in the market? Yeah? If I don't declare dividend, will share price go up or come down? Will there be any connection between dividend and share price? If the connection is there, then it is called relevancy policy. If I say irrelevancy policy, what does it mean? You pay dividend, you don't pay dividend, it makes no difference at all. And this is what MM believes, Modigliani and Miller. Their model believes irrelevancy theory, that is, you give dividend, you don't give dividend, it makes no difference at all. According to them, learning this chapter is of no use, because this chapter is all about learning how much dividend should we pay. And they believe, don't worry, how much ever you want, you pay. You pay, you don't pay also, they believe there is no problem. Value of the share, individual, that is market price of one share, and if you multiply that by number of share, you get the total market value of the firm or the company. They believe that it remains same. But Walter and Gordon, these two models, believe that whatever dividend decision you take, it will immediately impact the price of the share. Now, what do they say? Let's read. Walter model, mark this formula important. P is equal to D plus E minus D into R by or divided by K whole divided by K. What is this? Some students find it difficult to mug up these formulas. You actually don't have to mug up the formula. Just observe, P is equal to D by K. This we already studied in cost of capital chapter. Price is equal to D divided by K or KE, correct? What did we study? KE is equal to D by P in cost of capital. Just cross multiply, KE into P is equal to D, correct? So P is equal to D by KE. This much we know. Now D is the dividend that is paid. What about the money that is not paid, that is kept as reserve? That reserve is nothing but E minus D. What is E minus D? Earning per share minus dividend per share. Now if earning is 7 rupee, dividend is 3 rupee, you have taken 3 here, that is dividend. The 7 minus 3, 4 is kept as reserve, even that should be taken. And what will company do with this? They will reinvest, I told you 2 minutes ago, and that reinvestment will earn some return. That reinvestment will earn some return, that is R, and that you have to see whether it is more than K or less than K. Therefore, there you divide it by K. Even that return is earned forever. It is again another example of perpetuity. So D plus E minus D into R by K whole divided by K. So in simple, what we already know is D by K, that is dividend divided by cost of equity. Now we just have to add D plus E minus D. Why are we doing E minus D? What is not paid as dividend is kept as reserve. That reserve is reinvested. We want to see whether that return is more than A or not. Now R is rate of return, or sometimes they use the word internal rate of return. It is basically saying I am keeping some reserve. Dear shareholder, I am not giving you full dividend. I am keeping some reserve. That reserve I am reinvesting, and that reinvestment will earn some return. And that is again a perpetual income. Therefore, R by K whole divided by KE, or K and KE are one and the same. So this is the formula: D plus E minus D into R by K whole divided by K. You know P is price of the share, D is dividend, E is EPS, R is company's rate of return, K is shareholders capacity or cost of equity. Now, some assumptions: they believe R and K are constant, no taxes and no flotation cost. Now the question, most important, please mark this important. How to decide whether to give more dividend or not? Many students try to mug up few things without understanding the basic logic. The entire subject, entire chapter, sorry, Walter model, Gordon model, and even model, we use these percentages R and K. R is rate of return on company's investment, K is the cost of equity or equity shareholders expected rate of return. Now, if you don't understand the correct meaning of R and K, you won't be able to solve any problems here, not even simple question. Now, what is R? It is company's rate of return. That is, if company keeps reserves and surplus, they can reinvest. When they reinvest, how much they can earn, correct? Suppose that is 15%. And if K, that is shareholders expectation, is 12%. Now think about it. Shareholders money will be with company. When company says I'll keep it as reserves and surplus, shareholders money will be with company, and company can earn 15%, whereas shareholders were just expecting 12%. Now shareholders want 12%, company has the ability to earn 15%. That means keeping more reserve is a good decision, because company can generate 3% extra to shareholders. Shareholders wanted just 12%. Company has a project with which they can earn 15%. Then company should keep more reserve and reinvest. Correct? Shareholders will be wealthier by 3 more percent. No doubt they were expecting just 12. They will get that. They'll in fact get more than that. What if it is other way around? They were expecting say 18%. Now keeping reserve, more reserve, is a very bad decision. Why? Because shareholders are expecting 18%. You keep that money instead of giving it as dividend. If you keep that money and then you reinvest and you're going to earn just 15%, you are taking away their wealth. So the better thing is, don't keep reserve at all if K is more and R is less. What if R and K both are same 15%, 15%? Then whether you give dividend or you keep reserve and reinvest makes no difference at all. Correct? Whether you give dividend or you keep it as reserve, it will make no difference at all. That means finally you have to check only these two things, R and K. If R is greater than K, R is greater than K, then company's ability to generate wealth is more than shareholders' expectation. Keep more reserve, give less dividend. Keep more reserve indirectly means give less dividend. But if R is less than K, then do not keep reserve, give all the money in the form of dividend. Let them enjoy now itself, because if you keep their money, they will expect high rate of return, and company has no ability to earn high return. What if R is equal to K? Then reserve and dividend, how much ever you want, you can distribute, because it makes no difference. Or it's more like an indifference point. You give money, you keep money, the rate of return is anyway same. That's the summary given here. R greater than K. In bracket it says growth firm. Why are we calling it as growth firm? When will you call a firm or a company to be growing? If they are able to meet the expectation of shareholders and in fact go beyond that. A growth firm is a one which is increasing its turnover, increasing its customer base, increasing the profits, increasing the earning. If that is happening, then shareholders, they themselves will come to AGM and say, don't give us dividend, keep reserve and reinvest, because shareholders know company is growing very well. Second, if R is less than K, declining firm. That means company has no new projects in mind. They cannot earn more than what shareholders are expecting. If R is less than K, high dividend is better, low reserve. Don't keep reserve at all. Give. Give it to shareholders in the form of dividend. Let them do whatever they want. You keeping their money is a dangerous idea. If R is equal to K, that means it's a normal firm. What do you mean by normal firm? You give dividend, you keep reserve, it will not make any difference, right? That's what it says. Dividend decision will make no impact on the price of the. And here, when I say lower dividend is better, it can be as low as 0% dividend. High reserve means 100% reserve. Keep full money. Keep full money. Don't give even 1 paisa dividend. Here I say high dividend is better, low reserve is preferred. High dividend can be as high as full 100%, then low reserve can be as good as 0%. Right. A small example. Earning of the company 50 lakh rupee, dividend payout ratio, number of shares, equity capitalization rate means KE, rate of return on investment means R. Here you observe R is 15%, K is 12%. What is happening? R is greater than K. When R is greater than K, what is the right thing to do? Keep more reserve. How much more? Maximum. Maximum can be 100% reserve. But what is company doing now? They are paying 60%. If they pay 60%, then they are keeping only 40% reserve. Correct? See what are they asking? Compute the market value per share as per Walter model. Substitute the formula 5 rupee EPS. How did they get 5 rupee EPS? 50 lakh earnings, 10 lakh share. So 50 lakh divided by 10 lakh, 5 rupee, and 60% you pay, that means 3 rupee you pay. Therefore, formula will be 3, that is dividend, correct, plus 5 minus 3, that is EPS minus DPS, into R by K, correct? It is written like this: 3 plus 5 minus 3 into 0.15 by 0.12 whole divided by 0.12, and this is coming to 45.83 rupee. But here you observe R is greater than K, and that's why they're asking you sub question 2. Compute optimum dividend payout ratio according to Walter model and market value of the share at that payout ratio. They are now asking you what should have been the decision and how to decide. Sir, R is 15 and K is 12. R is greater than K. That means we should have kept more reserve. We should have kept more reserve. More reserve means 100% reserve. Now, if you keep 100% reserve, dividend will be 0. Now, the formula will be P is equal to 0, correct? Plus, see this, 5 minus 0 whole divided by, sorry, multiplied by 0.15 by 0.12 whole divided by 0.12. This comes to 52.08, and you can see from 45 rupee your share price has now gone up to 52.08. That means the decision that you have taken is a good decision. If share prices are going up, what does that mean? Your decision is well accepted. Next, Gordon model. The proposition is same as that of Walter model. That means R and K greater, less and equal. That logic remains same. Slightly change in the formula, E into 1 minus B divided by K minus BR. K minus G, some books write it as K minus G, and E into 1 minus B. Now, lot of students have this doubt. What is this complicated formula? It's not complicated formula. You just see E into 1 minus B divided by K minus G. What did they do? What is B? B is retention ratio. You can see here, retention ratio. What is the meaning of retention ratio? Sir, 60% you pay, that means 40% reserve. Now, if I say earning 10 rupee, 60% you pay, that means 40% is reserve. Now, 1 minus 0.4 is what? 0.6. 10 into 0.6 is what? 6 rupee. That is nothing but dividend. Correct? When I do earning into 1 minus B, remember the example I told you, EPS 10 rupee, 60% payout ratio. I can either say 6 rupee dividend, or I can say 10 into 1 minus 0.4, 10 into 1 minus 0.4, which means I can write this formula as P is equal to D divided by K minus G. Now some students have this doubt, sir, G is growth rate. Growth should be added. Why are they minusing? Correct. Actually, we already know this formula. What was that formula that we studied? You just see, they did K minus G. What was the formula we had for cost of equity we studied in cost of capital? K is equal to this, D means D1, D1 divided by P0 plus G, the growth rate. Now just observe, they shifted this way, K minus G is equal to D1 by P0. G is shifted to this side. So it becomes K minus D is equal to D1 by P0, and then they cross multiplied K minus G into P0 is equal to D1, correct? And then they say P0 is equal to D1 by K minus G, and D1 itself is written as E into 1 minus B. That means it's the same formula that we studied in cost of capital, correct? I quickly repeat, what did we study in cost of capital? K is equal to D1 by P plus growth. They shifted growth this side, so the plus G becomes minus G. So K minus G is equal to D1 by P0, cross multiply KE or K minus G into P0 is equal to D1. They wanted P0, so they said P0 is equal to D1 by K minus G. So don't think growth should have been added. Why did they deduct? It is the same thing from right hand side, they shifted to left hand side. From there they brought it to denominator. That is why it is Ke minus G. This G in some books is written as B into R. G is written as BR, B into R. B is the same B here, the retention ratio. R is what I discussed in Walter model, rate of return on company's investment. So it's actually not a different formula, it's the same formula. See this. E is EPS, B is retention ratio, K is cost of equity, and R is company's ability to earn. Growth is also computed as B into R. What is B? Retention ratio. R is rate of return on company's investment. This approach assumes that there is some dividend that is paid every year. Very, very important. The only difference between Walter and Gordon model is this. Walter model says you can have zero dividend also, no problem. You can have zero dividend also, no problem. But Gordon model believes that some dividend must be paid. Therefore, you should never write in exam that R is less than K, therefore 100, sorry, R is greater than K, therefore 100% reserve, no dividend at all. Do not write no dividend if the question is under Gordon model, because they believe some dividend at least has to be paid. Sir, then what should I write as conclusion? You can say company should keep as much as possible maximum reserve and should pay bare minimum dividend. Never write zero dividend, because the dividend policy under Gordon model has an assumption that some dividend is always paid. Therefore, in your answer, let it not be like no dividend at all. You write company should pay bare minimum dividend and should keep maximum reserve. Now we can argue, sir, 99% I'll write 1% dividend. Some other student may say 99.5 I'll write 0.5. There is no end to this. Somebody will say 99.99. Correct? Therefore, you simply write maximum reserve and at least some bare minimum dividend is to be paid. Here they assume that K is greater than G. Like Walter model, even this approach assumes R and K are constant. There is no tax and flotation cost. One simple way to understand, in Walter model, for reserve you write as E minus D, correct? E minus D is reserve per share. Here you write percentage. Why did I say percentage? When you write B, what is B? Earning per share into 1 minus retention ratio, 60% paid, that means 40% reserve. 60% paid, that means 40% reserve. So this 0.4 that I am writing is actually in percentage term 40%. Yeah. In Walter, you write it as E minus D, earning minus dividend. Here you write that in percentage term. Otherwise, almost everything between these two models are same. And these two are very, very important, most commonly asked in exam also. One question, net profit 30 lakh. There are preference shares 12%, 100 lakh. Number of equity share, return on investment means R, cost of equity K given to you. Calculate the price per share using Gordon model when dividend payout is 25, 50 and 100%. Sir, just now you said there can't be 100%. I said you can't have 100% reserve. I did not say you should not pay 100% dividend. Don't get confused. Watch this part of video once again if you want. This model assumes 100% reserve is not allowed. You can't say zero dividend, right? But if you want to give 100% dividend, you can surely do. Okay. So first net profit 30 lakh, you have to first pay preference dividend, earning available to equity shareholder 18 lakh. There are 3 lakh, so EPS is 6 rupee. Now, if dividend payout is 25%, then 6 into 0.25 divided by 0.16 into 0.75, you can substitute, you get these numbers 150, 50 and 37.5. If you see the trend, it is very, very low when you pay 100%. Why is that happening? You observe, R is 20%, K is 16%. When R is more, K is less, what you should have done? When R is more, K is less, what you should have done? You should have kept more reserve, correct? But when you say in third sub question 100% paid as dividend, that means you're almost keeping no reserve at all. Therefore, the value will be very, very low. And in sub question 1, you are paying 25%, that means you're keeping 75% with you, reserve is more. Because of that, value of one share is also simple logic. Next one is approach, Modigliani Miller. They believe in irrelevancy theory. That means whether you pay dividend, more dividend, less dividend, none of that will make any difference. Some assumptions they make is perfect capital market in the cost of capital chapter. I have discussed this. No taxes. Companies are fully financed by owners' fund. This is one limitation of this model. They believe that companies are fully funded by owners' money. What does it mean? There is no debt at all. That means you will either use your reserves and surplus, or if you have shortage of money, go to equity shareholders. There is no question of preference share, no question of debt also. Practically speaking, this is an illogical assumption that a company is fully financed by equity. Even if there are companies out of 100, maybe only 5 or 10 companies will be fully financed by equity. Every company will take some debt at least. What is the conclusion they make? Market value of equity share of a company is not influenced by manner in which its earnings are split between dividend and reserve. They believe you give dividend, you don't give dividend, it makes no difference at all. What's the formula? P0, price of share as on today, is equal to D1 plus P1 divided by 1 plus K. D1 is dividend at the end of year 1, P1 is price at the end of the year 1 divided by 1 plus K. P0 I told you at the beginning, P1 at the end, D1 at the end. You already know cost of equity. One example. There is one confusion among many students about a solution to this question given in ICA study material. All the explanation in study material is correct, but I feel they have done one small mistake. They have calculated value of the firm as on today. Actually, value of the firm should be calculated at the end of year 1. Therefore, don't get confused by their way of working out. They have done the value of firm calculation as on today. But ideally speaking, it should be done as at the end of year 1. I have done it here. You have an example. AB Engineering belongs to risk class for which the capitalization rate KE is 10%. Currently, they have 10,000 shares. Selling means market price 100 rupee. The firm is planning to declare a dividend of 5 rupee at the end of current financial year D1. It expects to have net income of 1 lakh and has a proposal of 2 lakh rupee. Calculate value of the firm when dividend is not paid and dividend is paid. In study material, they have calculated the value of the firm as on today, which is not correct. You have to calculate value of the firm at the end of the year. See this first one, if dividend is not paid, P0 is equal to D1 plus P1, same formula, 1 by 1 plus KE. You substitute the numbers, you get 110. Same way, if dividends are paid, P1 will come to 105. Same way, that will be what? 100 is equal to 5 plus P1 by 1 plus 0.1. You cross multiply and you get 105. Now what happens at the end of the year? You see here, if dividend is not paid, dividends are paid. Net income will be 1 lakh, 1 lakh, done. Dividend, if you don't pay, it is 0. If you want to pay 10,000 shares into 5 rupee, amount available with you will be 1 lakh and 50,000. Total funds needed 2 lakh, 2 lakh, that is already given. How much will be shortage of fund? You need 2 lakh, you have only 1 lakh, you will have a shortage of 1 lakh rupee. Here you need 2 lakh, you will have only 50,000, that means now the shortage will be 1 lakh 50,000 rupee. And from where will you get this? You have to issue shares, new shares, and when? That is after 1 year. After 1 year, you should not take P0, you have to take P1. That day, one share will give you 110 rupee. That means 1 lakh rupee divided by 110. Here 1 lakh 50,000 divided by 105. That gave me number of new shares. What will happen to total number of shares? You already have 10,000. Add this 10,000 plus 909, 10,000 plus 1428, multiply by P1. P1 is price of the share at the end of the year, 110 and 105. value of the firm will be same. Yeah, if you round off while doing the calculation, this may not match exactly 12 lakh to 12 lakh. I have not done any rounding off. You can see here I have kept this 0.09, 0.09 and so on. Though I know number of equity shares cannot be in decimals, I have to keep it same. Otherwise, my total 12 lakh and 12 lakh will not match and it will unnecessarily create confusion to you. So basically what happened, whether you pay dividend or you don't pay dividend, value of the firm at the end of year 1 remains same. Okay, in study material, I say study material, they have done value of the firm as on today, which according to me is not correct. You have to calculate value of the firm at the end of year 1, that is remaining same. Right, there are other models in dividend theory. These are not so important from exam point of view, but don't take chances. Just go through for 5-10 minutes one day before exam as well. Number one, dividend remains same forever. We already know this formula. P0 is equal to D by K. When we discussed cost of equity is equal to D by P, you just do cross multiplication. K into P is equal to D. So P is equal to D by K. We already know this. If dividend is growing, then it is D0 into 1 plus G, K minus G. I already told you 15 minutes back, they shifted G from this side to that side and then they shifted to the denominator. In variable growth also, you will use the same formula, but the growth rate will be different every year. That's all. And this traditional model, they've never asked any question from this in examination till now. Okay, in study material also they have given these models, and just there are one or two small questions just for 1 or 2 minutes only one day before exam. Brush through, don't worry much about this. They have not asked. Price of the share is equal to M is multiplier into dividend plus E by 3, and here Linter's model D0 dividend at the end of year 1 should be D0 plus EPS into target payout minus D0 into adjustment factor. My suggestion, as I told you, there is one question, there is one question on gram and dot and one question on Linter model in study material. 1 or 2 minutes, just read through. Don't worry too much about the concept and logic behind this. Not very important. They've never asked before. Don't spend too much time on this. Okay. With that, our dividend decision chapter is over. Yes, let us start now. The next topic, chapter 7, working capital management. I have segregated this into 7.1, 7.2, and so on. Treasury, cash management is 7.1, and then debtors, inventory, creditor, and so on. Actually, this is the biggest topic. Okay. So, my suggestion, let this be the last topic for your revision one day before exam, because this topic will take so much time for a student to revise, and then you're only going to get one question or maximum two questions, and the time that you take for this one topic, in that time you can actually cover other 3-4 topics. So only once you complete all small topics, go for working capital management. Okay, in that there are small segments. We are first discussing treasury and cash management. Now, some of the most commonly asked adjustments are cash budget preparation questions, the most common set of questions. First adjustment they ask is minimum balance. Now, if you have minimum balance condition in the question, how will it be? Say something like this. Company wants to prepare a cash budget starting from January of this year, Jan, Feb, March, 3 months data given, and January opening balance is 2 lakh rupee. Opening balance as on 1st January. And question says they want to maintain a minimum balance of this 2 lakh rupee. Now, what may happen in the month of Jan? You will start with 2 lakh opening balance, OB I am writing 2 lakh rupee, and then all the receipts, all the payments, and closing balance may come to 1,85,000. You can't stop there because question says minimum balance of 2 lakh. Then you will have to add a line here, loan taken, that is you have to take 15,000 loan, make the balance as 2 lakh. Then this will become now adjusted closing balance. This 2 lakh will become opening balance when you start February month. Okay, suppose at the end of February your closing balance is 2,25,000. Anyway, they said minimum balance, they did not say maximum balance. So what you can do, the loan that you have taken, you repay the loan now. How much was the loan? 15,000. You repay 15,000. Correct? Now the balance will still be 2 lakh 10,000. Anyway, question is minimum balance. Don't worry, above 2 lakh there is no problem at all. Continue. This becomes the starting point for March month. Okay, but what may happen in exam at the end of February month? What if you have only 2 lakh 5,000 rupee? Now it is above 2 lakh. Now, sir, I have extra money, I'll repay the loan. But remember, you can't repay full 15,000, because if you repay 15,000, you'll go back to 1 lakh 90,000 in February. Again, you have to take 10,000 loan. Correct? Therefore, you can repay the loan of only 5,000, then your closing balance will come to 2 lakh rupee, and this will become next month opening balance. Now 15,000 loan taken, only 5,000 repaid, you still have outstanding loan of 10,000 rupee. Suppose in March month you get 2 lakh 13,000 balance, now comfortably repay the outstanding balance 10,000 loan. If you have shortage there also, pay how much ever is possible. If you are below 2 lakh, take one more loan. So when there is a minimum balance condition, this is what you will have to do. Very important. I've explained in just 2 minutes. I hope this is crisp and clear to you. Second possibility in exam, they can ask you maximum balance condition. Now, what is the meaning of maximum balance? Same line, assume they say 2 lakh rupees is the 1st January balance and they want to keep maximum of 2 lakh only. Now what may happen, you may have to observe here. You may have to do some extra adjustments. What if closing balance come to 1 lakh 85,000? Don't worry. Why don't worry? Why did I say don't worry? Because the question says maximum balance 2 lakh rupee. Below that is totally okay. So you will continue with 1 lakh 85,000. That becomes the February starting point. Okay. Suppose now February balance is 2 lakh 30,000 rupee. February closing balance come to 2 lakh 30,000. Now read the line, maximum balance is 2 lakh. I can't keep anything more than 2 lakh. So, sir, then what to do with the 30,000? Invest. So, here it will be minus investment made, 30,000 you invest. Now you will come back to 2 lakh rupees and so on. Correct? That means now the problem comes only when you have more than 2 lakh, because the question is maximum condition. Sir, what if I have only 1 lakh 90,000? Don't worry, because you are anyway below 2 lakh. Question is only maximum balance. Now the 2 lakh becomes opening balance for March. Correct? And after all the plus minus receipt and payment, you may come to 1 lakh 95,000. Sorry, here 1 lakh 95,000. Yes, sir, should I do anything? Should I sell the investment? Why? They only said maximum condition, they have not said minimum condition. So just continue with 1 lakh 95,000. Let that be opening balance next month. So when they say maximum balance, you should not cross 2 lakh. If you are below 2 lakh, no problem at all. Simple. This is what you have to do if question says maximum balance. Third possibility, fixed balance condition. What is this fixed balance condition? They say, sir, 2 lakh rupee is the balance on 1st January. Company wants to keep a fixed balance of 2 lakh only. Now what does it mean? You will not keep more than 2, you will not have less than 2. Okay. Now take the example. Same Jan, Feb, March. You started with opening balance 2 lakh. All the receipts you add, payments you minus. Now suppose the closing balance comes to 1 lakh 80,000. Now the question says fixed balance 2 lakh. You have to take loan. Correct? I will write add loan taken 20,000 rupee. With this you will make the balance as 2 lakh, and this 2 lakh will become February opening balance. Suppose February closing balance is 2 lakh 30,000 rupee. Yes, now loan can be repaid, but how much is the maximum loan that you have? Only 20,000. Okay, repay that. Sir, now I still have 10,000 extra. Correct. It's a fixed balance condition. You should not keep more than 2 lakh. Now the extra 10,000 you will invest. So this will now be investment made. Investment made. Now again you will go to 2 lakh. That 2 lakh becomes the opening balance. Now suppose at the end here you have 1 lakh 85,000. What to do? You have to have 2 lakh balance. Now don't say, sir, will take loan. Don't take loan. You have made investment of 10,000. Now add investment sold. Why am I adding? Because when you sell investment, there will be cash inflow. When you sell investment, there will be cash inflow. 10,000 will come to you. correct? The same 10,000 that you invested, use that. Sir, is that enough? No, it's not enough. Why? 1,85,000 plus 10,000 is still 1,95,000. But how much you wanted? 2 lakh rupee. Now for the balance 5,000, you will have to take loan. And now you see the balance comes to 2 lakh. Now in the month of April, again you start with 2 lakh. Suppose now here you reached 2 lakh 10,000. Now don't say, sir, invest 10,000. You have a loan, correct? First repay the loan. 5,000 loan is repaid. 205,000 now. But question is fixed balance condition. So another 5,000 you invest. Now again you go down to 2 lakh rupees. Correct? So I quickly repeat possibilities in exam. First month shortage, take loan. Next month excess, first repay the loan. Then also you have invest. Next month shortage, sell that investment. Then also you need money, take loan. Next month again excess, first repay the loan. Then you still have money, invest, and this chain will continue. This is what you have to do if question is about fixed balance. So I explained all three variety: minimum, maximum, and fixed balance condition. One day before exam, watch this video of just 6 to 8 minutes of all three possibilities. You'll be able to work out any cash budget preparation question. Hmm? Let's go back. The other most commonly asked adjustment: collection from debtor and payment to creditor. Many students, they know that this adjustment comes again and again in exam, and still they don't prepare well for this. Collection from debtor, payment to creditor. In question sometimes they'll give you, company makes 20% cash sale. In the balance credit sale, half money is collected next year, another half next to next year. These kind of adjustment. How to do this? And what you learn for debtor, same thing is applicable for creditor. In debtor, you collect money. In creditor, you will have to pay money. That's it. Okay. See here, I've given one example. Company makes 20% cash sale. 50% of credit sale is collected 1 month after the sale. Another 50% is collected in the following month. Sales data is given to you. April, May, June, July, August. Calculate the receipt for June. I have just written June example. In exam, you can do July, August, September also. Now for June, how to calculate? See, in the month of June, whatever cash sale you have made will come to you. How much is the cash sale? Read the adjustment once again. Company makes 20% cash sale. That means go to June month, 3 lakh into 20% of that is cash. Take it here. Done. Next, 50% of the credit sale is collected 1 month after sale. That means in the month of June, whatever sale I have made in previous month, which is May, from that also I'll collect something. How much will be that? Credit sale of May, that is, how much is May sale? 3.2. Now observe, out of this 3.2, 20% will be cash sale. That month, May month, that means only 80% is credit sale. Now when I do 3.2 into 80%, 3.2 into 80%, what am I getting? Credit sales. Credit sales. This into how much am I collecting? 50%, this number. Same way, continue. It says another 50% is collected in the following month. That means when I am in June, I won't collect only May month. I will even collect something from April month. I will even collect something from April month. That means credit sale of April to be shown here, which is go to April 3.5. In that 80% credit sale, in that 50% is collected. You add all the three, you will get to know the collection in June. Okay, there are many questions like this in study material. Ensure you work out these kind of questions one day before exam. Please make a note somewhere: cash collection from debtor and cash payment to creditor, where you have this kind of adjustment, some cash and some credit, and the credit is collected next month, next to next month. Such one question you must work out. If there is a cash budget question, this adjustment will always be there. Okay, very important, very simple. I'll quickly repeat once again what I did. You can use the same logic for July, August, and work out. For the month of June, whatever we have sold in the month of June, in that 20% will be cash sale. That means I have to take 3 lakh, that is sale of June, into 20%. One number is ready. Second, whatever credit sale I have made in the month of May, correct? First, how to get the credit sale? 3.2 lakh is total sale of May. In that 20% will be cash. Therefore, 80% will be credit, correct? In that 50% I'm collecting now. And last segment, they have said 50% in the following month. That means I have to go 2 months before. That is April month 3.5 lakh into 80% into 50%. Add all the three. This will give you collection for, very important. I think, I hope you've already made a note. One on collection and one on payment. Next, some other adjustments they ask: depreciation and all non-cash items. If they give, just ignore. Why? We are not preparing P&L account. We are here to prepare cash budget. If they say amortization, preliminary expense written off, goodwill written off, depreciation, all of this is of no use, because I am preparing cash budget. Only cash inflow, cash outflow is considered. Other aspects are not considered at all. Last one, outstanding expenses. Again, you should not take outstanding expense. Why? Salary paid 10,000, outstanding 3,000. Why should I take 3,000? I'm preparing cash budget. It is not a P&L. Again, I repeat, many students in the class also they do this mistake, because we've been working out all this P&L type of questions in accounts class, in costing, FM, everywhere we take it as cost. It is a cost, but we are now not preparing P&L account, not income statement. We are doing cash budget. Only if it is paid, take it. If it is not paid, do not take it. So if they say 10,000 paid, 3,000 outstanding, you will take only 10,000 rupees. Another area which is ignored by many students in cash budget, and they know, institute knows very well that you ignore, therefore they ask a question: Bommel's model of cash management. Many students don't even know this is there in the syllabus. This model is similar to EOQ model. If you see the formula, you will understand. What was EOQ formula? Economic order quantity in material, 2AO by C, correct? That EOQ formula gave you how many kgs of raw material you should order, correct? Now that was about raw material. This is about cash. Same way now, square root of 2AT. Now A in EOQ, it was annual raw material, correct? Here it is annual cash requirement, cash disbursement. T is transaction cost. In EOQ, it was O, that was ordering cost. What was ordering cost? Every time you place an order, irrespective of how many kgs you buy, you have to pay some ordering cost: loading, unloading, toll charges, transportation, all of that. Here it is transaction cost. What is this transaction cost? Whenever I transfer money from my bank account to my investment account or demat account, so from my regular bank account to demat account, and from demat account back to my regular bank account, whenever I do this transfer, right, there will be some charges, maybe 5 rupee, maybe 8 rupee, maybe 10 rupee. That is called T, transaction cost. Whether I transfer 10,000 or I transfer 25,000, this 5 or 10 rupee transaction cost will remain same. This is similar to EOQ concept, ordering cost. Whether I buy 100 kg or 200 kg, if the lorry is coming in that road, the transportation cost is same. The toll charges are to be paid, loading, unloading has to be paid. And then H is the holding cost. In EOQ chapter, we studied this as C, which is carrying cost. There it is carrying cost, here it is holding cost. Understand, the principle is common. The principle logic is same. What is the common logic? If I buy raw material, I am blocking money, because I'm not investing it, I'm blocking money. And when I block money, I'm losing an opportunity. There is an opportunity cost. Same way here also, if I keep money in my regular bank account, I won't be earning anything. That money won't grow. But if same money is kept in investment account, that is demat account, I buy bond, I buy debenture, I purchase shares of other companies, the money will grow. There will be appreciation, there will be interest or dividend at the end of the year. Money kept in regular bank account is as good as purchasing raw material and keeping that in godown or warehouse. In both the places, money gets blocked and you have opportunity cost. There also we took opportunity cost as denominator in EOQ. Here also to take the same opportunity cost. Here, by solving this, you'll get to know how much should be optimum cash balance. A question in exam can be like this: company requires 12 lakh rupee cash per annum and transaction cost is 15 rupee, and there is carrying cost of 8%. That means 1 rupee, if you invest in demat account, you will earn 8% interest. Same 1 rupee, you keep it in regular bank account, you won't earn any interest. That means it is 8% on 1 rupee. 0.08 is the opportunity cost. In EOQ, we do opportunity cost per kg per annum or per unit per annum. Here it should be per rupee per annum. Yeah, don't ignore this segment. Many students, as I told you, they don't even know this concept exists. They can either ask a theory question on this or a practical question. If it is a practical question, it will be for 5 marks. Please don't ignore this. There is one question on this concept in study material. Workout, I even told you how it should be. Okay, that's all. This is what you can expect from cash budget. Only two variety problem, either cash budget preparation or Bommel's model of optimum cash balance. Right? Let's now move on to the second segment of this chapter 7.2, that is inventory management. Yes, the next segment is inventory management. Now, this is mainly the EOQ concept that you have studied in costing, material chapter in cost accounting subject. The chances that they will ask EOQ question in FM, to be honest, is very, very less. Okay, because this is a pure, sorry, this is purely a costing concept, and in costing, they can ask this question for 5 marks or even 10 marks. So, in FM, EOQ question, according to me, is a rare possibility. But let's not take chances. Even in study material, it is just 1.5 page, and there also they have mentioned that only EOQ is covered in inventory management, and that EOQ is already discussed in cost accounting subject. So I will not take much time on this, just maybe 5 to 10 minutes. We will quickly brush up. Concept of economic order quantity, assumptions that are used. This can be a theory question. Again, I told you less likely, but if they want, they can ask EOQ theory question or an EOQ practical sum. EOQ is the quantity of material to be ordered. It is the optimum size of purchase order that minimizes total annual holding cost and ordering cost of inventory. The major objective of managing inventory is to discover and maintain the optimum level of investment in inventory. The optimum level will be that quantity which minimizes the total cost associated with inventory. Understand, a company wants, just an example, 10,000 kg of raw material. They have two options. Either they can buy all 10,000 kg in one single order, buy everything in one go, yeah, or they can buy just 100 kgs 100 times, 100 kg into 100 orders. Now, if they buy in bulk like this, what will happen? Their ordering cost will be very less. That is, you have to pay for transportation, loading, unloading, toll charges, everything only once. But they will be carrying so much of stock with them. First day itself, 10,000 kg will come to your godown, and you won't be using full 10,000 kg in 1 week or 1 month. This is for full year. This 10,000 kg is annual requirement. Correct? You will use it for full year, and you have to store it now. You need a big warehouse, that rent, and you have to pay so much money to the supplier on day one itself. That money could have been invested. There is an opportunity cost. You have to take the insurance because you have so much of raw material with you, and you need to have some staff to maintain that inventory. You have to pay them salary. All of this is called carrying cost. If you buy too much, then your carrying cost will go up. On the other side, if you buy only 100 kg, you will have to buy 100 times. That many times you will have to pay for ordering. That means transportation, loading, unloading, all of this will be paid 100 times. So ordering cost will go up. But on the other side, because you are carrying very less stock with you, only 100 kg, small warehouse is enough. You don't have to block big sum, big amount of money. Little bit of amount is more than enough. Correct? Therefore, opportunity cost or the carrying cost will come down, which means when I buy bulk also, there is a problem. When I buy very less also, there is a problem. That means somewhere between 10,000 kg and 100 kg, there is some level where OC and CC, ordering cost and carrying cost, both are minimum and both are equal. Both are minimum and both are equal. And that level is called economic ordering quantity. That level is called EOQ, economic ordering quantity. If I buy more than EOQ, suppose EOQ comes to 2000 kg, what does it mean? You should buy 2000 kg. At that level, ordering cost and carrying cost will be equal. Ordering cost and carrying cost will be equal. Now, what will happen if I buy more than 2000 kg? Your ordering cost will come down, but you'll have to carry more stock. correct? Ordering cost will come down, carrying cost will go up. What will happen if I buy less than 2000 kg? Then carrying cost will come down, ordering cost will shoot up. So 2000 kg is the best level where both ordering cost and carrying cost are minimum and are equal. In costing class, we have studied this in detail. Most of the students know what happens when you buy more. Carrying cost will be very, very high, ordering cost will be low. When you buy less, exactly opposite. At TOQ, both will be equal. That means OC should be equal to CC. That is when total cost is minimum. Now, how to calculate ordering cost? Annual raw material that you are buying divided by quantity that you are ordering. Annual raw material divided by quantity. By the way, I'm just explaining the derivation of this formula because many students know EOQ formula is square root of 2AO by C, but they don't know why is this formula, why are we doing square root. I'm just explaining that. One thing we understood, that a level where OC is equal to CC, my annual cost is lowest, correct? Either this side OC will go down, CC will increase, that side you buy, that means two less you buy, OC will go up and CC will come down. So finally, what is our objective? OC and CC should be equal. Now, how to get ordering cost? Annual raw material divided by quantity that you buy every time. This will tell you number of orders. This should be multiplied by ordering cost per order. So A by Q into O will tell you ordering cost. On the other side, carrying cost. Carrying cost depends on the quantity that you carry multiplied by carrying cost per unit per annum. That is, each kg raw material that you buy, for that if you have paid 35 rupee, understand instead of buying raw material, the same 35 rupee could have been invested. And if you invest, you can earn, example, 18%. Now 18% interest on 35 rupee, that becomes your carrying cost per unit. But we should not do it on full quantity, we should do it on average quantity. That's why it is 1 by 2 into Q into C. Sir, why are we doing 1 by 2? Please understand, suppose if my EOQ is 2000 kg, EOQ is 2000 kg. If this is my, say, warehouse example, this is the graph, day 0. Based on 2000 kg, annual requirement, I have taken 10,000 kg. That means in a year, I will buy 5 times 10,000 kg divided by 2000. So 5 times if I have to buy in a year of 365 days, roughly once in 73 days I am buying. In Calci, you can check 365 days divided by 5 orders, once in 73 days. Now on day 0, that is today, if I buy, my next purchase will happen on 73rd day. Next will happen on 146th day and so on. Now, how much am I buying? 2000 kg. Is it correct to say I will buy 2000 kg and I will keep 2000 kg for 73 days and 73rd day I will fully consume it and make it zero, and that day I will buy new stock? This is not correct. What happens in reality? Today you buy 2000, tomorrow you will consume some 20-30 kg, again another 20-30 kg. Inventory will come down like this, and on 73rd day it will reach zero, correct? Which means if I come to your warehouse on first day, you may have 2000 kg, but if I come to your warehouse on third day, you may have only 1950 kg. 3 days later, it may be just 1900 kg. If I come to you on 72nd day, you may be having just 50 kg. 73rd day, you may be having 0 kg and you are waiting for the lorry to come. Correct? Which means you should never say, I am always carrying 2000. No. Someday 2000, someday 1950, someday 1900, someday maybe just 50. Therefore, it is better to take the midpoint. Where is the midpoint? Sir, 2000 maximum stock, 0 minimum stock. That means 2000 plus 0 divided by 2. 2000 maximum inventory in hand, 0 minimum, midpoint, therefore 2000 plus 0 by 2. This you can even write as 2000 by 2. Or you can even write it as 1 by 2 into 2000. Everything is one and the same, and that's what I have done here, 1 by 2 into Q into C. Right? Let's continue now. How did they got this formula? So here you have AO divided by Q, correct? And here you have QC divided by 2, QC divided by 2. AO by Q is equal to QC by 2. Cross multiply this way. Q square C is equal to 2AO. So Q square is equal to 2AO by C. but I want to know the Q, that is quantity to be purchased, that will be square root of 2AO by C, and this is the logic behind our formula 2AO by C. Correct? Q square is equal to 2AO by C, but I want Q, therefore I do square root of 2AO divided by. That's why we should always apply carrying cost on average inventory. Remember this sentence. Carrying cost is always on average inventory. Now there are three elements of cost: buying cost, ordering cost, and carrying cost. Just now I showed you how to do. Buying cost is the amount that you pay to the supplier. Ordering cost is the amount that you pay every time you place an order, loading, unloading, all of that. Carrying cost is the cost that you incur because you're storing or carrying or holding that stock with you. Sometimes they even give opportunity cost, even that is part of carrying cost. In exam, just to confuse you, they may say opportunity cost 8%, insurance 2%. Then you take both, then carrying cost will be 10%. If they give these percentages separately, add everything and take that number. Formula, I told you just now how they got it. 2AO divided by C, square root of that will give you economical order quantity. One small example, a company manufactures a product, they require a component called alpha. Annual requirement of alpha is 8,000. Cost of placing an order 200. This is ordering cost. Cost per unit is 400. Carrying cost 20%. The company has been offered a discount of 4% if you purchase 4,000. Should the offer be accepted? First, you should work out EOQ. How much is EOQ? Square root of 2 into 8,000 units, correct, into 200 rupee divided by 20% on 400. Understand this. Instead of buying raw material, had I invested 400 rupee, I would have made 20% return. Correct? This number that you're going to get is economic order quantity. Now the question is, will you accept a discount? Now how to do this? You will have to compare at EOQ and at discount offer. What happens? Purchase cost. Purchase cost will be equal to how much is annual requirement? 8,000 units, correct, into 400 rupee. But here 8,000, if you accept the discount, you are getting 4% discount. So you have to do 400 minus 4% discount. 400 rupee, correct, cost of one unit minus 4% discount. This will be 384. This is the purchase cost. Then ordering cost, how to calculate? 8,000 units divided by whatever EOQ you get. Let me check how much is the EOQ. Is 2 into 8,000 into 100 by, I am getting 200 as my EOQ. 200. Now what happens? Ordering cost will be 8,000 I want, and I'll be buying 200. So this will give me number of orders into ordering cost is 200 rupee, this number. But here I need to buy 4,000 to get the discount. That means it is 8,000 by 4,000 into 200 rupee. This will be very less now because you're buying in bulk. Other side, carrying cost will be 1 by 2. I told you average inventory into 200 into carrying cost is 20% on 400 rupee. This number. But here it is 1 by 2 into you are buying 4,000 into 20% on, remember, 384. Some students do a mistake here. They apply 20% even here on 400. You are not paying 400. When you have discount, you are paying only 384. That means you have to take opportunity cost only on 384 and not on full. This will give you carrying cost. And then when you add, you will get to know the total cost. Whichever is lower, that you select. Under discount column, if you get less, select that. At EOQ, if you are getting less annual cost, then select the EOQ, reject the discount offer. That's it. EOQ and one thumb you can do one day before exam. Just spend 5 minutes, not even 5, 3-4 minutes. Go to the study material on EOQ with discount. There is only one sum. Just revise it. You don't have to even work out. If you are writing both groups, by the way, this is already there in costing material chapter. You would have done the studies as well as revision. Don't spend too much time on this. Quick revision for 3-4 minutes should be more than enough. Okay. This is about inventory management. And now we move on to the next topic, subtopic within working capital management, that is receivable management. Yes, let's move on to the next discussion. 7.3, working capital management subtopic, receivable management. Basically, here we are trying to understand whether to extend credit period to our customers or not. Extending too much of credit is also bad, but saying only cash and carry is also a problem. We need to find out the perfect balance between giving more debt and also being able to collect that well. Right? See here. Management of receivable refers to planning and controlling the debt owed to the firm from customers on account of credit sale. It is also known as trade credit management. Large amounts, if they are tied up in receivable, there are chances of bad debt, there will be cost of collection. Understand? If you give too much of time to customers, too many datas, right? What will happen? In P&L account, you can show good profits because you have sales, but you will not have money in cash account or bank account. At the end of the year, what is the use of having fantastic net profit in P&L but not having money at all in your balance sheet, in your bank balance, in your cash balance? Where is all the money? In the pocket of your customer, right? Because you gave them 30 days, 60 days, 90 days, 120 days. Number one problem, they will delay the payment, and the more they delay, you will have shortage of money for day to day activity. Number one. Number two, they won't pay on time. If you give 30 days time to somebody, they won't pay on 30th day. We also do this with our friends, correct? Therefore, if 30 days time is given, nobody pays on 30th day. You need to hire people only to call those customers, remind them that their money is outstanding, and they will then pay maybe after 40, 50 days. Now you need to appoint some people only to do the collection work. This is the second problem. Third, what if some customers don't pay at all? Then it becomes a bad debt and that money is completely lost. Correct? More than all of this, the fourth, when someone says, I'll pay after 30 days, indirectly that customer is saying that he will be keeping my money, the seller's money, for 30 days. Don't you think there is an opportunity cost? My money, seller's money, is in the pocket of customer for 30 days, and he may have money on the day he bought goods, but because I gave him 30 days, he said okay, I'll pay after 30 days. He might invest that money for 30 days in some stocks and he can earn some dividend. He can lend it to somebody, earn some interest. That means he is earning extra money using my money. It is my money, correct, which was in his pocket. I gave him 30 days. He is making extra return from that money in 30 days. That means four problems. Number one, too much of debtors will only give you book profit in P&L, but you may not have enough cash or bank balance. Number two, you have to have people to do collection, so there is collection administration cost. Number three, bad debt loss. Number four, opportunity cost. But on the other side, what are the benefits? If you say that I will do only cash and carry, read this. On the contrary, if the investment in receivable is low, that means if debtor number is very less, the sales are restricted since the competitors may offer more liberal terms. You may say cash and carry, but today you are in a competitive world, you are not in monopoly. Your competitors may offer 30, 60, 90 days. If you say cash and carry, customers won't come to you. Their customers will never come to you. Forget that. Even your customers will go to them because you are just a trader. Understand? I am selling a soap, correct? For you as a customer, whether you buy that soap from me or from somebody, it makes no difference because I am not a maker of that soap. I am only a seller of that soap. I am a trader of soap, correct? You are buying that soap, whether it is from me or from somebody, the soap remains same. But I am saying cash and carry. My competitor is giving 30 days. You will definitely go there itself. Therefore, if my competitors are offering liberal credit terms, then even I am forced to give more credit period to my customers. Otherwise, my sales will be lost, right? So, in examination, how to decide whether to give credit or not, we have to work out net benefit. Yeah, I have given a small table, a simple format to understand. Present policy, assume I have taken an example. Presently, we are giving 30 days time. And what are we planning? Either giving 60 days or giving 90 days. Sales, they'll give in the question, you just have to copy. Minus variable cost, fixed cost, bad debt losses. Remember, bad debt will be given as a percentage, and that is always on sales. Always on sales. minus collection and administration expenses, right? I told you you'll have to hire people. Their job will be only to, correct? Their job will be only to call all the customers, follow up and collect the money. Profit before tax and opportunity cost. I will first pay taxes. I have taken 30% as example. It will be given in the question. If they don't give you, take 30%, no problem. Yeah. Minus opportunity cost, that will give you net benefit. Sir, one doubt. Why are we not deducting opportunity cost before tax? Just like collection expenses, bad debt, we can do this also. No, you should not. The reason is Income Tax Act doesn't allow opportunity cost. Income Tax Act says opportunity cost is not an allowable expenses, so allowable expenditure. So if you take opportunity cost above profit before tax, then your profit before tax will come down, and then you will be paying less tax, which is not correct as per Income Tax Act. Therefore, what you should do, calculate PBT without considering opportunity cost, calculate tax payable. After that, you deduct opportunity cost. This will not impact taxes anyway, because you're doing it after. You're doing it after tax payment. So opportunity cost will not disturb your tax payment. One very important thing, remember in exam, if opportunity cost and even tax is given, you should first calculate tax, then only opportunity cost. For opportunity cost, I have given a note. This should always be calculated on total cost, that is variable cost and fixed cost. That is, I'll give you an example. Variable cost is 14 lakh rupee plus fixed cost is 6 lakh rupee, total 20 lakh. Sales may be 25 lakh, remember, total cost is 20 lakh. You should do it on cost. Yeah, 20 lakh into opportunity cost, say rate of interest is 12%, and you are giving 30 days time, do 30 into 30 by 360. 60 days time, 60 by 360. Okay, one more doubt. You may find it silly, but many students have asked this to me. Sir, whether to take 360 days or 365 days. Guys, please don't worry about it. You can take either 360 or 365. Accordingly, your answer will slightly differ. Totally fine. You will not lose marks just because you took 360, but they wanted it to be 365. Please don't worry. 99% chances in the question itself they will give you consider 365 or consider 360. It will be printed clearly in the question itself. Okay, if it is not printed, you take 360 or 365, no problem at all. But in working note 1, if you have taken 360 days, working note 2, working note 3, wherever, in that question at least, you keep same number of days everywhere. You take 360, full solution 360. 365, take 365 in the entire solution. Okay. Sir, what if cost details are not given? Suppose this 14 lakh and 6 lakh is not given in the question, then you can do it on sales. See this. If cost details are not given, then calculate this on sales. They should actually give, if not, to take it on. 2, 3 other small points to make a note in this chapter. Sometimes they will give you debtor turnover ratio. Debtor turnover ratio can be used to find out collection period. How? Sometimes they say debtor turnover ratio 4 times. Now, what is the meaning of 4 times? In a year, we collect money from our customers as many as 4 times. Or if you put it here, 360 days divided by 4 times. 360 days divided by 4 times, you get 90 days. Correct? What is the meaning of 90 days? Once in 90 days, you collect money from customers. Indirectly, I am saying credit allotted to debtors. Correct? Credit allotted to customers or debtors is 90 days. So if they give debtor turnover ratio in exam, you take 360 days, again 360 or 65, don't worry. 360 days, divide that by DTR, debtor turnover ratio. That will give you number of days, and this is called collection period. How frequently are we collecting? Done. Sometimes they will ask you to work out the sum under incremental approach. Many students have asked this doubt to me. I thought I'll clarify it in this video. Incremental approach can also be used if question has only present versus proposed. Now in my example, it was present and proposed two policies. Correct? But in some questions in study material, there is present policy, there is proposed policy. Yeah. And in the study material, answer is under some incremental approach. What is this, sir? Many students have this. So listen to me. Suppose at present sales are 100, proposed policy sales are 120. Okay, variable cost 80, it will become 92, something like this. Normally what we do, we follow this table. Sales will write, let me just erase this 1 second. What we normally do, we fill the sales data, correct? We then minus the variable cost, we then minus fixed cost, and so on. Finally, whichever is higher net benefit, we take the decision. But in study material, they have worked out under incremental approach. What is incremental approach? Instead of doing two separate columns, they do something like this. They just write particulars and amount. Okay, instead of writing particulars present and proposed, they write particulars and amount. And then they write incremental sales. Incremental sale means 120 minus 100, sales will go up by 20 rupee. Correct? Incremental variable cost, that is 92 minus 80, that is 12 rupee. Same way, suppose bad debt here 3 rupee, 4 rupee. So here they write incremental bad debt 4 minus 3, 1 rupee, like this. And finally, the answer will not be just net benefit, it will be incremental net benefit. Incremental net benefit, if that number is positive, say positive 5, I'm just writing an example. What is the meaning of positive 5? If you shift from present system, if you shift from present system to new system, correct? If you shift from present system to new system, you will have positive 5 rupee benefit. That means the new policy or proposed policy is better. But instead of positive 5, if you get negative 5, that means it is better to stay with present policy. Shifting to new policy is not a good idea. That's it. So don't worry too much if they ask you incremental approach. It is particulars and amount. Instead of writing sales in two columns, you write increase in sales, increase in variable cost. You don't have to do fixed cost because fixed cost won't increase anyway. Increase in bad debt, increase in opportunity cost, net increase or net decrease. If net result is positive, accept. Otherwise, continue with the present policy. Simple. Hmm? So, I have taken couple of examples for your understanding. See this. ABC Private Limited is considering relaxing their present policy for accounts receivable. They have two proposed policy. Currently, they have 50 lakh sale and debtor turnover ratio 4 times. Just now I told you 4 times means what? 360 days by 4 times 90 days. Current level of loss due to bad debt 1.5 lakh. Required return is 20%, which is opportunity cost, and the company's variable cost is 70%. Identify which is the better policy. Present, proposed 1 and 2, sales given, receivable turnover, bad debt given, mock test paper 20. How did they work out? See this. First, they copied sales, then they deducted variable cost, which they have given here 70%, and then bad debt, expected profit, they have done opportunity cost separately. Finally, net benefit. If you see currently 1175, in future 1220, 1181, therefore 1220 is the best policy. How did they work out opportunity cost? 35 lakh. Now see what is this 35 lakh? They have taken only variable cost. Why? There is no fixed cost in the question. I told you, you should take variable cost plus fixed cost into rate of interest. What if fixed cost is not there? Sorry. What if fixed cost is not there? Take only variable cost. What if variable is also not there, fixed is also not there? Take sales. In this question, variable is available, therefore they have taken into 3 by 12 into 20%. So 20% is okay. From where did they get 3 by 12? Very simple. What is the meaning of 3 by 12? 4 times. 4 times means 360 days by 4 times. 90 days. 90 days means 3 months. Instead of writing 90 days by 360, they have written it as 3 months by 12. Same way here, 4 by 12, 5 by 12. How did they get 4 by 12? Here it is 3 times. 3 times means 360 days by 3, 120 days. So 120 by 360. 120 by 360 is nothing but 4 months, 120 days. So 4 by 12. Here 5 by 12. They got the opportunity cost. They wrote here finally net benefit. In fact, in exam, this expected profit A minus B minus is actually not needed. You can directly do sales minus variable cost minus bad debt minus opportunity cost. Anyway, net result is what matters. There is no use of doing this expected profit. You can skip that. Don't worry. One more sum. A company wants to follow more prudent policy, 9 lakh rupee per annum at present collection period 45 days, selling price 3 rupee, average cost 2.25. Observe, variable cost is 2 rupee. Now, average cost is 2.25 and variable cost is 2. That means fixed cost is 0.25 rupee. But one thing is very, very important. Fixed cost is never shown on per unit basis. Fixed cost is always on total basis. For calculation purpose, I can do that, but that has no meaning. Example, rent of my classroom is 10,000 rupee and I have 1000 students attending. So 10,000 rupee by 1000 students, I can say rent is 10 rupee per student, correct? But understand, if one student doesn't come tomorrow, rent won't come down. If two students extra join from tomorrow, rent won't go up, correct? So this 10 rupee per student has no meaning. 10 rupee per student practically has no meaning. Therefore, rent should always be in total. Total rent is 10,000. Remember 10,000 only. Don't try to understand fixed cost on per unit basis. But sir, here how to do? Understand, they said the sale is 9 lakh rupee, selling price is 3 rupee. So if you do 9 lakh rupee by 3, you will get to know number of units, that is 3 lakh units, and the 3 lakh units if you multiply by 0.25 you will get the fixed cost amount, and that's what they have done here, 75,000. In the working note you can see 2.25 minus 2, that is fixed cost per unit, 9 lakh rupee by 3, that will give you number of units. This is 75, and 75,000 they calculated once and they wrote that in all policies, correct? All policies. Why, sir? Fixed cost, and fixed cost remains same. We all know that very well. Correct? You don't have to calculate fixed cost every time. It's the same number. You calculate once, write it everywhere. So basically sales minus variable cost, which is 2 rupee per unit, correct? And fixed cost, bad debt, opportunity cost, finally net benefit. Wherever you have highest, you consider. Yeah, that's all. This is about receivable management. Important thing is to work out opportunity cost, and I recommend all of you, in study material there is one question where one customer is paying on installment basis. Okay, after 30 days he pays 30% of invoice value, after 50 days another 24% of invoice value, after 90 days another 15%, like this on installment basis a customer pays. That question in study material is actually a very good sum. I want all of you to practice that one sum in addition to this video. Just that one question, please work out one day before exam also, go through that sum. Okay, with that we are done with receivables management. Now we are moving on to next small segment of this topic called payable management. Yes, the next discussion is on payables or creditor management. This even in study material is just 1.5 2 pages. They have never asked a question from this very, very small segment. I will not even spend more than 5 minutes on this very, very simple, very, very easy concept. Just go through again, guys. Whenever I say it's a very small and simple segment, don't ignore that. You never know, 5 marks question may come from that itself. Let that not be a bouncer in exam to you. Okay, don't take chances. That's why even if the topic is very, very small, I'm still covering. That's the reason. You never know from which small segment in the syllabus they're going to ask a 5 marks question. So better not to take risk. Don't spend too much time, but that doesn't mean don't even read that. Okay. Management of your creditors and supplier is just as important as managing your debtor. Trade creditor is a spontaneous source of finance in the sense that it arises from the ordinary business transaction. Here you don't have to go to a bank, or you don't have to go to public and issue debentures or things like that. You want money. For what purpose you want money? You want to buy goods. Instead, buy goods on credit. Instead of taking money and buying goods on cash, talk to the supplier, buy goods on credit. That means it is as good as taking their money in the form of goods. Correct? Instead of taking their money in the form of cash, you are taking their money in the form of goods. If a supplier is giving you goods and says, pay me after 60 days, don't you think indirectly you are using his money for next 60 days? Like in debtor, I said customers are blocking our money. In creditor, we are blocking somebody's money. So it comes as a spontaneous source of finance. That's why they said it comes in the ordinary course of business. But it is also important to look after your creditors. Slow payment to them may create ill feeling, and your supplies could be disrupted, and also it may create a bad image. Some students in the regular batch, they ask this question to me, sir, why should we even study this? Creditor management, simple, sir. Delay the payment, over. Don't pick their phone call, over. Why? To learn. But that's not correct. Correct? If you delay the payment, what will happen? That supplier may not supply goods to you in future on credit. In future, he may say, first pay the amount, then only buy. Cash and carry. I'll not even give you 1 day extra time. Correct? And bad reputation. And that supplier will tell 10 other people, you will never get anything on credit from the market because you have created a very, very bad image for yourself. One small example, that's all that I have for discussion. ABC Limited has been offered a credit term 2 by 10 net 45. Many students don't understand this itself. Such a simple thing. I don't know why many students don't get this. 2 by 10 net 45. What does this mean? I have sold goods to you today. How many days time you have? 45 days. But if you come and pay within 10 days, if you come and pay within 10 days, you will get 2% discount. That's all. I repeat, I have sold goods to you today. You have 45 days to make the payment. Full amount, 100 rupee invoice value, you have to pay 100 rupee within 45 days. But I'm giving you an offer. If you come and pay within 10 days from today, instead of taking 45 days, if you pay within 10 days, I'll give you 2% discount. That means you have to pay only 98 to me if you come and pay within 10 days. If you come and pay within 10 days. If you pay on 11th day, 12th day, or any time before 45 days, you will have to pay full 100 rupee. Very, very simple thing. Students get confused in this also. Hence, the company has a choice of either paying 98 rupee on 10th day, I gave you an example, or look at this now. Invest that 98 for 35 days and eventually pay the supplier 100 rupee. Sir, what is this? Now think about it. Today you purchased, okay, you have 45 days time. This is today. You have 45 days time. After 10 days, you had 98 rupee in your pocket. You are going to the supplier to pay 98 because there was a cash discount offer. Now, if you go this side, you have supplier. And to supplier, how much you will have to pay? 98 because you are doing this on 10th day. Correct? You have another option. Go here, invest. Invest 98 rupee for how many days? Understand, you are taking this decision on 10th day and you have to pay on 45th day. That means you can invest this money for 35 more days. You can invest this money for 35 more days. How much you can invest? 98 rupee. Some people understand it as 100 rupee invested for 35 days. No, that is wrong. You had 98 rupee in your pocket. You were, imagine, riding your two-wheeler on the way. Today's 10th day. On the way you're going. Left side you go supplier, 98 rupee. Right side you go, you can invest. How much? Same 98 rupee. For how many days? 35 days. From 10th day till 45th day. And if you do that, on 45th day, you will withdraw. For 35 days, you can earn some interest, some return on investment. The decision as to whether the discount should be accepted, that is, whether I should pay on 10th day or invest and pay on 45th day, depends on the opportunity cost of investing 98 rupee for 35 days. Analyze what should company do. I have taken an example. Consider 10,000 rupee invoice value, 25% as return on investment. See, if you accept discount, your outflow will be 9,800, 10,000 value, 2% discount. If you don't accept discount, then you'll have to pay full 10,000. But here one advantage, you can invest that 9,800 from 10th day up till 45 day. That's why I've taken 9,800, 25% return for 35 days. You can earn 235 interest. Now I've taken with negative sign because 10,000 is an outflow. This 235 is inflow. So if you accept discount, your outflow is 9800. If you don't accept, that is if you pay on 45th day, outflow is only 9765, which is good decision now. Refuse the discount and pay on 45th day. That's all. This is the only thing. In study material also, you have only one or two questions. There is one question in study material which you can go through. When I say study material on this creditor management, there is a question. The Mohit company name, Mohit is the accountant and he has delayed the payment instead of paying on 10th day, he's paying on 15th day. Why is he not doing so? That one illustration you can go through. That one sum is reasonably good. Otherwise, creditor management should not take more than 5 minutes one day before exam to you. Okay, that's all in this topic. We will have to now go to the most important, the biggest part of the chapter, which is overall working capital management, which is 7.5. Understand, this is starting from 7.1, correct? Cash and treasury, receivable, inventory, and this payable. All of this now in 7.5. All of this put together is one chapter, and you can expect minimum one question, maximum two questions. That's why I told you it's a very big topic. So don't spend too much time on creditor and inventory and all of that. You should study, but not too much. Focus more on the overall working capital management. Okay, we now start 7.5. Yes, this topic, overall working capital management. Let us first understand the basic meaning of working capital. It's the difference between current asset and current liability. In simple, how much money, how much of your money is blocked in day to day affairs. You need some money for deposits, advances, you need some money to purchase raw material, you have produced FG but you're not able to sell. Again, your money is blocked there. You have sold goods but your customer has not paid. But you will have to pay rent, salary, electricity, internet, so many expenses on monthly basis. All of that is your day-to-day affairs. Correct? Here we are not talking about plant, machine, land, building. We are only talking about day-to-day affairs. How much money you need for your day-to-day activity. That is discussed here. The difference between current asset and current liability. The practical segment of this chapter has two major areas, that is estimation of working capital under two methods. First, using operating cycle approach. Second is listing out all the current asset, current liability one by one, and then total of CA minus CL will give you working capital. See this. Operating cycle is the time gap between cash outflow and cash inflow. That is, today if I pay money to supplier and buy raw material, I will keep it for 30 days. Then start the production, that will take 10 days. Then it becomes FG in my showroom, it is there for 30 days. Then I sold it to customer, he takes 30 days. That means finally I'm going to get my money back maybe after 90 or 100 days. This 90 days or 100 days is called operating cycle. Hmm? From day to day business, from day to day perspective, the day business pays to the day business gets back the money. How to calculate? One operating cycle is equal to raw material period plus WIP plus FG plus debtor minus creditor period. Let me give you an example, you will understand it better. See, suppose day 0, I purchased raw material. For 40 days, I kept it as raw material as it is in my warehouse. I did not touch that material at all. Done. Finally, I started the production. Day 50, it got over. That means WIP took 10 days. Okay. Then I kept this item in my showroom. Now this is FG. After 30 days, a customer came and he bought it. Now this is FG period. Correct? After WIP comes FG. Then he said he will pay me after 40 days. That means he will be paying me on 120th day. This is called debtor period. So if I have paid money on day 0, cash outflow, the money will come back to me on 120th day as cash inflow. This 120 days is called one operating cycle period. Now, I have assumed in this example that I purchased on day 0 and I paid immediately. Correct? Now, if debtor is taking time, you can see in the line last part, if debtor is taking 40 days time from 80 to 120, I can also take some time from creditor. Imagine my creditor is giving 30 days time. That means cash outflow will not happen on day 0. It will happen now on day 30. Here is my cash outflow. Correct? That means now one cycle is not from 0 to 120, it is from 30 to 120. That means operating cycle is only 90 days. Able to follow? It will start from 30th day, that is when there is cash outflow. From there I have to go to 120 days. So therefore, what should be the formula? Raw material was with me for 40 days, WIP was with me for 10 days, 40 to 50, and FG was with me for 30 days, 50 to 80. Debtor took 40 days time, that is 80 to 120, correct? And I have taken 30 days time, therefore I should do raw material period plus WIP plus FG plus debtor minus creditor. That is, I'll start from 0. Instead of starting from 30, I will start from 0, go till 120. I will only minus this 30. That is the reason the formula RWFD finally minus C is creditor period. How to calculate number of cycles? See, in my example, it was 90 days, correct? And then if I do 365 days by 90 days, I will get to know how many cycles are there. Okay, let me take for ease of calculation this number as 360. 360 by 90 is 4 cycles in a year. Now, what is the meaning of 4 cycles? If I put money today, it will come back to me in 90 days. Like this, in a year, money will come back to me 4 times. Able to follow? Money will come back to me 4 times. That means if I put money on day 0, it will come back on 90th day. Same money I can reuse. Correct? I paid, now I received. The money that I have received, I can reuse from 90th day, 180th day, 90 more days, from there 270th, from 270th to 360th. Same money I can reuse in the next year as well. This will tell me how many cycles. Now, what is the use of knowing how many cycles? Working capital will be annual operating cost, that is basically total cost, you minus the depreciation, only cash cost, divided by number of cycles. Suppose I need 10 lakh rupee for the entire year, 10 lakh rupee, I need to divide by 4 cycles. All that I have to keep in my pocket on day 0 is only 2.5 lakh rupee. Understand the logic. I will keep 2.5 lakh rupee. I will invest that on day 0. When will I get that money back? On 90th day. Same 2.5 lakh, again I will invest. That will come back to me on 180th day. Again I will reinvest. Again that will come back. That means same 2,50,000 I can keep rolling. How many times? 4 times. If I do that in a year, I can spend 10 lakh rupee. That means to spend 10 lakh rupee for one full year, I don't have to keep 10 lakh rupee on day 1. I have to keep only 2,50,000 with me. I hope everyone is able to understand. Correct? Now, suppose this 90 days, suppose this comes down to say 30 days, then what will happen? 360 days by 30 days, number of cycles will be 12 cycles. Correct? And then 10 lakh rupee per annum, I will have to just divide by 12 times. So 10 lakh divided by 12, I will require only 83,333 rupee as working capital money, which means you observe here, I can spend same 10 lakh. I can spend same 10 lakh rupee for the whole year by keeping just 83,333 on day 1. That means one thing that every business should try and do is reduce this operating cycle period. Instead of 90 days, make it 30 days. Number of cycles will improve. What is the meaning of number of cycles going up? Movement will be very fast. Movement is very fast. What does that mean? Money will come and go very, very quickly. Therefore, you don't have to keep too much money on day 1. Just for next 30 days, whatever you need, you keep it. 30th day, that money will come back, reuse it, and repeat this for the entire year. Correct? Think of milk shop. They buy goods midnight at 4 a.m., 4 o'clock. Correct? Suppose they take 1 day time from the supplier. So 4 a.m. they buy, they sell, they collect cash, and they pay to the creditor. Again goods will come, again they do this. That means their working capital cycle or operating cycle is 1 day or maybe even less than 1 day. If they buy in the morning 4 a.m., same day 9 p.m. before closing the shop, they can pay to the creditor and go home. Next day again 4 a.m. they'll buy goods, and this cycle, their cycle is very, very fast. That means they will always have surplus cash with them. They will never have blockage of cash in the form of working capital. Why? Because the movement is very, very. Now these numbers, raw material days, in my example I told you 30 days, 40 days, 50 days and so on. In some questions they will give. What if they don't give? If they don't give, I've given you a list of formula how to find out all of this. RM period, average raw material by RM consumption. WIP, average WIP by RM labor factory opening closing. FG period, debtor period, creditor period. Many people find it difficult to remember these formulas. I'll give you a simple technique how to remember this. RM period you want, correct? Numerator, let it be average. And this is applicable to all formulas. You want WAP, average WAP, FG, average FG. Debtor, basically whatever you want, average of that number is numerator. Simple. Whatever you want, average of that number is numerator. Done, sir. Divided by What do you do with RM? RM you consume. What do you do with WIP? You produce. What do you do same way? Debtor, you sell. Creditor, you purchase. Correct? That means numerator is average, denominator is activity. RM, average RM. By what do I do with RM? I consume. WIP, average WIP. WIP means I produce. Now to produce what all I need RM. Observe the denominator. I need RM. In addition to that, I need some labor. Correct? Production won't happen automatically. I also need factory overheads, some expenses to be incurred in factory for the production. I add opening WIP, deduct closing WIP to calculate the net cost of production. Here also you understand when I say RM consumption, how to get RM consumption? Opening stock plus purchase minus closing stock. That means here also I am adding opening and deducting closing. This was only RM. Now I am taking RM consumption. Correct? That means opening and closing RM adjustment is done. WIP you have to do separately. For FG also you observe same RM, same labor, same factory, same opening closing WIP. Extra thing you have to do is add deduct opening and closing FG. Very simple. So WIP denominator can be called as COP, cost of production. FG can be called as cost of goods sold. Debtor, what do you do with debtor? Credit sale. Creditor, what do you do? Credit purchase. Very simple. Yeah. Now, without reading from the textbook, what are the formulas? RM period, average RM by RM consumption. WIP, average WIP COP, cost of production. FG, average FG by cost of goods sold. Debtor, average debtor by credit sale. Creditor, average debtor by credit purchase. Everything into 365 days because you want answer in number of. And once you get the number of days, then you will use R plus W plus F plus D minus C. That formula I already. One small example. Balance on 1st April, balance on 31st. RM, WIP, FG, debtor, creditor. Now, why did they give opening and closing? So that you can calculate numerator is average everywhere. To calculate average, you need opening and closing. Sir, one doubt in exam. What if they don't give? What if they don't give average? Then what to do? Then simply take closing balance of everything as numerator, give one note. Chalo. And then annual purchase given, cost of production, cost of goods sold, annual cost, annual sale, take 365 days. See what they did. First, raw material storage. Average RM opening plus closing by 2 divided by RM consumption. How did they get consumption? Opening plus purchase minus closing, 53 days. WIP, same way. Average WIP 35 plus 51 by 2. COP, cost of production already given, into 365, 21 days. Same way, 26 days, 41 days, 55 days. By the way, once you download this soft copy, you can also work out these sums. And then they brought all these numbers here, 53, 21, 86 and so on. Finally, 86 days. What is the meaning of 86 days? If you put money today, it will come back to you after 86 days. So in a year, how many cycles? 365 days by 86, 4.244 cycles. 4.244 cycles. And amount of working capital is 9,50,000 you want to spend, and money will come back to you 4.244 times. That means you need to invest 223,845 on day 1 itself. Yeah. And if depreciation is given, ignore it because you don't have to arrange money for depreciation. Many students get confused. Sir, why are we not taking depreciation? Working capital is all about how much money, in inverted comma, how much money is required for day to day affairs. Now, rent I have to pay, salary I have to pay, electricity I have to pay. For all this, I need money in pocket. Depreciation, should I pay to anybody? It is only an accounting entry. Why should I arrange money? Will the businessman think, oh, end of the month I have to pay rent also, depreciation also? Where is the money for depreciation? Why should you worry about money for depreciation? You are not paying anything to anybody, therefore, you don't have to consider depreciation. This is one way of estimating working capital. There is another way which is estimating all the components of current asset and current liabilities. That is, see one by one. Working capital is equal to current asset minus current liability. When I say current asset, I include all of this: RM, WIP, FG, debtor, bills receivable, cash, bank, even advances, deposits, include everything. Current liabilities include creditor, bills payable, outstanding or accrued expenses. How to calculate RM? Simple, purchase price minus discount. WIP. RM, you also need some labor and factory overhead into degree of completion. Degree of completion is given for WIP, say 70%, 80%. Anything above 0, below 100. Sir, in exam, if they say WIP but they don't mention degree of completion, what to do? If they don't mention, you can consider material 100%, labor and overhead 50%, 50%. Why material 100? Because most of the production process, raw material goes inside the machine at the beginning of the process itself. Most of the production process, raw material goes inside the machine at the beginning itself. But labor and overhead expenses are incurred throughout the process. Therefore, raw material, the moment you start the production, consider 100% cost is incurred. Labor and overhead, you have to incur throughout the process. Therefore, if nothing is given, assume half of the work is done. Therefore, take 50% labor overhead. Material can be taken as 100%. FG, same RM, labor, factory overhead. I don't have to multiply with degree of completion because if I call it as FG, it is 100% complete. And if something is 100% complete, what is the use of multiplying that by 100%? You will get the same number. Debtor, RM, labor, all overhead, basically total cost. Cash and bank, as given in the question, they will give. You don't worry. If they don't give, ignore. Creditor, RM, purchase price minus discount, nothing but raw material. Yeah. When you work out working capital estimation, remember by default we do it on cash cost approach. 2 minutes back I told you, you don't have to worry about depreciation, you don't have to worry about non-cash item. That's why I call it as cash cost approach. If you have sundry debtor worth 1 lakh, our cost of production is 75, actual amount of fund blocked in debtor is only 75. Therefore, you have to work out debtor based on 75,000, not on 1 lakh, because the 25,000 profit is a number that you have added, but you have never spent that money from pocket. Understand? I bought it for 75,000. I sold it to 1 lakh. Did I spend 1 lakh? No, I have only spent 75,000. So debtor is valued at total cost, not at sale value under cash cost approach. Also, suppose out of 75,000, if 5,000 is depreciation, then you will not even take 75,000. You will take only 70,000. In simple, depreciation and other non-cash items are ignored. Debtors are always valued at cost, not at selling price. This is one approach. By the way, many places you had the word overhead. Which overhead? I've given the note. If overheads are not segregated as factory, office and selling, student can consider the word overhead as factory overhead. Where is it relevant? You observe for WIP, they said factory overhead. FG, they said factory overhead. Debtor, they said all overhead. Now, other than factory, which are the other overheads? Office, admin, selling, distribution. If they give the breakup, you can take it correctly in correct place, in the right place. What if they simply use the word overhead? Which is that? Is it office? Is it selling? Is it admin? To clarify the confusion I gave, if question doesn't say anything, consider overhead as factory overhead. And what I discussed so far is cash cost approach. Don't take depreciation. Debtor is valued at cost. There is another approach. Now this you have to read in the question and decide in exam. There is another approach called total cost approach. Under that approach, depreciation is treated as part of the cost. Debtor is valued at selling price. Simple two differences. Debtor take at sales value. Cost, when I say, include even depreciation. Simple. Sir, in exam, which approach to follow? If nothing is mentioned in the question, see here, unless given as total cost, students are required to follow cash cost approach only, as that is accepted by bankers and other financial institutes. Remember, if question is silent, you simply go by cash cost approach. What if question specifically says that you have to work out under total cost only, then only you follow total cost. Question is silent, you go by cash cost approach. That is, depreciation is excluded, debtors are valued at cost. I've given a small example. Material, labor, overhead. See now, simple word overhead. It should be understood as factory overhead. Total cost, profit and price. Company keeps raw material in stock on an average for 1 month. Therefore, go to the answer for raw material 1,30,000 units, 100 rupee into 4 weeks by 52 weeks, because they said it is kept for 1 month. WIP 1 week, FG 2 weeks, credit allowed by supplier 3 weeks, company allows 4 weeks time to debtor, lag in payment of wage. Lag means delay, outstanding. Lag in payment of overhead, again outstanding. Company sells 1/5 of output against cash. That means balance on credit. So when you work out debtor, you have to take total sales. They have said 1,30,000 here. 1,30,000 into only 4 by 5 is credit sale. 1 by 5 is cash sale. Remember. And maintains cash in hand of 37,500. Estimate working capital for 1,30,000. Work in progress, they said 80% in all respects. When they say all respect, material, labor, overhead, everything is 80%. They use the word all respect, that means it's for everything. So you see what they did in the answer. Everywhere you can observe. They took 1,30,000 units, 100 rupee material, 4 week by 52. WIP 1,30,000 units, 212.5, that is cost per unit, into 1 week by 52 weeks into 80%. FG also same way. Guys, I have given the question as well as the solution. Once you complete watching this video, you can download this soft copy, work out these sums. If you don't understand any solution, please put your questions in the comment box. I will reply to you. Okay. Answer is there. Therefore, you can also practice 1,30,000 into cost per unit into 4 by 5 only. Why? Because you are doing debtor. 1/5 was cash, balance is taken on credit, cash and bank already given. Same way, raw material, outstanding wage and overhead, current liability, difference between C and CL will be your capital. One important segment, mark this question important, and you also spend little extra time on this. In study material also, there are some questions where the first line of the question says newly formed company. Whenever you are working out a problem on working capital estimation, under the heading or this variety, under the category newly formed, understand there is no opening stock, no RM, no WIP, no FG. If question is silent, that means it is for ongoing business. For ongoing business, what happens? You will have some opening stock, you have some closing stock. If nothing is given, you can assume opening stock itself is equal to closing stock. Ongoing business. But if it's a newly started business, there is no opening stock. You may have some closing stock at the end of the year, but there is no opening stock. They have applied to the private bank for the first time for financing the working capital and so on. Estimated level, material, labor, overhead, again including depreciation. So you will not take 40, you will take 30. Selling price given, raw material stock, WIP, FG, credit allowed and so on. Here, there are some areas of confusion. Let me clarify what they did. They have worked out cost of production, that is 31,200 completed production. You have the PDF, you can go through the question later. I won't scroll up and down too many times, it will be disturbing for you to understand that way. You can keep the question sheet in a separate tab. Plus 12,000 WIP, on that also material is fully spent. So 40. This is RM cost. Labor 31,200 into 15. This is for completed production. 12,000. This is WIP. Only 50% complete. Only that they have taken. Overhead excluding depreciation they have taken. Completed unit into 30. 12,000 WIP into 30 into only 50%. This is the factory cost. Closing WIP they deducted. Correct. 12,000 units into 40 plus 7.5. How did they get 15 into 0.5? 30 into 0.5. Cost of goods sold. Closing stock, that is 2652 is for 24,000. Sorry, it is for 31,200. How much is for 24,000? They got cash cost of sale, and this they will use for debtor and other calculation. You can see debtor here 612,000 into 60 by 360. WIP, just now I told you, 12,000 units material fully spent, 12,000 into labor only half spent, 12,000 into 30 only, don't take depreciation, overhead half spent. Raw material, very important. They have taken for finished goods and for WIP. 1728,000, this is what you have to buy. Buy so much? 31,200 completed units on that 40 rupee per unit, and 12,000 units you have started the production but you have not completed the production, but material is fully spent, therefore you have to take into 40 there also. So you need to consume 1728,000. But later you observe, when they worked out creditor, they took the 1728,000, they added closing stock of material 144, which they got from this answer 144. And how did they get 144? This number 1728,000, yeah, into material is kept for 30 days into 30 by 360. Sir, why did they add this? Understand, the newly formed company. What happens in a newly formed company? You do not have any opening stock, correct? So consumption will not be equal to purchase. You have to consume something, for that you have to purchase, plus end of the year you have to keep some closing stock, for that also have to purchase. There is no opening stock. Therefore, for creditor computation, you have to take consumption plus closing stock. That will tell you how much should be purchased. Actually, what is the formula for purchase? Consumption plus closing stock minus opening stock. But there is no opening stock because it's a newly formed company. Because it's a newly formed company. Therefore, I have to simply take consumption plus closing stock. That becomes purchase, and creditor calculation will be based on that purchase amount. This you have to do only if it is a newly formed company. Okay, everybody, at least once one day before exam, in this category, that is with newly formed company adjustment, you should work out without fail. Please mark, make a note somewhere, and you have 2 3 questions in study material also on this newly formed company adjustment. Please do at least once one day before exam. Right. The next segment is maximum permissible bank finance. Okay, you worked out working capital CA minus CL. You got the number. You went to the bank and said, "Sir, give me loan." How much is the loan you want? Sir, current asset 100 lakh, liability 30 lakh. I need 70 lakh for day to day. Give me 70 lakh. Will bank give full 70 lakh loan? No. Tandon committee, which was formed by RBI and central government, gave their report in 1984, and they have come up with 3 formulas, and banks can follow any of the 3 formulas and give you loan. First formula is 75% of CA minus CL. That is, you wanted 100 current asset, 30 current liability, you wanted 70 rupee, 75% of 70 rupee is all that you get. 70 into 75%, your loan amount will be 52.5. Later I will show you with one example. Second, 75% of CA minus CL, that means it is 75% of 100 minus fully 30. That means 75 minus 30, this may be just 45. Third one, 75% of soft core current asset minus current liability. Soft core is current asset minus core current asset. I have given an example here. Let me explain to you in simple. What is this core current? Some books use the word hard core current asset. Simple core current asset. What does it mean? I am running a hotel. For me, vegetables are raw materials, correct? And I also had some extra cash. I bought some other company shares, temporary investment. Suppose I have shortage of cash. What will I do first? Will I sell the vegetable first, or will I sell those shares that I have bought for temporary purpose? I will sell the share. Why? Because by selling that share, my regular business won't get affected. If I sell the vegetable, how will I run the hotel from tomorrow? That is my core current asset inventory. This temporary investment that I have made, these are not my core current asset. Understanding? So without that current asset, I cannot run my business at all. Then that is a hardcore current asset. Very, very important to me. But without having those temporary investment in some other company share also, I can survive. I will first sell that. That means these are not core current. This explanation is given here. One small example. Again, this is one area which many students ignore. Maximum permissible bank finance, MPBF. Very important. They can ask a 5 marks question, will be a bouncer to many students if they don't study. Yeah. See this. Current liability given, current asset given, core current asset given. Suggest. So, not suggest, calculate. So, first one is 75% of CA minus CL. How much is current asset total? You have to total all of this. 20 plus 10 plus 40 plus 150 plus 120, 340 minus current liability will be 120 plus 40, 160. So 340 minus 160 into 75%, 135 minus into by 40 to 75%, correct, 135. Second method, 75% of 340 minus 160. So here 340 into 75% minus 160, this comes to 95. Third, 75% of 340 minus core current asset 80. Yeah, minus 160 here. So first I do 340 minus 80 on that 75%. From that I deduct 160 to get a loan of only. So if there is this hardcore current asset or core current asset, minus that. So total CA 340, in that take out 80, 75% of that number minus 160, the maximum permissible bank finance. Sir, out of three formulas, which formula will the bank follow? That is up to bank. But Tandon committee said you can follow any of these three formulas. If they follow first one, you will get more loan actually, more working capital loan. If they follow second or third, you can see you're going to get very, very less loan. Please don't ignore this area. Okay. And somewhere please make a note, from working capital management, you can expect either a theory question or a practical question. Both are important. Study both theory and practical with equal seriousness when it comes to this chapter. Very, very important. Both theory and practical can be asked for 5 marks theory and a 5 marks practical, or a 10 marks question and still a 3 or 2 marks theory question can also come topic. Okay, all right. With that, we are done with working capital management. Let's move on. Last topic, that is ratio. Yes, let's start ratio analysis. Chapter that has too many formulas. Let me explain all the formulas to you. I'll give you a simple, easy way, simple technique, easy way to remember all these formulas. Be surely helpful to you. And there is no limit on how many questions you can solve on ratio analysis, because most of the questions they will give you ratios and ask you to work out or prepare the balance sheet in P&L. If you understand the logic and concept behind those formulas, you will be able to solve any complicated, even the reverse working balance sheet and P&L preparation sum. Okay, so let me begin. First set of ratios are liquidity ratios, current ratio, current asset by current liability. Very, very simple. This will tell you whether you have the ability to pay your day-to-day liabilities or not. Ideally, ratio should be 2 by 1 or 2 is to 1. That is, for every 1 rupee of current liability to be paid, a company should have at least 2 rupee of current asset with them. Hmm? Quick ratio, acid test ratio or liquid ratio, we do quick asset by current liability. Quick asset is nothing but current asset minus stock. Some books minus the prepaid expense also. You can just go by current asset minus stock. Now, what is the use of knowing this? Current asset has all variety of current assets, but out of that, stock, RM, WIP and FG, it takes more time to get converted to cash. It takes more time to get converted to cash. Therefore, in quick ratio, I minus the stock. So what is left out now? Debtor, bills receivable, cash in hand, cash at bank, temporary investments, marketable securities. In this, all the current assets other than stock, all these current assets can be quickly and easily converted to cash. You need money from debtor, you can go request, get the check, go to the bank, deposit. If not immediately, at least within 1 day or 2 day, you can 2 days, you can get that converted to cash. But if you have raw material WIP or FG, it will be very difficult to convert. Though it will be called current asset, but it won't be converted to cash overnight. Within 2 3 days, you can't convert WIP to cash. Correct? It may take weeks, sometimes it may even take months. That's why the word quick asset, where you can convert your current asset quickly into cash. Cash ratio, absolute liquidity ratio. Cash, bank and marketable security by current liability. Many students don't understand this ratio. My simple suggestion to all of you, if you're finding a ratio to be very difficult, put some numbers. It will start making sense to you. Suppose cash plus marketable security plus bank. All of this comes to 10,000 rupee. Take an example. Divided by current liability is 5,000. What does it mean? 2 by 1 or 2 is to 1. For 1 rupee current liability, I have readily available cash, bank and marketable security. Now this is next step of second ratio. In second ratio, I only minus the stock from current asset. Here I am minusing everything, debtor, receivable, advance, deposit, everything. I only take cash readily available in pocket, bank, go to ATM, withdraw in 5 minutes. Marketable security, go to demat account, sell those shares, convert to cash quickly. All of this can be done just like this. Correct? Basic defense interval ratio, cash bank marketable securities, assume same 10,000 rupee, daily cash operating expenses. Suppose every day I spend 1,000 rupee in my business and I have 10,000. What does it mean? I have 10,000 with me and I need 1,000 rupee on daily basis. That means even if all receipts are stopped from tomorrow, even if all receipts are stopped from tomorrow, you can still survive for 10 days. 10,000 rupee you have, 1,000 rupee you need, same 1,000 you spend for 10 days, you still have that much money. Correct? This will tell you if all revenues are suddenly stopped, how long can a company survive? How higher the number, better it is. Correct? Imagine a lockdown comes. How many days can I survive without having even 1 rupee receipt? That is next. Long term solvency ratio, equity, debt, and debt equity. Understand all of this together. Here, shareholders fund by total capital. Here, debt by total capital. Here, debt by shareholders fund. Let's assume shareholders capital is 2 rupee. Total capital is 3 rupee. So this is 2 by 3. Then debt will be 1 rupee out of 3 rupee. Now debt by shareholders will be 1 by 2. Simple. Shareholder is 2 out of 3. Debt is 1 out of 3. That means this should be 1 by 2. Yeah. Debt to total asset, total debt to total asset. Now again, sir, what is the logical meaning of this if I'm not able to understand? Suppose total assets are 10,000. Yeah, total debt is 8,000. What does it mean? 8,000 by 10,000, 0.8 or 80%. What is the meaning of 80%? 80% of the total assets are funded by debt. Balance 20% funded by equity or preference or reserves and surplus. That's all that is possible. If it is not debt, it has to be from owners. Owners means shareholders. Correct? Again, I repeat, if you do not get the meaning of a ratio, put some numbers, it will automatically start making sense to you. Capital gearing ratio. Observe long term debt plus preference share capital divided by equity shareholders fund. What is one common thing between long term debt and preference share capital? Both of them come with fixed expectation. Both of them come with fixed expectation. Fixed expectation means end of the year you have to pay. For debt you have to pay interest. For preference shareholder you have to compulsorily pay dividend. But look at the denominator, equity shareholders fund. This has no fixed expectation. These are flexible funds. What funds? Flexible funds. If you have money you pay dividend, you don't have money you don't have to pay. Yeah, that's why it's called gearing. Gearing means leverage, advantage. Proprietary ratio, proprietary fund by total asset. Proprietary fund means share capital, reserves and surplus. Basically, shareholders fund. Again, 10,000 rupee total asset, 2,000 rupee proprietor. That means this is 0.2. 20% of the assets are funded by owners, proprietor. Easy. Next, coverage ratio. This is what lenders check. Lenders, basically those who are giving you money. Debenture, banker, all financial institute. Look at this. Earning available for debt service by interest plus installment. Installment here is principal because I have already taken interest. So it is interest plus principal. What does it mean? Suppose I go to bank and ask for loan. What will the bank manager ask? How much are you earning? In that, what all the expenses that you have to pay for your monthly family expenses to be paid, they will minus all of that. Suppose my monthly earning is 50,000 rupee and all my fixed committed cost is coming to 20,000. That means I will have 30,000 rupee. This is earning available for debt service. Okay. Now 30,000 is available with me at the end of every month. And bank asks me how much loan I want, how many years I will repay it within, and what is the rate of interest. Using that, they will find out how much will be monthly principal plus interest component, which is EMI. Suppose if EMI comes to 32,000, they will say, boss, sorry, I can't give you loan. Why? EMI itself is 32,000, and from your salary minus your cost of living, you will have only 30,000. How will you pay our EMI? Correct? So, what banks check? Whether you have the ability to pay or not. What if this is 20,000? Now you see EMI 20,000, but this guy will have 30,000. That means this guy will have 1.5 times of what is to be paid to the banker. Banker will be happy to give loan. Here I have given the last line note. DSCR of 1.5 to 2 is satisfactory. That means it should be more than 1.5. That means if EMI is 20,000, you should at least have 30,000 more than that is necessary, 31, 32, 33,000 if you have, then bank will be very happy to give you loan. Sir, what if this number is very high, like 9 times, 10 times? Then bank will ask, boss, if you are earning so much, why do you need loan? If you are going to have so much cash with you, why do you need our loan? Correct? Therefore, it will be ideally in the range of 1.5 to. Next one is interest service coverage. See, the previous one was debt service coverage. There, they were checking everything, principal as well as interest. Here, they are checking at least will you have ability to pay interest. EBIT is the profit that you earn. Say 10,000, interest itself is 8,000. Now, bank will feel safe. Why? They need 8,000 only from me. They can see I am earning EBIT of 10,000. This is greater than 1. They are happy. So all that they want is more than 1 because they know now they will get their interest. Next one, preference dividend coverage ratio. If you are a preference shareholder, what will you check in a company? Will that company pay preference dividend? That means you will check whether they have earning after tax to pay you money, because from EBIT you first pay interest. EBIT minus interest, it is EBT, minus tax you have EAT. From there you pay preference dividend. Imagine preference dividend is 8,000 and EAT is 9,000 rupee. Now preference shareholders are happy because they know they will get their dividend. Correct? What if this is 18,000 and EAT is only 9,000? Preference shareholders won't like such companies because that year you are not going to get dividend. They may pay full 9,000 to you, but still another 9,000 will remain accumulated, and in future they will have to pay. Why will you invest in such companies when you are not sure of getting preference dividend of that year in the same half? Again, this should be greater than 1. Next, activity ratio or efficiency, performance or turnover. This is one place where many students have some confusion. I won't say doubt, some confusion. That is because the way they have solved some questions in RTP and study material. See here, total asset turnover, fixed asset turnover, current asset turnover, working capital turnover, capital turnover. What is one common thing everywhere? Turnover. Yes, put that as numerator. Simple. Sir, what is the denominator? You want total asset turnover? Put that as denominator, total asset. You want fixed asset? Fixed asset here. Current asset here. Simple. Same way. Now, what is the confusion that students have? Sir, it says turnover, or turnover means sales. Sales or COGS. What if both are available in the question? Which one to take? Take the first one, turnover. That is sales. If sales are also given, COGS is also given, always take sales. What if sales is not given? Take COGS. Correct? Now the confusion is, sir, in some books, in study material, in some places, sales given, COGS is also given. They have done COGS, sir. They should have given one note also. You do it on sales basis. Don't worry, you also give one note in exam. Simple. One more reason some students have confusion. In some places, they won't give sales at all. And they say total asset turnover in bracket based on COGS. That means they are not using turnover. Everywhere you also use COGS. If in question itself in bracket they say based on COGS, why do you want to use turnover? Use COGS. Understanding? First of all, read question carefully. If they say in bracket based on COGS, you also work out everywhere based on COGS only. Understanding? Both are given, go by turnover. Even if they, in some answers they have done on COGS, even they would have given a note. In exam, to be on a safer side, you also give one note. Chalo. Capital employed can be replaced with the word net asset, that is nothing but FA plus CA, fixed asset plus current asset minus current liability, or you can simply call it as capital employed. Correct? Either fixed asset plus current asset minus current liability, all, or rest everything on the liability side, which is capital employed. Inventory turnover, something that you know. Here, observe again. COGS or turnover. Now, which one is the first preference? COGS. Remember one basic thumb rule. Wherever you see a formula which has something or something, always first preference is first term. Here, COGS is the first term, use that. Turnover is the second thing, use turnover only if COGS is not there. Yeah, divided by average inventory. For average inventory, you need opening plus closing by 2. What if opening is not given? Take closing. And all the turnover ratios are measured in times. Remember, measured in times. Sir, what is the logical meaning? Let me explain logical meaning to one. You can apply the same logic everywhere. Suppose turnover 10,000. Total asset 5,000. Now this I told you measured in times. 2 times. What is the meaning of 2 times? From every 1 rupee of total asset, you are generating 2 rupee turnover. From every 1 rupee of asset, you are generating 2 rupee turnover. Come back. Debtor turnover, credit sale by average debtor, creditor turnover, credit purchase by average creditor. Now this comes to 8. What does it mean? 8 times. And I already told you in receivable management, 360 days by 8 times will tell you number of days, collection period. Here, if creditor turnover comes to 10 times, that means in a year 10 times you make the payment. So 360 days by 10 times, 36 days, which means once in 36 days, you make the payment. Yeah. Next, some easy ratios: GP, NP, operating profit. You know all of this. GP by sales, NP by sales, operating profit by sales. Sir, what is the difference between NP and operating profit? Understand, your net profit, which comes from P&L account, this can be disturbed. What do I mean by disturbed? So many things can come and sit in P&L account. Profit or loss on sale of investment, interest you earned from some investments that you had made, dividend that you received, some lottery a company wins, some loss of stock due to fire, insurance claim against that. Anything and everything can come and sit in net profit, that is P&L account. But when I say operating profit, I will exclude all non-operating items. What do I mean by non-operating items? All these, those that are not related to day-to-day affairs, those that are not at all connected to my main business. All of that I should exclude. All of that I should exclude. So operating profit will have only day-to-day regular business activities. Net profit can have anything and everything. Return on investment, profit by investment into 100. Now the word return on investment is a very general word. Profit by investment. Which profit? Now investment, which investor has invested? Now a debenture holder might have invested, equity shareholder may be there, preference shareholder may be there. All these guys have given some money to the company, correct? Therefore it is further analyzed as return on asset, return on capital employed, and return on equity. Return on asset is PAT, add back, PAT is profit after tax, add back interest by average total asset. Average is basically last year and this year closing balances, or opening balance of this year plus closing balance by 2. Why am I doing PAT plus interest? Understand, from profit before or earning before, interest and tax, EBIT, you pay the interest, you get EBT. Why are you deducting interest? First to calculate the correct tax, and then you add back the interest. This is more like the CFAT that we did in capital budgeting chapter, correct? Same logic is applied here also. You add back interest to find out the correct profitability by deducting the tax only. First to deduct interest to calculate correct tax, you then add back the interest to calculate the correct profit that you have earned. Return on capital employed, EBIT by capital employed. This I discussed even in the risk and leverage chapter. Return on equity. Now, when you say return on equity, you are thinking purely from the angle of equity shareholder. Now, what will equity shareholder get? Not EBIT, correct? From EBIT, first you have to pay interest. This is for debenture, EBT, and then you have to pay tax. This is to government. I am an equity shareholder. I've still not got anything. Then you have EAT. You have to first pay preference dividend. Now there is some earning available to equity shareholder, which I write as ETISH, earning available to equity shareholder divided by equity shareholders funding to 100. This is written from equity shareholders perspective. Done. This return on equity that we studied just now can be analyzed using a model or a formula called DuPont model. DuPont has 3 aspects. One, net profit margin, next asset turnover, and then equity multiplier. Now what is NP margin? You all know, profit by turnover. Then asset turnover, turnover by total asset, all simple. Equity multiplier, asset by equity. Yeah, in simple, observe. I am coming in reverse order. I have given 100 rupee as an equity shareholder to a company. From that 80 rupee they have used for purchase of assets. Only 20 rupee they are spending for day-to-day purpose. This is the last part, equity multiplier. Using 80 rupee asset, they generated 160 rupee turnover, asset turnover ratio. I said I'm coming in reverse order. From 160 rupee, they are making 16 rupee profit. Observe here, from 100 rupee I gave, 80 rupee is going to asset. This will tell me how safe my investment is. Why am I using the word safety? Tomorrow, if you close the business, at least 80 rupee will come back to me. 20 rupees paid for day-to-day expenses, rent, salary, electricity. That money will never come back when company goes for liquidation. But the 80 rupee, which is in the form of asset, when you go for liquidation, asset can be sold, cash can be liquidated, money can come back to you. So this tells me whether my money is safe in this company or not. Second, using that 80 rupee asset, company generated 160 rupee turnover. This will tell me whether company is using the assets efficiently or not. This is a measurement of efficiency. If this number is very high, imagine with 80 rupee, another company is generating 170, 180, 190, 200, 10 rupee turnover. That means they are using the asset with higher efficiency. Yeah, from 160 sales, they are generating 16 rupee. This will tell me profitability, whether they are able to control the cost or not. As an investor, I want all the three. My money should be safe, that money should be used efficiently, and that should give me enough profits. Only then, as an equity shareholder, I will be, money should be safe, should be used efficiently, and cost should be controlled. Only then my profit up. And this is what DuPont model says: NP margin, asset turnover, and equity multiplier. I just explained in this thing. You mark important even for theory. They can ask you explain return on equity under DuPont. Some more ratios related to shareholder or owners, that is EPS. You already know, earning available to equity shareholders divided by number of equity share. We have done discussed lot of questions on this. Dividend, total dividend divided by number of shares. Dividend payout ratio we studied in dividend decision, DPS by EPS into 100. Some ratios related to share market. Dividend yield, observe, I paid 40 rupee market price of the share. I paid 40 rupee, purchased that share. End of the year, they gave me 2 rupee dividend. So 2 by 40 into 100, 5% is dividend yield. Yield is basically ability to generate output. Yeah. And my investment was 40. It has generated a yield of 2 rupee. Same way, earning yield. This is not DPS. This should be EPS. Please make a correction. EPS by MPS. EPS may be say 8 rupee, 40 by 8 by 40 into 100, 20% earning yield. Price earning ratio, MPS by EPS. Observe here, 40 rupee MPS, earning is only 8 rupee. That means I am ready to pay 5 times. I am ready to pay 5 times of what I am going to earn to buy this share. Now, higher the number, understand that means if the number is very high, what does that mean? People are ready to pay more money to purchase that share. Earning is 8 rupee. I am ready to pay 40 rupee for that share. Imagine in the market that 40 becomes 45, 50, 55, 60. 8 EPS remains same. That keeps going up. That means more and more shareholders are planning to buy that share. Demand and supply. More people want to buy the share. What will happen? Automatically, share price will go up in the market. Next one is market value book value ratio. Suppose market value of the share is 40 rupee, book value is just 10 rupee. That means it is getting now traded at 4 times. Higher the number, costlier the share. When will a share become costly? Again, when buyers are more, demand for the share is more, share price will shoot up. Yeah, I have given some examples for your understanding. Trading and P&L account given, all the numbers are here, and they have even given balance sheet. They can ask you to compute all the ratios. Now this you can also go through. I have explained all the ratios. Answers are already printed here. But understand, in exam, two varieties of questions can be asked. One variety is they will give you all the data, ask you to work out ratios like this. Yeah. Second, they will give you all the ratios, ask you to prepare balance sheet, reverse working type. Please work out both variety questions. Yeah. Data given, ratio to be done, go through one question. Ratio given, balance sheet P&L to be done, go through one or two questions. Both variety you should go through. Here GP ratio is GP by sales into 100. Where is GP? Go to the P&L. You have GP here, sales here, GP by sales into 100. Second one, NP ratio. You have NP, you have sales into 100, and so on. I don't think I need to explain this in detail. Because you have both question and answer. After the video, you can go through this. Yeah, I've given all the explanation. Another variety question which students ignore. Let me spend little more time on this. Previous one is easy. I told you two variety questions. Data given, ratio to be done. Second variety, ratio given, balance sheet to be done. Nowadays they are asking a third variety, very rare, but in one question paper they ask. They will do all calculations. They will give you data also, they will give you ratio also, and they will ask you to comment. Those who have attended my regular class, you may remember we have done 3 4 questions like this in the class also. They will give you industry average and your company, or they will give you your company last 3 years, ask you to write performance summary, or ask you to write about what is good and what is bad in the company. Such questions are kind of theoretical questions, but very dangerous. Kind of theory question, appear to be theory questions, but they are very dangerous because students don't know how to answer. See one good example of R Textile Limited, details about R Textile Limited 2017-18, average of textile industry given. That means your company with average of entire textile industry. Current ratio. Yours is 2.2 last year, 2.5 this year. Industry average is also 2.5. Quick ratio 1.52 and 1.5. Same way, all the numbers are given. And they are now asking, this can happen in exam also, comment on the following. Liquidity. Now liquidity means you have to use current ratio, quick ratio, and you have to write a comment whether it is good or not. Look at this, liquidity. Current ratio has improved from last year and matching with industry standard. Quick ratio also improved above the industry. This may happen due to reduction in receivable. Overall, it is reasonably good. All the liquidity ratios are either better or same in both the years compared to industry average. This type of questions, students are finding it difficult in exam to answer because they know the formula, they can put the numbers, but if they don't understand the logic, what is the meaning? See, 2 is to 1 is the current ratio. Suppose in exam, one company has 9 is to 1, 25 is to 1. What is the meaning of 25 is to 1? For 1 rupee current liability, you have 25 rupee worth current asset. Is it a good thing? Definitely not. Definitely not. Every student, many students, let me not say every, sorry, many students think that higher the number, better it is. This is not the correct thumb rule. High number is better everywhere. No, 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 no. That is wrong. If you have 25 rupee of current asset for 1 rupee current liability, you are unnecessarily keeping too much of current asset. You don't need so much of stock. You don't need so much of cash. You don't have to keep so much in bank balance. You should have actually invested that in long term securities, or you should have purchased some fixed assets. For 1 rupee current liability, you keep 2 rupee current asset enough. You want to keep little extra to be on a safer side, 2.5 or 2.8 maximum 3 also. But if you keep 25 is to 1, you are unnecessarily blocking money. This comment you can write only if you understand the logic. And that's what I tried explaining in last 30 minutes. Understand the logic behind every ratio. Then only you'll be able to answer the commentary questions like this. You can see one more example. Operating profit, operating income reduced from last year, but profit margin has maintained. This may happen due to variability in cost on turnover. Here, however, both the ratios are still higher than industry average. You should be able to write this type of comment in ICAI study material. Yeah, there are 2 3 questions like this where they have given 2 years data and industry average. You need to compare. This is not to work out, there is nothing to solve, but please spend some time, read this. Please read this, very very important. Okay, don't ignore this variety. And as I told you, the third category, they will give you all the ratios and ask you to prepare balance sheet. Fixed asset turnover ratio 8 times, capital turnover, inventory turnover, receivable turnover, payable turnover, all the numbers given. GP given. Now, one doubt that many students have, I'll just take 2 minutes to cover this. Sir, for balance sheet preparation type of question, my worry, sir, from where to start, which working note to do. If I see the study material or even the class material, in one some working note, one is inventory, second some it is fixed asset, third it is some capital turnover. Everywhere we have done different working note. How to understand what should be done first? So the best way to solve this problem is, they want you to prepare balance sheet, right? Write the heading balance sheet. Liability amount in rupee, asset amount in rupee. Now go to the question. Is there any number that you can fill directly? Check if fixed asset is given. Okay, fixed asset 10 lakh given, fill that. Okay. Sir, next what to do? Next see what can be done. Sir, current ratio is given, current asset, current liability is given. Okay, find out. From the ratio, you can find out either current asset or current liability. Once you get current asset, write the total current asset here. But you know, under current asset, there are three numbers. And then go to the question. See if inventory ratio is given. You can do inventory turnover. Using that, you can calculate inventory value, debtor value. And if you get inventory and debtor, and since you know the total CA, if you know inventory debtor, cash can become balancing figure. So, there is no standard format, there is no standard order in which you need to prepare the balance sheet or you have to do the working notes of balance sheet. First copy everything available in the question and then you see what else I can calculate, go in that order. In this example, in this question for example, you see which is that number which I can write in balance sheet directly. None of this can be filled in balance sheet. GP I can't fill. There is no long-term loan. Reserve and surplus given. So write the balance sheet, write liability, leave one line for share capital. Immediately after that, reserves and surplus, write this number. Ending inventory of the year. Okay. 20,000 above beginning inventory. Not okay. Because this is not an ending inventory value. This is ending inventory higher by 20,000 compared to opening inventory. So if you get opening stock, you can get the closing stock. That means in this question, the only number I can fill directly is reserves and surplus. Fill it. Okay. What next, sir? Then you see which is the next number available. Next number available is GP ratio. GP ratio given, GP amount given. GP amount is available. From there, you can get sales. Once you get sales, you can get fixed asset turnover, capital turnover, sales you have GP, you have COGS, from their inventory turnover, you can get average and then they have given opening and closing stock 20,000 difference, from that you can find out closing inventory, receivable turnover given, assuming all sales on credit basis you can do debtor and that's what they have done here, that's what I'm explaining. Once you get all of this, you can go and prepare the balance sheet. Here they might have done balance sheet at the end, you can start balance sheet at the beginning itself. Okay, and available numbers you fill, those numbers that are not available you can do working note 1 2 3 4. Here one more thing, some students do a mistake, they will try to mug up the formula in a very incorrect way. Fixed asset turnover ratio, some students understand this as fixed asset by turnover. This is completely wrong. Exact opposite is the correct formula, turnover by fixed asset. Yeah. So what to do? Sir, I'll get confused with these kind of things. Remember, only if the word to is used in between. Suppose fixed asset to turnover, if they say, then you can write fixed asset by turnover. If the word to is in between, whatever is there before to is numerator, whatever is there after to is denominator. Simple. Huh. Suppose if they say fixed asset to current asset ratio 13 is to 11. That means fixed asset by current asset 13 by 11. If the word to is there in between, what is there before to? Fixed asset, numerator. What is there after to? Current asset, denominator. Here, fixed asset turnover, there is no to. Therefore, don't do fixed asset by turnover. That will be wrong. Understanding? Some questions you have this proprietary fund to fixed asset. Now there is a 2 in between, proprietary fund numerator, fixed asset denominator. And here you see fixed asset turnover, capital turnover, inventory turnover. From GP ratio with GP amount I can do sale. That means for all the formulas I can use sales itself. Fixed asset turnover, turnover or COGS. We can do turnover itself. But you see what note they gave. Fixed asset turnover, inventory turnover, capital turnover is calculated on the basis of cost. They are saying we did it on COGS or COS basis. Again, this is confusing. This is what I told you 15 minutes back. Yeah, you should actually do, if sales is available, turnover is available, do it on turnover only. I have received lot of questions, lot of doubts from students on this. Sir, they could have done on sales. Why did they do it on COGS? Don't worry. Formula said sales or COGS. They did on COGS. You do it on sales. Balance sheet will still tally. Don't worry about that because you will always have, see this other current asset. If you do everything on turnover basis, other current asset, which is a balancing figure, slightly that may go up or come down. Balance sheet will still tally. Don't worry. So you should ideally do it on turnover basis only. They have done it on COGS. They gave a note. you also give a note in exam and come safe. Yeah, I hope you understood. Guys, three variety questions can be asked in examination. One, data given, ratio to be done. Second, ratio given, balance sheet to be done. Third, data and ratio, everything is given. Comments need to be written. This comment part type of questions, please spend some time. No working out, just reading one or two questions from study material should be sufficient. Yeah. Chalo. With that, ratio analysis topic is done. And with this, our entire marathon revision has been completed. Yes. Two, three things before we conclude this video. Suggestion number one, in examination, FM and economics is together. Do not take more than 2 hours for FM because you have to write economics. Keep 1 hour for economics. Don't take more than 2 hours for financial management. Okay, FM should be 2 hours, economics should be 1 hour. Keep in that ratio. Number one. Number two, one day before exam, always complete the smaller chapters first. Risk and leverage, dividend decision, risk analysis in capital budgeting. Complete this first and then go to the bigger topics. Third, do not ignore theory. Out of 60 marks, 60 in FM, 10 marks will be theory itself. Okay, theory is very, very important. I have prepared a theory summary notes. The link to that PDF, theory summary of financial management, I will paste it in the description section below. You can download that also. Yeah, so theory should not be ignored. 10 marks out of 60, extremely, extremely important. Keep these three things in mind. I wish you all the very best for your FM paper. Please share this video with all your friends who are writing FM and economics paper. Thank you so much. Once again, I'm closing this session. Take care. Bye bye.